The next we'll do is accounting standard 13. Again, very, very important standard which deals with investment. There are only 2 or 3 types of questions which are regularly tested in the examination. And if you are comfortable with that, we will be able to handle this. Now, first thing, what is investment as per AS 13? These are assets held by an enterprise. So they are an asset for earning income by dividends, interest, or rentals, or for capital appreciation or other benefits. So you are holding it for earning income, that is largely in the nature of dividend, interest, and rentals, or for capital appreciation or other benefits. Now, typically, when we say investments, that is covered by accounting standard 13, is your investment in equity shares, bonds, debentures, investment in property. Okay. Now, what are exclusions? If something is held as stock in trade, it is excluded. Means if I'm buying and selling investments regularly as stock in trade, I'll exclude that. Accounting standard 19 covered, operating or finance leases, those are excluded. Investments or retirement benefit plan of life insurance and life insurance enterprise, that is removed. And venture capital funds and related AMC or unincorporated mutual funds, etc., those are also excluded. Okay, these are what are excluded from the scope of this particular standard. Now, definition is not that much relevant, but what is important is what are the types of investment. The standard describes or classifies the investment into 2 categories: current investment and long-term investment. Current investment is intended to be held not more than 1 year from the date of investment, and it is readily realizable. So basically, we also can call it short-term. Less than 1 year you can call, less than 12 months you can call, but this is not from the date of investment. You are viewing it from the date of investment. I will hold it for a period of 12 months, current investment. If it is not a current investment, we classify it as a long-term investment. So there are 2 types of investment: current investment and long-term investment. Current investment, that is your something which is intended to be held for not more than 1 year from the date of investment and which is readily realizable. Long-term investment is any investment other than a current investment. If it is not current, it has to be long-term. Now, the key part of this standard, what it also requires is, if it is current investment, we will show it at lower of cost or fair value. If it is long-term investment, we'll show it only at cost. That will come subsequently, but this is the overall principle when it comes to classification of investment. Now, how do we account for investment? Initial recognition is always done at cost. Initial recognition means first time when you recognize something, you will consider it to be at cost only. The cost of an investment includes acquisition charges. So what is that? Whatever amount you have paid plus brokerage fees, duties in order, but stamp duty or something like that. Okay, so that is what you will consider. So if I have paid, let us say 1,000 is the cost, 1% is the brokerage, which is 10. So my cost of investment becomes 1,010. Cost of investment becomes 1,010. Okay, then we have this discussion of cum interest and ex interest that we will do subsequently. Cost will include this, plus if you have brokerage, you have considered if there is any fees, any duties, whatever is paid to acquire the investment forms part of the cost of investment. If, however, we have acquired it by issuing shares or other securities, then the cost is fair value of securities issued or asset given. So if I have acquired an investment by issuing my own shares, or if I have acquired an investment by giving some other asset, then I will take asset, security issued or asset given. Always first preference will be something which is given, unless something which what you have given up is considered first. If you are acquired in exchange or part exchange for another asset, cost of investment is determined with reference to fair value of asset given up. Again, here also fair value of asset given up. But if something which is acquired is more evident, then we will take that. Same principles what we learned in accounting standard 10, accounting standard 26, same principle applied here. Fair value of asset given up. If acquired is more evident, then fair value of asset acquired. More evident means it is more clear. It is more clear. That is what is cost. Now, we referred or we said that there is a requirement of fair value. What is fair value? is the amount for which an asset could be exchanged between a knowledgeable willing seller, buyer, and a knowledgeable willing seller in an arm's length transaction. So generally, this fair value, what we can refer to is at market value. Typically, you can look at stock exchanges. Whatever is happening in the stock exchanges, whatever is being dealt with at the stock exchanges, that is what is the fair value. Okay. That is what we will. Now, whenever we buy an investment, for example, I have purchased some shares or I have invested in debentures, I have invested in bonds, I will receive for shares dividend, for other investments interest. Now, if this dividend pertain to the pre-acquisition period, we'll deduct it from the cost of investment. For example, I acquired something on 1st of April of 25. The company declared dividend for the year ending 31st March of 24. This is declared out of pre-acquisition profit. So if something is declared out of pre-acquisition profit or it is related to pre-acquisition period, we will reduce it from the cost of investment. Whatever is for the post-acquisition period, we'll take it to P&L. So if I have invested 10,000 in a particular share or in a particular security, and I have received a dividend of 1,000, which is pre-acquisition, this will be shown at a value of 9,000. This adjustment is relevant for accounting standard 21 questions as well, what we have discussed there. Okay, so 10,000 minus 1,000, 9,000 is the amount that will show the investment. Now, how about interest? Interest, what happens is, let us say, I purchased some securities on 1st of June of 25 and last interest paid was on 31st of March of 25. I have 1,000 debentures of 100 each at 12% interest. So the debentures pays me 12% interest. 1,000 is the number, 100 is the face value, 12 is the interest. So I purchased on last interest paid. Last interest paid was on 31st of March. Next interest will be paid on 30th of June of 25. Next interest will be paid on 30th of June of 25. Now, 31st of March of 25, whatever is the interest I have paid or the company has paid, it is okay. On this date, I have bought. Now, when I bought on this date and when I get interest on 30th of June, I will get interest for 3 months. I'll get interest for 3 months. Though I have bought on 1st of June, on this date, because I hold the debentures, I will get the interest for 3 months. Now the seller will say, boss, for April and May, I have held the investment. So you have to reimburse that interest to me. So generally what happens is, I'll calculate interest for 2 months. That is 1,000 into 100 into 12% into 2 divided by 12. If I do that, 12% of 100 is 12. So 12, this gets cancelled. Interest is 2,000. This is called pre-acquisition period interest. So when I am buying the debentures from the other party, he would say amount you have to pay is 1,000 into 100 plus 2,000, that is 1,02,000. When I pay this 1,02,000, 2,000 is for the interest, 1,00,000 is for the debenture. So this 2,000, what I will do is I will debit investment by 1,00,000. I will debit interest receivable by 2,000 and I'll credit bank by 1,02,000. Now, if you see on a face value basis, face value is 100. Number of months from last interest paid is 2. Interest rate is 12%. Now, how much interest has been accrued on this 100? Interest is equal to 100 into 12% into 2 by 12. So this will be 2. The other party, when he sells me, he will say pay 102. This includes interest. Or we say this is cum interest, that is cumulative of interest. Now, even if the question does not say we have paid interest or not, we have to calculate that interest component. We have to calculate that interest component and account for it appropriately. So any interest for the Pre-acquisition period will not be taken to the cost of acquisition. It will be considered as a part of your P&L item. Okay. Now, if I say 102, come interest. Interest is 2. So 100 is X interest. 100 is X interest. Brokerage is calculated on 102 only. Brokerage is calculated on 102. This is taken to investment account. This is taken to the interest account. Okay. Now, the complex part of these questions will deal with it subsequently. But are you clear with the come interest portion and the X interest component, how to calculate? Likewise, when we acquire rights shares can be acquired on come rights basis. Inside entitlement. So when we acquire shares and we are entitled to rights, what happens is we can subscribe to the rights shares subsequently. Okay. Now, if we have subscribed to the rights shares, means the company has come up with the rights issue, we have subscribed to it, the cost of the rights share is added to the carrying amount of original holding. So if the company comes up with rights shares, we have subscribed it, the cost will be added to the original holding. That's straightforward. But if we have not subscribed, but we have sold it in the open market, so I can sell my right entitlement in the open market. I can sell right entitlement in the open market. Then the proceeds will be taken to the P&L. But there is an exception. For example, I have acquired some shares at 100 on come rights basis. I have sold the right entitlement for 5. Typically, this 5 should be taken to P&L, no problem. But if the share price falls because of this rights issue and X rights price, let us say, becomes 96. X rights price became how much? 96. Then what will happen? Then what you will do? To the extent of this 100 minus 96, 4, you will reduce from cost of investment, and 1 you will take it to P&L. Sir, what if X rights falls to 94? Entire 5 will be adjusted from the cost of investment. So if shares are acquired on come right basis and the market value of the investment immediately after the becoming X right is lower than the cost for which they were acquired, sale proceeds of rights will be applied to reduce the carrying amount of such investment to the market value. So from 100 it became 96. 4 out of this 5, 4 will be credited to investment account and balance 1 will be taken to P&L. This is one concept which is important, can be tested on MCQ basis, or when you're doing MCQ, you will do it. Okay. Then, as far as investments are concerned, it is lower of cost or fair value. It is lower of cost and fair value. And if it is long-term investment, it is carried at cost. Principle. Theory, very important. When you get a theory question, you have to write long-term investments are carried at cost. Current investments are carried at lower of cost and fair value. Now, if cost is 100, fair value is 90, you will record it at 90. This 10 of loss is taken to P&L. So if reduction in fair value is debited to P&L account. If reduction is done, it will be taken to P&L account. Okay. Then subsequently, let us say in year 2, fair value became 105. Cost is 100. So what you will do? You will value it at cost. Now this 90 to 100, the reversal, if the investment value is increased, the increase up to the cost is credited to P&L. So because 10 we have debited to P&L, 90 when it became 100, this 10 we will credit to P&L, like this we will do. And we will do on each investment individually. It is not that you will take gold, silver, debentures, bond, everything on one side and compare it on a totality basis. That is not allowed. Gold, do it separately. Silver, do it separately. Each share, each instrument separately we have to value. So formula, current investment is valued at lower of cost or fair value. If there is a reduction in fair value, it is debited to P&L. If there is subsequent reversal, it is credited to P&L up to the cost. You will not show it above the cost. For long-term investment, they are carried at cost, and very important that if there is any decline which is other than temporary, for remembering purpose, you can put it permanent, but you have to say other than temporary. If there is an other than temporary decline in the carrying amount of long-term investment, the reduction in carrying amount is charged to P&L. So if cost is 1000, If cost is 1000, because of reduction, it came down to 900. 100 will be debited to P&L. If subsequently we feel that the whatever the decline was there, which has been removed, then in that case, what you will do? You will reverse the amount back to the P&L. Okay. Again, it is done on individual basis. Then there is something called as investment property. Investment property is basically your land and building held for investment purpose. An investment property is an investment in land and building that are not intended to be occupied substantially for use in the operation of the enterprise. So if I have an office place building, if I'm using it for my office, I call it to be property, plant and equipment as per accounting standard 10. But I have a land and building and I want to give that on rent, then that is called investment property. That is called investment property. Investment property is accounted by using the cost model as per accounting standard 10. So you'll have cost minus depreciation minus impairment. Okay, so that is about investment property. Whenever we sell off investment, the difference between the sale proceeds minus selling expense and the carrying amount is to be taken to P&L. So basically, I can say net sale value. Let us say 1000 is the sale value, 1% brokerage. So you will do minus 10, you get 990. The sale value will compare with the carrying amount. Sale value will compare with the carrying amount. If sale value is greater than the carrying amount, the difference is taken to P&L. If it is the reverse case, you will debit it to P&L. So gain is credited to P&L and the loss is debited to P&L. Okay. When the part of investment is disposed, let us say I have 1000 shares, but I have disposed only 500 shares, then we will calculate the average carrying amount, using the average carrying amount basis. So basically we'll do average basis. We'll do the average basis. This, when we solve questions, we'll have more clarity. Sometimes there can be reclassification. Earlier we thought it is current, now it is long term, possible. Or it was long term, now it is current. What we will do? We will do first, if it is current to long term, means current to long term, lower of cost or fair value. So you will take cost, fair value on the date of reclassification, whichever is lower at that value, you will take it to long-term investment. And subsequently, that amount becomes the cost for the long-term investment purpose. Okay. If it is long-term to current, means earlier it was long-term, now it is current, you will take lower of cost or carrying amount. Carrying amount generally happens if there is a permanent amount deduction, or otherwise it is cost. So lower of cost or fair value, lower of cost or carrying amount. In these two, that is how you will do the reclassification. The difference that will be taken to PN. Difference will be taken to long-term investment in A is costing 8.5 lakhs, are now classified as current. Company had reduced the value of this investment to 6.5 to recognize a permanent decline. Fair value is 6.8. But you will take cost and carrying amount, not the fair value. Cost and carrying amount, whichever is lower. So 6.5, that is how you will take. Okay. Now, this is the portion covered by accounting standard 13. In the next class, we will see how do we do the accounting, how do we prepare the accounting, do the accounting for investment, how do we prepare the ledgers, what are the things to be taken care, all of those things. Okay. Tomorrow, there is no class. The next class is on 26th. We will do from 10 to 12 or 12:30. Okay. Sure. Thank you.
Okay. So in the previous class, we ran through the discussions around accounting standard 13 investment, what is the principle. Now today what we'll do is we'll take up the questions which are generally tested in the examination. So there are two type of question. One question will test about the accounting standard 13 principle. For example, cost or net realizable value, not net fair value, cost or fair value, long-term investment. That is one type of question. And then the second type of question is where we have to prepare a ledger account for investment. So one is where they'll test the core principles of accounting standard 13. How do you value current investment? How do you value long-term investment? These principles are tested. Then we have second type of question where they will ask you to prepare investment account in the books of the investor. These are the two type of question that generally comes up. These principles we have already discussed. Now in examination, when you get a question, whether it is current investment valuation or long-term investment valuation, you have to give the definition of what is a current investment or a long-term investment. Then what is the valuation principle? For example, what you would say, long-term investment. These are generally valued at cost, unless there is a decline which is other than temporary. So if there is a decline which is other than temporary, then we will write it down to the fair value, or we will write off the loss because of the decline. Okay, so that is how you have to frame the question. What is a current investment? You have to write that. Or what is a long-term investment? You have to write that. Then, because it is a long-term investment, we have to value it using what do you call the principle of long-term investment, valued at cost. But if there is a decline which is other than temporary, then it should be written down to the realizable value. Then accordingly, the investment should be valued at so and so amount. That is what you have to state. Okay, so that is how you will be writing when it comes to the examination. Now we'll take up questions. So for example, this one where it is a core theory testing. An unquoted long-term investment is carried in the books at a cost of 2 lakhs. The published accounts of the unlisted company received in May year 1 showed that the company was incurring cash losses with declining market share, and the long-term investment may not fetch more than 20,000. So we invested at 2 lakhs. It may not fetch more than 20,000. How will you deal with this in preparing financial statement for the year ended 31st March of year 1? Okay, now one thing that you have to understand is the information when we received was in May. Now you have to see whether the financial statements have been approved or not approved. Okay, that is one thing you have to write. Assuming it is not approved, assuming it is not approved, then this becomes an adjusting event. This becomes an adjusting event because we got the financial statements for 31st March of year 1 as on May. So the condition existed on 31st March of year 1 and we got the information in May. Hence, it is an adjusting event. Now, if it is an adjusting event, what is the thing we will do? We will adjust it. That is the first thing. So that part you will cover first. Then, second part that you need to understand is there is a cash loss, it is not doing good, and the long-term investment may not fetch more than 20,000. Now, if we assume that this investment, if this we assume that this declining in value is other than temporary, then we have to make a provision for diminution in value. 2 lakhs minus 20,000, 1,80,000 should be provided for. But if we assume it is not, if it is temporary decline, then in that case, you will continue to show it at 2 lakhs. So that is why you have to give the answer. Okay. Provision for diminution should be made to recognize a decline other than temporary in the value of investment. This is very, very important. Exact same terms, if you write, your answers are true. Okay, so that is how we will answer. Then ABC Limited wants to reclassify its investment in accordance with Accounting Standard 13. Decide and state the amount of transfer based on the following information. So you can have current to long term, or you can have long term to current. Both the scenarios are possible. Now, how do we reclassify? Long term to current, lower of cost and carrying amount. Current to long term, lower of cost and fair value. Okay, so that is the amount at which we will be transferring. First, portion of current investment purchased for 20 lakhs to be reclassified as long term as the company has decided to retain them. The market value on the date of balance sheet was 25 lakhs. So what is this current? Current means lower of cost and fair value. What is the cost? 20 lakhs. So we'll transfer it at cost. The market value is 25, which is higher than the cost. Therefore, the transfer should be carried at cost only. But you have to give this theory. This theory is important. Okay. Then another portion of current investment purchased for 15 lakhs to be reclassified as long term. The market value of this investment on the balance sheet date is 6.5. Lower of cost and fair value. Fair value is 6.5. So you will take it to 6.5, balance 8.5 lakhs will be your expense. Certain long-term investment no longer considered for holding purpose to be reclassified as current investment. Original cost of this was 18 lakhs, but is written down to 12 lakhs. So cost 18 lakhs, carrying amount 12 lakhs, so you'll transfer it at 12 lakhs. To transfer at 12. So what about 6 lakhs? 6 lakhs has already been written off to P&L. So there is no treatment for that loss of 6 lakhs. Then Innovative Garments Manufacturing Company invested in the shares of another company on 1st of October at a cost of 2,50,000. It also earlier purchased gold of 4 lakhs and silver of 2 lakhs on 1st of March. Market value on 31st March of the above investment are given below. Shares, gold, silver. Shares is 225, gold is 6 lakhs, and your silver is 3 lakhs 50,000. Okay. Now, what is the question? How above investment will be shown? The screen got interrupted in between. I hope now it is visible. How above investment will be shown in the books of accounts of Innovative Garments Manufacturing Company Limited for the year ended 31st March, as per the provision of Accounting Standard 13 investments. Okay, now what have they done? They have given 3 investments: shares, gold, and silver. Okay, now how do you evaluate shares? You have to check whether it is current or long term. If it is current, what is the cost? Cost of 2,50,000. So if it is current, you'll value it at 12,50,000. Sorry, if it is current, you'll value it at 225, lower of cost and fair value. If it is long term, you'll value it at cost only. Okay. Then it purchased gold of 4 lakhs, silver of 2 lakhs, and 1st of March. Market value is as follows. So cost of gold is 4 lakhs and cost of silver is 2 lakhs. Okay. Now here in both the cases, cost is lower than the market value, and hence you will be showing it at cost only. That is the first thing. Okay, that is the first thing. Second thing is, again here, whether it is long term or short term. Now, we can make an assumption it is for long term, or you can make an assumption which is short term. But however, whichever assumption you take, cost is still higher, lower than the market value. You will continue to show it at cost. Okay, so that is how you will do the answer. So that is as far as the principles of accounting standards related question is concerned. Okay, that is how it is done. Now, the second thing is investment account to be prepared. Now, when we talk about investment account to be prepared, please ensure you follow this format. Okay, this format which is easier to use. You'll mention the date, particulars, nominal value or face value, interest, what is the cost, that is one part. Then date, particulars, nominal value, interest, cost. Here, in case of shares, you can have dividend column also. Okay, so you will have date, particulars, face value, interest, cost. Is it mandatory? Not mandatory, but as per the suggested answers, the model solutions, whatever they have given, even when we check papers, all of this information is given. Okay, so for the entire set, you will get marks. So can we write total? Total is, if you want, you can write total also. So interest plus cost, you can write a total column also. You will do it in the horizontal format. Okay, because this will not fit in a single page, right? For each investment, you will prepare a separate investment account. So that is these are the things you have to keep in mind. Now, whenever they give an information of purchase, ensure you add the percentage of brokerage, any other duty and all at the value of the transaction. That is one thing you have to keep in mind. Then, especially with respect to debentures, you have to see if there is any pre-acquisition dividend for interest. For dividend also it will be there, but for interest it will be much higher. In year 1, Messrs. Y Limited issued 12%. Yeah, horizontal means landscape. Vertical is your vertical format, the page, when you take the page. So if I have to just show you this is how normally it would be, right? I don't think it is visible. It is blurred. So the thing is, make it the way you do partnership capital account. It will make examiner's job easier to value the thing. Okay, that is the first thing, right? So here, Messrs. Y Limited issued 12% debentures of 100 each. Interest being payable half yearly on 30th September, 31st March. These dates are very important. This is when the company will pay interest. This is when the company will pay interest. On 1st of December, Bull and Bear purchased 10,000 of these debentures at 101 X interest price. X interest means interest has to be computed separately and paid separately. Interest has to be computed separately and paid separately. Also paying brokerage at 1% of X interest amount of the purchase. If nothing is given, this value is the value that is considered for calculating brokerage. So this is the first thing. Now, first thing, when did we purchase? We purchased on 1st of December. When we purchased on 1st of December, first thing that you have to do is which was the last interest paid date. That is what you have to calculate. So here interest is 30th September, 31st March. If I purchase on 1st of December, the latest date is 30th of September. So till 30th of September, the company has paid the interest. Till 30th of September, the company has paid the interest. Now, when I buy on 1st of December, the selling party will ask me interest for full month of October and full month of November. 2 months interest the selling party will ask. Interest based on what? Interest based on 12% at face value. So 12% of 100, 12% of 100 into 2 divided by 12. 2 months interest I have to pay. So this if I do, this will come to 2. This will come to 2 per debenture. This if I multiply by 10,000, that is 10,000 into 2, I get 20,000. I get 20,000. Okay. So this is one thing that we need to understand, that this is the interest value that we will pay separately. Now, if this was given cum interest, let us say 101 cum interest, then from this 101 cum interest, we would have reduced 2 of interest. But here we will say 101 plus 2 of interest. 20,000 is interest. Okay. And brokerage of 1%. So amount paid will be 10,000 into 101%. When they say purchased at 101, purchased at 97, 98 and all of that, that indicates percentage. 10,000 into 101 into 100. This is the face value. Okay. Now when face value is 100, you can directly say 10,000 into 101. Okay. If face value is 1,000, then you have to use 101% into 1,000. If at all there is a face value of 1,000. If face value is 100, you can directly take 101. So this will become, if I have to calculate 10,000 into 101, 1010,000. This is the thing. On this, 1% brokerage is payable. So you add 1% brokerage, that is 10100. Okay, 10100. So the total comes to 1020,100 plus interest 20,000. So that is the total amount paid. Now, when you pass the entry, you will debit the investment cost by the amount paid towards the debenture, and you will debit interest to 20,000. So the actual entry is in investment debit 1020,100, interest debit 20,000 to bank the number. Okay, so that is the first thing you would do. Then, and please keep in mind, in examination, sometimes they give you a question with multiple transactions. So you have to be very careful in calculating. Okay. On 1st of March, the firm sold all these debentures at 103x interest price, again paying brokerage at 1% of x interest amount. Now what happened? On 1st of March, they sold. Did we get any interest? We did not get any interest. The company will pay us interest on 31st of March. We sold it off on 1st of March. So my selling price will be 10,000 into 103. That is 103,000. Right? This is my selling price. Plus, brokerage. Sales value will reduce brokerage because we will get lesser amount. Minus brokerage 1%, that is 103,000, 10,300. So 10,30,000 minus 10,300, you have 10,19,700. That is towards the sale value of debenture. Please remember, as we pay 2 months interest, we will also ask interest. Sir, how much amount interest we will ask? Last paid date is 30th of September. We are selling it on 1st of March. So we'll ask interest for October, November, December, January, February. Okay, for 5 months. So 5 months interest will be 50,000. 5 months, like we had 2 months interest at 20,000, 5 months interest is 50,000. Okay. Now, the difference between the cost 10,20,100 and the selling value 10,19,700, whatever is the difference that we get, that difference will be the P&L balance. Okay. Now, here what has happened? We purchased at 10,20,100, we sold at 10,19,700. So there is a loss of 400. There is a loss of 400. Now this is 100% sold. If we had only sold, let us say 400 debentures, we would have calculated gain or loss considering 400 debentures, and balance 600 debentures would be closing balance. Okay. This is the loss. And the balance number in the interest column is the interest. Now this 30,000 is basically, see, we purchased on 1st of December, we sold on 1st of March. This represents 3 months interest. That is how the account gets tallied. Any question here? Let's look at this one. On 1st of April, Mr. Krishnamurthy purchased 1000 equity shares of 100 each in Telco Limited at 120 from a broker who charged 2% brokerage. He incurred 50 paise per 100 as cost of shares transfer stamps. Okay, so basically what it means, 2% brokerage we paid and 0.5% stamp duty we paid. On which value? On the transaction value. On 31st of January, bonus was declared in the ratio of 1:2. 1:2 means 1 for 2. So if I have 1000 equity shares, I'll get 500 bonus shares. Please remember, for bonus, we'll just adjust the number column or the face value column. We will not adjust the value column because the value of investment does not change. Before and after the record date of bonus shares, the shares were quoted at 175 and 90 per share respectively. This change in value because of bonus shares is not relevant for us. What is relevant for us is what is the closing balance? What is the closing balance? On 31st of March, Mr. Krishnamurthy sold bonus shares to a broker who charged 2% brokerage. How much did we sell? We sold 500 shares. Show the investment account in the books of Mr. Krishnamurthy, who held the shares as current assets, and closing value investment shall be made at cost of market, whichever is lower. Even if this information is not given, because we are holding it at current investment, we will value it at cost or market value, whichever is lower. Okay. Now, sir, how to take the market value? Market value, if nothing is given, we can take this number as the market value, that is post the bonus issue. Okay. Now, first, how many shares? 1000. Face value 100. So to bank, this is the nominal value. Then how much did we pay? 120. But we paid 120 plus 2% brokerage, 2.4 plus 0.5% stamp. Sorry, 0.5% stamp duty, which is 0.6. So this is 120, 122, 123. 123 per share. Or you can calculate on totality basis also. Totality basis, that is 1000 into 120 plus 2.5%, you get 1,23,000. You get how much? 1,23,000. Okay. So that is the first entry. Then there is no dividend. There is a bonus issue. Now, whenever there is a bonus issue, you will just say to bonus shares, just increase the face value or quantity. So instead of nominal value, you can also have quantity. You can follow that also. You will add here, but amount will be 0. You will not add anything in the amount column. All right. Then on 31st March, Mr. Krishnamurthy sold bonus shares to a broker who charged 2% on brokerage. Now, sir, what value did we sell it at? Now, nothing has been given, so we can assume that we sold it at this number, that is after the bonus issue. So 90 is the sale value. How many shares did we sell? We sold 500. See, we had 1000 shares. We got 500 as bonus. This 500 we sold. This 500 we sold. So 500 into 90, we get 45,000 minus brokerage. See, whenever we are selling, we will reduce the brokerage. Whenever we are buying, we will add the brokerage. Okay. Brokerage at how much? 2%. So 2% of 45,000 is 900. So you get 44,100 as sale value. So you have 44,100 as sale value. Is it clear so far? So far it is simple calculation. Correct. Okay. Now, the most critical element is what is the profit on sale of these shares? What is the profit? Don't think bonus shares is 0. We should not do. After you purchase this bonus share, we have to calculate what is the average cost per share. Average cost per share meaning we paid 1,23,000. With this, we got 1,500 shares. So 123 divided by 1,500, we have 82 per share. This is the cost, average cost. Okay. Now what do we do? Cost of shares sold is equal to 500 into 82. 5 8 is 40, 5 2 is 10, 41,000 is the cost sold. 41,000 is the cost sold. And balance 1000 into 82. This is my closing balance. So we'll follow average basis, not FIFO or something. Unless the question mentions it, we'll follow the average basis, right? Now, sale value is 44,100. Sorry, sale value is 44,100. Cost of this is 41,000. So 44,100 minus 41,000 when you do, you get 3,100 of profit. That profit you will record on the debit side. Always remember, profit is recorded on the debit side of the investment account and losses are recorded on the credit side of the investment account. So 3,100 is the profit. 3,100 is the profit. Then 82,000 is the closing balance. 82,000 is the closing balance that you have calculated. Your ledger will automatically tally. Okay. These type of questions typically we can expect for 5 marks in the examination. One more thing, the bonus before and after what they have given, that thing we should, not consider as if it's a right issue. One more thing, our closing valuation is at how much? 82. What is the market price? Market price is 90. So because it is less, the cost is less than the market price, we'll continue to show it at cost only. Okay, so this valuation of equity shares for 31st March is also important. If it is lower, let us say, if for example, for whatever reasons, the fair value is only 70,000. So you will record this at 70,000, balance 12,000 will be your loss. Okay, that is one thing you have to keep in mind if it is a current investment. Let's look at this one. On 1st of April of year 1, Rajat has 50,000 equity shares. This is what opening balance of P Limited at a book value of 15 per share, nominal value 10. Book value of 15 means cost is 15, opening balance is 15. He provides you the following further information. On 20th June of year 1, he purchased another 10,000 shares of P Limited at 16 per share. So this is the fresh purchase. That is 10,000 plus into 16. On 1st of August, P Limited issued one equity bonus share for every 6 shares held by the shareholders. Now, please remember, unless the question mentions otherwise, you are entitled to bonus and dividend on all the shares. You are entitled to bonus and dividend on all the shares. So, 10,000 is your purchased, 50,000 is what is your original holding, right? So, 50 plus 10 is 60,000. How many bonus shares? 1 for 6. 1 is to 6. So, into 1 divided by 6, you get 10,000 bonus shares. You get 10,000 bonus shares. On 31st October, the directors announced a right issue which entitles the holder to subscribe to 3 shares for every 7 shares held at 15 per share. Shareholders can transfer the rights in full or part. So, now what is this? Original holding is 10,000, 50,000 is the opening balance, 10,000 is the original holding, bonus issue. You have 60,000. Sorry, my bad. Original opening balance is 50,000 plus 10,000 we purchased. We got 60,000. Then we got 10,000 bonus. This made it 70,000. Now my right entitlement is 3 shares for every 7 shares held. So 70,000 divided by 7 multiplied by 3. Right entitlement is 21,000. Okay. This basic working, you should be able to do it properly. This basic working, you should be able to do properly. Okay. Now, Rajat sold 1/3 of the entitlement to Umang for a consideration of 2 per share. So, out of 21,000, sold 1/3, that is 7,000. Subscribed. Balance will assume we have subscribed 14,000. Okay. So balance brought down 50,000 at 15. So 50 into 15, 7,50,000. To bank account, we purchased 10,000 at 16. So 10,000. 10,000 into 16, 1,60,000. Then bonus issue 10,000. So, like what we did, they got bonus issue of 10,000. So, I did a mistake here. 70 by 7 into 3. Guys, if I am making any calculation error, it is your due to know responsibility. Yeah, Vishnu had highlighted 30,000. So, it is 70 by 7 into 3. I did 7 into 3 wrong. This is 10,000 into 3. This is 30,000. Out of 30,000, I'm doing again. We have 70,000 shares before the rights. Divide by 7 into 3. This has to be 30,000. Thanks, Vishnu. Out of this 30, one third is sold, 10,000, and two third, 20,000 is subscribed. By sale of this, whatever amount we get into 2, this is 20,000. This will be transferred to P&L unless the shares issue after the rights have, the share price of the rights have come down. In that case, we can credit it from the cost of shares also. Okay. But here nothing has been given. So we'll take directly this 20,000 to the P&L. We subscribe to the right shares 20,000 into 15, 3 lakhs, and closing balance 90,000 shares of 12 lakh 10,000. Okay. Now, if for example, because of this rights issue, the shares price have fallen, we will credit this to investment account. We'll say by bank 20,000, depending on what is given in the question. This is credited to year. Any questions so far? Any confusion in this? This is one of the easier chapters, only that calculations can make it complicated. Also, the wording of the question. The wording of the question, very, very important. Very, very important. The wording and sequence. So, if there is right issue, bonus issue, multiple issues given, you will go in the sequence of what is given in the question. Okay. And unless I'm telling you, unless it is mentioned, every share is entitled for bonus, every share is entitled for right. Okay. Let's look at this one. On 1st of April, Sundar has 25,000 equity shares of X Limited at a book value of 15 per share, nominal value 10. On 20th June, he purchased another 5,000 shares of the company at 16 per share. Similar question. The directors announced a bonus and rights issue. No dividend was payable on these issues. Now here, they have clearly said bonus and rights issue. No dividend was payable on these issues. So if dividend information is given, only will get an original share. Sir, if this statement was not given, then what? Then you will assume every share is entitled to your dividend and bonus and rights. Okay, please keep this in mind. And that is how it works in real life also. That is how it works in real life as well. Okay. Bonus issue 1:6. Date is 16th August. So first you will do the bonus issue. Bonus issue 1:6. First you will give the impact of bonus issue. Then rights basis 3:7. Same. The structure is same. 15 per share. Due date for payment 30th of September. Shareholders were entitled to transfer the rights in full. Accordingly, Sundar sold 1/3 of his entitlement to Sekar for a consideration of same. Now, only thing different in this question is dividends for the year 31st March of year 1 at the rate of 20% were declared by X Limited and received by Sundar on 31st of October. When did we get declaration? 31st of March. So if we got the declaration on 31st March itself, on 31st March itself, we can say that it is dividend which is receivable. It is dividend which is receivable that you have to record it. Okay, that is the first thing you have to keep in mind. Then dividends for shares acquired by him on 20th June are to be adjusted against this cost of purchase. Okay, so multiple things are there. One, you have opening balance. This dividend, whatever you get, that is how much? 20%. So 25,000 into 20% into 10, whatever you get this number, this 50,000, this will be directly taken to P&L. No problem. Then we purchase something on 20th of June, 5,000 shares at 16. They announced dividend at 20%. So what is the dividend there? Dividend there is 5,000 shares into 10 into 20%. This is 10,000. This is considered to be pre-acquisition dividend. If it is pre-acquisition dividend, we'll reduce it from the cost of investment. Now, what is the entry we pass? Normally, we say bank to dividend. But here we will say bank to investment. Bank to investment. So in the investment account, what you will do, you will credit that 10,000 that you have received as dividend. So what about balance dividend that we have received? The balance dividend that we have received will be taken to P&L directly. 50,000 that we calculated, that will be taken to the P&L directly. Okay. Then on 15 November, so after all of this, after this date, on 15 November, Sundar sold 25,000 shares at a premium of 5%. So technically, there is nothing called premium. The sale price, basically, what they mean is it is 15. Sale price, what they mean is it is 15. Now, the most important thing here is we started with how many shares? 25,000 shares. Then we purchased another 5,000 shares. So we have 30,000 shares. Plus, we got bonus. Now, what is the bonus that we have received? The bonus count, if you see, the bonus is 1/6. So bonus is 1/6 means 1/6 of 30,000. We got 5,000. This makes it 35,000. This divided by 7. The rights issue is same, no? 3:7, like we had in our other question. Rights issue is 3:7. So 35,000 divided by, not 35,000. We purchased 5,000 again, I guess. We purchased 5,000. So again, my bad here. I'll just redo this. No, correct only. 30,000 plus 5, 35,000. 35,000, the bonus issue is, the rights issue is 3:7. So divide by 7, multiplied by 3, if I do, it becomes 15,000. So the total shares that we have currently, out of this 15,000, we subscribed to 10,000 and we sold 5,000 in the market. So the total number of shares that we have is 45,000. How 45,000? 30 opening plus 5. Not opening 30, 25 plus 5 purchased 30. 30 plus 5 bonus 35. 35 plus 10 that you have subscribed 45. So this is 45,000. Now the most important thing you have to keep in mind is for calculating average cost, you will take opening cost, whatever you have paid, bonus is 0. Rights issue subscribed cost. So the most important is minus 10,000 of this pre-acquisition dividend. So when you do that, 375 plus 80 plus 150 minus 375, 80, 150 minus 10 divided by 45,000, you get the average cost. You get the average cost. You get the average cost, right? That cost multiplied by 20,000 is the closing balance, and we have sold 25,000 shares. So while calculating profit on sale of 25,000 shares, you will multiply that by 25. Or the easier way to do that is this number 375 plus 80 plus 150 minus 10. You have 5,95,000. This is the cost of 45,000 shares. So 595 divided by 45,000. If I do, I get 13.22. This is the average cost. Closing balance will be 20,000 into 13.22, and the cost of sale will be 25,000 into 13.22. Like this also you can do the calculation. Closing balance information is not given, so the cost will be considered as closing balance. For the shares purchased on 20th June, if the question was silent on pre-acquisition dividend, would we receive the dividend? So what we have to see dividend. This is just for your general understanding also, so that you are aware of how things work in the real life. Generally, what happens is This is 31st of March of year 1, financial year end. Let us say 31st of May is when the financial statements are signed. Somewhere around 30th of September, AGM is held. In the AGM, they declare the dividend. In the AGM, they declare the dividend. They declare. So this is the date of declaration. When they declare the dividend, what they say is, or when they pass the resolution, they mention that the shareholders who hold the shares on, let us say, who are holding the shares on, let us say, 15th of October. Whoever hold the shares as on 15th of October, this is called the record date. You should have the shares as on 15th of October to get the dividend. Whether it is dividend pertaining to previous year, whatever is the date from whichever profit it has come, they will say 15th of October is the record date. So if I hold the shares on 15th of October, I'll get dividend. This happens in real life. Okay. There is no such concept, very rarely you will see that. And it can happen only in the private companies where they say that this share will not be entitled to dividend. But generally practice, if you see, because when I'm buying it on 30th of September, I'm assuming the company has earned profit. Or if I'm buying it on 10th of October, I'm also buying because the company had the past profit. You cannot exclude me. But after this record date, subsequent buyers, they will not be entitled to dividend. Okay, they will not be entitled to dividend. So this is the record date. So technically, in the question, if they have not mentioned anything, when was the dividend declared? 31st of October. You will be entitled to dividend on bonus also, on rights also. Okay. Technically, that is how it works. ICAI somehow they have this concept of dividend is not applicable on this, not applicable on that. Generally, that is not how it happens. All right. Now, one question we'll do which has both cum interest and ex interest. The following information is presented by Mr. Z relating to his holding in 9% central government bonds. Okay, 9% central government bonds. Opening balance, nominal value 1,20,000, cost 118, nominal value of each unit is 100. So they have themselves given that nominal value of each unit is 100 and what is the cost? 120. So when you prepare in the nominal value column, you will write cost 118, the nominal value 120, cost 118. Okay. On 1st of March, he purchased 200 units, ex interest at 98. Means purchased on 1st of March, 200 units at 98 ex interest. So you will add interest to this separately. Sold 500 units ex interest out of original holding at 100. So 500 units of original has been sold. This will credit. You will also collect interest on this. Purchase 150 units, 98 come interest. Now here what it means is total value paid is 98. Total value paid is 98. And from this we'll remove the interest component and account for it separately. We'll account for it separately, right? Then sold 300 units ex interest at 99 out of original holdings. Okay. Interest dates are 30th September and 31st March. Mr. Z closes books on 31st December. So books are closed on 31st of December. So this opening balance is as on 1st of January. When is the interest paid? 30th of September. So in this opening balance, also, we have the interest component. Okay. And I think I missed to mention that point. If the date of payment of interest is not same as the date of year end, you also need to calculate accrued interest and credit it to the investment account, like in this case. Okay. Now here, opening balance has a cost of 118, 120. That is the opening balance. On which date? On 1st of January. Whereas interest was previously paid on 30th of September. So October, November, December, 3 months interest is accrued. It is lying as an accrued interest in the previous year. So when we open the books, when we do the opening balance, what we'll do is we'll calculate 3-month interest and post it in the interest column. Like the same way, we will have closing balance of interest, right? Now, how much is the interest? 120 into 9% into 3 by 12. So 120 into 9 into 3 by 12, if I do 120 into 9 into 3 by 12, if I do, I get 270. 270, 2700 is the interest. So what happens is When you say to balance brought down, you would say cost 1,20,000, nominal value 1,18,000, and interest column you will say 2,007 because this is the interest income of the previous period. This is the interest income of the previous period. Okay, then that is the first thing. Then on 1st of July, we sold 500, on 1st of March, purchased 200 units, X interest at 98. So 200 into 98, if I do, I paid 19,600 plus I have to pay interest. Interest for till March. So October, November, December, January, February, not March. March is we purchased on 1st. So 5 months. So 5 months, how many units? 200 units. 200 into 9% into 5 by 12 into 100. So if you do 200 into 9 into 5 divided by 12, we get 750. So apart from this, you also pay interest of 750 that you will account for it separately. So let us see. Opening balance, cost, interest, sorry, nominal value, interest, cost. Then 19,600 is we paid plus interest we calculated 750. All right. Then on 1st of July, sold 500 units X interest out of original holding of 500 at 100. Means what? We sold 500 into 100. That is the sale value. This is what? X interest. If it is X interest, we will collect interest also. So interest on this till which date? 1st of July means last interest payment date is March. So April, May, June, 3 months interest. 500 into 100 into 9 into 3 by 12 for 3 months. So 500 into 100 into 9 into 3 by 12, we get 1125. This interest amount will collect along with the sale proceeds. So when we post it, we will say by bank 500 into 100, 50,000. So our entry will be by bank, interest column 1125 and principal column 50,000. Principal column 50,000. Right now, when this transaction happened, there is a profit earned because we sold some number of debentures and there is the cost to that. The difference is profit. Now here, if you see the investment account, it would appear as if Mr. Z follows FIFO method. FIFO means what? First in, first out. So we have opening balance of 1200. Current year purchase of 200. We sold 500. When we sold this 500, we sold out of this 1200. So cost that is relevant is 118. Cost that is relevant is 118. Okay. Cost that is relevant is 118. So here by bank sale proceeds of 50,000 that we have received, right? Then we also received 1125 of interest that we have collected, right? Now we have to calculate what is the profit element on this sale. That is the first thing. One more thing, what we missed, on 31st March we'll receive interest. On 31st March we will receive interest. On which all purchases we will receive interest? We will receive interest on the opening balance and whatever we have purchased on 1st of March. So opening balance is 1200 plus this is 200. So total is 1400 into 9% into 6 by 12. So 1400 into 9% into 6 divided by 12, we get 6,300. This is the interest received on the first two transaction. That also you have to keep in mind. Whenever there is an intervening date, we'll get it, post it to interest column, and at the end of the year, the balance will be transferred to P&L. Okay, so this is done. This is done. Now, what is the profit? 1,18,000 is for 1,200. So 118 divided by 1,200. Cost is 98.33. This cost is 98.33. And at what value did we sell? We sold at 100. So what is the profit? Profit is 1.67. Profit is 1.67 per share. 1.67 into 500 if I do, I get 833. That is one way to calculate. Or the other way to calculate is, you can say cost of 500 is equal to 118,123 divided by 1200 into 500, or divided by 1,20,000 into 50,000. Whatever you do, the number will be the same. This is the profit of 833. Cost divided by 1200 into 500, 49,167, sale proceed 50, profit is 833. That profit will transfer to P&L. Sir, can we transfer all the profit at once at the end of the year? You can do that, but the problem is you may miss out. So moment there is a sale transaction, immediately post the profit transaction or loss transaction. Okay. Then on 1st of October, purchase 150 at 98 come interest. It is along with interest. It is along with interest. But the best part here is, or the confusing part here is, we purchased on 1st of October. When did we pay the last interest? We paid the last interest on 30th of September, which means there is no accrued interest. Sir, there is accrued interest of 1 day. No, sir. See, technically what happens is, if you have purchased on 1st of October, you will start getting interest from 1st of October. So last interest paid date is 30th of September. The next day, if you have purchased, you will not pay anything, or you will not consider anything towards interest. Entire 98 is your cost. Sir, what if we purchased on some other date? So let us say we purchased on 1st of November at 98. Then in that case, what would happen is 100 into 9% into 1 by 12 is the interest component. So 100 into 9% into 1 divided by 12, 0.75 is interest. So out of 98, you would say 0.75 is interest, 97.25 is the principal or the cost. Okay, that is one working you have to keep in mind. Purchase 150 units at 98 come interest, so we'll account for it. Sold 300 units x interest at 98, 99 out of original holdings, 300. So we have 1200. Out of 1200, we sold 500. Again, we sold 300. Same treatment what we did for the previous sale. Same thing we'll do. One more thing is, between 1st of July and 1st of October, there comes 30th of September, for which also we'll get interest. Now here, we'll get interest on how many shares? 1400 minus 500, only 900. So here, the interest that you have calculated, you will get only on 900 shares. Okay. Then closing balance of investment that you have to calculate, be slightly careful because this is FIFO. You are not doing weighted average. The question has specifically told FIFO, so you have to do FIFO. Now, what is the closing balance of investment? Closing value of investment, if you calculate as per the ledger, you get 75,000 as the nominal value, or 750 as the count. Out of the 750, what you have to see is 1200 minus 500 minus 300. 1200 minus 500 minus 300. 1200 minus 500 minus 300. How much is left? 400 is left. So you will take 400 from the opening balance, and this as it is as per the actual cost. So it will be the closing balance. And then you also need to calculate interest element in the closing balance of number of debentures. Now, how do we calculate that? Closing balance is 750. The last dividend paid was on 30th of September. So October, November, December, 3 months balance, 3 months interest is what you will calculate. Are we clear? See, the pattern of questions are same. Just that we have to be cool in the examination and read the information properly and calculate the working notes properly. Our working note is mandatory because, by using FIFO method, you can do it, no problem. If you can handle that, it is okay. That's not. So what happens is, this if you calculate, right, on the principal side, 1,18,000 plus 19,600, 833, this, all these numbers when you calculate, you will get to the same number. But sometimes working note carries marks for closing stock valuation. Okay. So the time you will spend to verify it mentally, just take 1 minute extra and write a working note. No? Okay, that would be helpful. Because there are marks, 1 mark also matters, right? Okay. So this requires, see, it requires careful calculation. It requires careful calculation, especially when you have multiple transactions happening. If it is a single transaction that is given or a two transaction that is given, then all of you will do good. I know I'm 100% confident on that. Okay. If nothing is mentioned, we'll follow weighted average method. If in this case the question gave FIFO method, so hence we follow the FIFO method and be very careful of cum interest, X interest, and interest dates. Okay, so just look at the ledger and see how much interest should I receive, and accordingly you will post. Right now, we'll take a 10 minutes, not 10 minutes actually. We'll get back at 11:15 and we'll start up with the next standard, accounting standard 17. Okay, so now we'll start with accounting standard 17. This is one standard again, which is more of a disclosure based standards. See, there are some standards which give us how to compute, like inventory, PP, and all of those things. They tell us what to compute, how to compute, and how to do all those calculations. This is more about how to report. So A17 on reporting, A18 is on again on disclosures and all of that, right? Now here, segment reporting, the importance is, especially when we have companies, let us say, the favorite example I give, I keep on giving ITC. ITC has multiple business verticals. They have cigarettes, they have hotels. Hotels partly now they have moved out, but still it is relevant. Then they have agricultural thing. Then they have textiles. They have FMCG. They run into multiple different businesses. Now, the purpose or the idea of this segment reporting is that whenever you have multiple business segments, the idea is the investor should know which segment is contributing how much. For example, for ITC, cigarette contributes the maximum. Cigarette contributes the maximum in terms of profit. Hotels is the business which drains out money. A lot of losses happen, because not cash flows and all, they require heavy investment. So investors should know that what are the importance of each of these segments in the business. Same way, this I gave our different product. There may be one country, there may be one company, let us say, they have operations in India, they have operations in Middle East, okay, they have operations in US. Now, if I'm too much dependent on US, some negative changes happen in US, I know the business is impacted. So the shareholders they need to have this breakup of what is the business scenario or what is the contribution of businesses from each product or from each, geography and all of those things. That is what we need, right? That is the first thing. Now, what the standard requires is the entity should identify something called as segments. There are two types of segment. One is a business segment and another one is a geographical segment. And give segment information or report segment information, segment revenue, segment expenses, segment assets, segment liabilities. Those are the things that the standard requires. Now, segment is basically, you can say, a component of business, which is important for our understanding purpose. Product, it can be product, based on product, it can be based on geography, it can be based on customers. For example, if I take Indigo Learn, if we start multiple different finance courses, so CA can be one segment, CFA can be one segment, CMA US can be one segment, something like that, right? Or if we start, let us say, science teaching, finance can be one segment, non-finance can be another segment. Or we can say, no, entire education is single segment. That is also the management call. Now, the standard tells us what is a reportable segment. So segment is basically a part of the business. Segment is basically a part or component of business. What should be reported? That is what the standard gives. Subsequently, we will see the threshold criteria for determining the segment, results. A reportable segment is a business segment or a geographical segment. So there are two types of segment. One is business segment, one is geographical segment. Identified on the basis of definitions of business or geographical segment for which segment information is required to be disclosed. So we have to first know what is a business segment, what is a geographical segment. Then we have to see what is a reportable criteria, under which criteria will we report the segment. That is what we have to see. Okay. A business segment is a distinguishable component of an enterprise that is engaged in providing an individual product or service or a group of related products or service that is subject to risk and returns that are different from other business segments. So simple definition is, if I have a product or service
or a group of product or service which has risk and returns that are different, risk and returns which are different from other business segments. So FMCG, the risk and returns are different as compared to cigarette. Cigarette has a huge regulatory risk, and these days we have this sustainable thing, SDG, environmental concerns and all of that. So this is subject to higher risk. Hotel has a different set of risk altogether. Okay, when COVID hit, hotel was the impacted the most. FMCG was not so much impacted because people will eat. So risk and returns are different for the business segment. So a component of business that is providing definition, why I'm saying is because sometimes if you get a theory question, definition becomes very, very important. Product or service or a group of related product or service that is subject to risk and returns that are different from other business segments, right? There's a definition. Now, how do we decide business segments? We decide based on the nature of products, type of customers, and all of those things. Same way, we have something called as geographical segment. This is something which is providing products or services within a particular economic environment that is subject to risk and returns that are different from operating in other economic environment. So if something is operating in India, it is subject to different risk and rewards, risk and returns that subject that if you compare with some company or some entity operating in US. So these are the two things that you have to understand, the business segment and the geographical segment. Now, how do you decide based on nature of product, type of customers, methods used to distribute? It can be online and it can be offline. Same with geographical. What are the similarity of economic and political conditions? Generally, we consider EU as one geographical segment, though there are different countries. Then we have Middle East with some kind of geography. Then special risk, exchange control regulations, some factors, 2 or 3 factors you can remember for your examination purpose. Now, the most important part is identifying the reportable segment. First, we'll come to the definition. How do we identify? Then we'll come to primary and secondary. Okay. Now, as far as segment reporting is concerned, when we talk about identifiability, these are this tests to be performed. These are the tests to be performed. What are the tests? One is the revenue test. What does the revenue test say? Any segment which has segment revenue of 10% or more of total revenue of all segments. We are not saying total enterprise revenue. Total revenue of all segments put together. So if there are A, B, and C, there are 3 segments. This is 10, this is 15, this is 20. Total of segment revenue is 45. Okay, total of segment revenue is 45. If this segment revenue is greater than or equal to 10% of this 45, we will report. There could be C. A would be selling to B, B could be selling to C. And enterprise revenue may be only 30. This is not what we will consider. We will see total revenue of all segments. So in the examination, they will give you what are the segment revenue of each of the segments. And if each segment has revenue of 10% or more, that will become reportable. Okay. Then second one is result test. This is where sometimes students make mistakes. If the result is 10% or more of higher of combined result of all segments, profit or loss in absolute terms. What does that mean? We have A, B, C, D. 10 of profit, 15 of loss, 20 of profit, 25 of loss. So what you will take? You will take profitable segment. You will say total profit of profitable segment is 30. Total profit is 30. Total loss 15 and 25, 40. So what we will do? We will take higher. We will take higher of these two and then we will report it. Okay, so that is the result test. Then asset test. Sorry, higher means you will total this up and then you will take the 10% and then you will do the presentation. Okay. Then segment assets greater than or equal to 10% of total assets of all segment. Then management can add or fit a reportable segment if they want to. Management can add or fit a reportable segment if they want to. Meaning to say, if they want to, if there is a significant segment, it doesn't meet the criteria, but they want to report, they will do it. And lastly, the 75% test. Now, what the 75% test said is, reportable segments total external revenue if it is less than 75% of total enterprise revenue. This is slightly different. This is talking about external revenue. So let us say A and B are reportable segments. A and B are reportable segments. If A and B are reportable segments, their external revenue is 10 and 20. Total enterprise revenue is 50. 20 plus 10 is 30. So 30 out of 50, if I do, I get only 60%. The standard says bring this number up 60% to 75%. Bring this number up 60% to 75%. That is what should be reported. Meaning to say, keep adding new segments. Keep adding new segments such that the total revenue, that external revenue that is reported becomes your process your 75% threshold. If it is less than 75% threshold, you have to keep on adding revenue. Now, how to add? It is management choice what they want to add. Okay, it is management choice what they want to add. Whether they want to add some small segment or higher segment or lower segment, whatever it is, but it has to cross your 75% revenue, external revenue criteria. Am I clear? Again, a quick recap. Segment revenue, 10% of total revenue of all segments. Again, revenue of all segments, not the enterprise revenue. Result test, 10% of higher of either profit or loss. So take the profit, take the loss, whichever is higher. Of that, you will calculate 10% and you will see whether it meets the result test or not. Okay, so absolute profit or absolute loss. So first you will segregate profit separately, losses separately. Then asset test, 10% or more of total asset. There is nothing called liability test. Then management choice. If the management wants, they can designate something. And finally, what you have to understand is if 75% of external revenue is not reported, that is external revenue is not reported, you will add other segments to ensure that this 75% threshold is met. Now, generally in the examination, segment revenue is given. If it is not given, and if we have to calculate what is the segment revenue, what we will do, we'll take revenue directly attributable to the segment, revenue that can be allocated on a reasonable basis, and revenue from transaction with other segments. So when we say segment revenue, I'm talking about revenue with external customers also and revenue between the segments also. Okay, that is what is segment revenue. What we will not include is extraordinary items, interest or dividend income, and gain or loss on sale of investment and extinguishment of debt, unless these two criteria where the enterprise is of primarily financial in nature. So segment revenue is revenue to the external customers and revenue with the other segments. Revenue to the external customers and revenue with the other segments. Segment expense. So when we have to report the segment information, you also need to represent segment expense. Segment expense is those expense which is directly attributable to the segment, can be reasonably attributable to the segment and relating to transaction with other segments. So if I am a segment, my expenses that I've incurred, some expenses that can be allocated to me, and the expenses that I incur while transacting with other segment that should be included. What we don't include, extraordinary items, interest expense and income tax expense. These are important from your examination point of view. You'll not include these items when it comes to segment expenses. Now, segment revenue minus segment expense, the difference is called segment result. This difference is called segment result. So we have seen what is the reportable criteria, right? 10% of revenue, 10% of profit or loss, whichever is higher, 10% of asset, management choice, 75% of external revenue criteria. So that is the thing. Segment revenue is total revenue of the segment with external customers as well as with other segments. Segment expense is total expense of the segment, including segment expense incurred with other entities. Segment result is revenue minus expenses. Then we also have sometimes to disclose about segment assets. Segment assets are those which are employed by a segment in its operating activities and are directly attributable to the segment or can be allocated on a reasonable basis. So my segment assets plus something which can be reasonably allocated to me do not include income tax asset and asset used for general enterprise or head office purposes. So income tax asset, your DTA or your current tax asset and head office assets should be excluded. See, be very careful with what is not included. What is not included? What is not included? Because sometimes you may get a question in the examination where you have to compute these things. Segment liabilities that is related to the operating activities of the segment and are directly attributable to the segment or can be allocated does not include income tax liabilities and borrowing and other liabilities which are financing in nature other than for operations. So borrowings that you have, debentures that you have, all of that is excluded unless the segment itself is having a business which is primarily of the financial in nature. Okay, so all of this you will exclude, right? So this is the calculations. Now first we'll take up a question. Tirumala has the following business and geographical segments. Examine which of the following are reported: business or geographical. You have revenue of 9,600, 300, 100, 1750 profit, 1800 profit, 70 profit. This is the asset which are reportable. Now, first revenue, you will take total of revenue. Total of revenue is 10,000. 10% of revenue is 1,000. So greater than 1,000 is this. So this becomes reportable under revenue test. Then profit. Total of profit is 2,000. 10% is 200. What is more than 200? This is more than 200. So this becomes reportable. Then net assets. 5,500 is the 10%. So this becomes reportable. So only A is reportable in the three criteria. Now here they have not given external revenue, but if external revenue is of A is, let us say 7,000, sorry, let us say it is 6,500. Total revenue of the entire business is, let us say 10,000, just for example. So this is only 65%. We have to make it 75%. We have to make it 75%, and accordingly you will add more, segments. This is just for example purpose. It does not fit in this particular calculation. This one, there are 6 segments: M, N, O, P, Q, R. Asset 40, 10, 80, 30, 20, 20, 10, 200. 10% is 20. 50, 190, 10, 10, 10, 30, minus 100. Now this what you have to do is 50 separately, 190 separately, profit separately, losses separately, profit separately. 190 plus 10, 200. 50, 60, 70 plus 30, 100. Higher, 200. Higher, 200. 10% of this is 20. So 20 means we'll see which all becomes reportable. Then revenue is 1,200. 10% is 120. So here we take 120. Now which are reportable? Anything 20 or more is reportable under asset. So what this is reportable, this is reportable, this is reportable, this is reportable, this is reportable. So almost everything is reportable under the asset criteria itself. Under the revenue criteria, again it is higher 20. This is reportable, and this is reportable. Under the revenue criteria, 120, this is reportable, this is reportable. So all the segments are reportable in this particular case. So profit separately, losses separately, you will take the higher, and all are reportable as per what we have done. Is it clear? Now, in this case, whenever there is information about deferred tax asset is given, then what we have to do? We have to exclude deferred tax liability asset to calculate the segment assets. Okay. Now coming back. When we talk about reportable segments, one more classification that is required is which is primary and which is secondary. Sometimes what happens is you have business segment also, geographical segment also. Same entity may have business as well as geographical segment. Now, when you have both the segments, which is business as well as geographical segment, which is more relevant? Which is more relevant? Or how do we present? Do we say it is business or do we say it is geographical? Then what do? We have to identify which is
primary segment and which is the secondary reportable segment, which is the primary reportable segment and which is the secondary reportable segment. Okay. Now, the way to classify, the way to decide is if the risk and returns are predominantly affected by the differences in product and services. So you have to ask yourself, which is affecting my risk and rewards? Is it the product, services, or is it the geography? If it is the product that is affecting, we will say primary segment is the business segment and secondary segment is the geographical segment. Then, if it is not because of product and service, then primarily it will be a geographical segment, secondary it will become a business segment. So, you will have to see this, and also you will have to figure out by looking at the internal organization structure, management, and all of those things, how they are managing, how the reporting is happening. Based on that, you can decide. But if dominantly the risk and rewards are coming from dominant risk and rewards are from your products and services, then we say it is a primary is a business segment and secondary is a geographical segment. Otherwise, we'll say primary geographical, secondary is business segment. Okay, so that is how the classification. This is required for disclosure purposes. This is required for disclosure purposes and nothing else. So for as far as disclosures are concerned, if at all when you have to disclose, if business is primary, some other information is required. If geographical is primary, some other information is required. Important thing, interest expense should not be included unless the operations of the segment are primary financial of nature or interest is included as a part of the cost of inventory. So typically interest is excluded. Now, the reporting format or the disclosure format, we have two primary and secondary segment reporting format. So what is primary? For primary, you have to give some information. For secondary, you have to give some information. I would not suggest you to waste a lot of time here, but I'll quickly explain to you how it works. Okay. As far as primary reporting format is concerned, means the base format, you have to report whichever is primary segment, either a business segment or a geographical segment. What is the segment revenue? Classified into segment revenue from sales to external customers and segment revenue from transaction with other segments. So you will report segment revenue. You will give the breakup. How much is the external revenue? How much is the segment revenue? Segment revenue means revenue with other segments. Then what is the segment result? This is segment revenue minus segment expenses. What is the carrying amount of segment assets? Carrying amount of segment liabilities? Cost incurred during the period to acquire segment assets that are expected to be used during more than one period. So any new assets additions. Amount of expense included in segment result for depreciation and amortization in respect of segment asset. What is the depreciation component? Total amount of significant non-cash expense other than depreciation and amortization in respect of segment assets that were included in the segment expenses and therefore deducted in measuring the segment result. So, other than depreciation and amortization, what are the significant non-cash expenses that you have incurred? That also you have to mention. If business is primary, you'll give the information for business. If geographical is primary, you will give geographical primary. Geography can be based on location or customers, either ways. Okay. Remember these things. Then secondary information. Now, what is the meaning of secondary information? If my primary is business, I have to give more information on geography. If my geography is primary, means the geographical segment is primary, then I have to give some information on business. If primary format is business segment, the following information should be given as secondary information. So, primary format is business. So, product related revenue, product related expenses I've already given. Now, give the information for geography. Now, how will I give? Segment revenue from external customers by geographical area based on the geographical location of its customer. For each geographical segment where revenue from sales to external customer is 10% or more of enterprise revenue. What it means is you have disclosed product information. Give me information of sales to external customer which accounts for 10% or more of total revenue. So take the total enterprise revenue, calculate 10% of that, give revenue by geographical area. Give revenue by geographical area based on the location of customer for each geographical segment where revenue from sales to the external customer is 10% or more. So basically,
identify geographical locations where our sale is 10% of the more of total revenue. Where our sale is 10% or more of total revenue. Total carrying amount of segment asset by geographical location for each segment whose segment assets are 10% of more of the total asset of all the geographical segment. Here it is revenue, enterprise, total geographical segment, 10% of asset reported, and total cost incurred during the period to acquire segment asset that are expected to be used for more than one period by geographical location of asset for geographical segment whose segment assets are 10% or more of all segment assets. So basically, two things you have to report in secondary. One, revenue. Revenue from sale to external customers by geographical location, considering 10% or more of external revenue. Then, whichever geographical location has assets, which is 10% or more of the total geographical, segmental assets, that asset will show. Here we are reporting assets. Here we are reporting additions to the assets. Here we are reporting revenue considering 10%. Okay. If primary format is geographical segment, then we should give following segment information for each business segment where revenue from sales to external customer is 10% or more of the enterprise revenue, or segment assets are 10% of more of the total asset of all business segments. Similar information should be given if primary geographical, give it for secondary. What do we give? Sir, revenue 10% or more from external customers based on total enterprise revenue. So if you see, revenue is based on total enterprise revenue, asset is based on total asset. Asset is based on total asset. First, segment revenue from external customers. Again, 10% or more for each segment. Total carrying amount of segment assets. Total cost incurred during the period to acquire segment assets. Same thing, right? Then, if primary format of enterprise for reporting segment information is geographical segment that are based on the location of asset, and if the location of its customer is different from the location of asset. Now, what is this? It can get complicated. Here we said primary format is business, give secondary geographical. Here we said primary format is geographical, give additional information for business. Now what we're saying is primary format is geographical based on asset and customers are located differently, then report revenue from sales to external customers for each customer based geographical segment whose revenue from sales to external customer is 10% or more. So meaning to say, geographically, what I have done, I have given based on location of asset. Then I will give business segment information considering 10% threshold. Also give customer location based 10% or more revenue details. Same way, if the primary format for the enterprise is geographical segment based on location of customer, then give assets by geographical location of asset and total addition to the asset. What does this basically mean? If my primary is geographical and I have given information by location of assets, means this geographical is based on asset, then give revenue details based on customer geographical segment. And if I have given customer geographical segment as my primary information, give asset based details based on location of assets. Right? So the last part is sometimes tricky. Read it 2 to 3 times, revise it 2 to 3 times. That will actually help you. Then what should we disclose? We should disclose segment revenue, result, asset, liabilities, capital expenses, depreciation, other non-cash expenses, what you have seen. Secondary segment disclosures. If geographical segments are secondary, then give revenue from external customers by geographical location, assets. If business segments are secondary, give these 3 details. This, revise it thoroughly. Okay. So that brings us to the conclusion of A17. Okay. Very simple standard. If a question comes on identification of segment, to be reported and all of us will do absolutely well. I don't have any, question or doubt there. When it comes to disclosure, that is where I feel it sometimes becomes slightly more, tricky and complicated. That is where we have to be extra careful. All right. Any questions?
Now, this is one thing. I mean, I don't know whether they'll give it in the examination, but at least for us to understand how it is presented, we'll just have a look at it. Prepare a segmental report for publication in Diversifiers Limited from the following details of the company's three divisions: forging shop divisions, sale to Brights Bar divisions, other domestic sales, export sales. So this is the breakup. Forging shop division breakup is given. Bright Bar division, this is what is given. Fitting division, this is what is given. Now, these sales to Bright Bar division, bright sales to fitting division, these are your inter-segment sales. Export sales, other domestic sales, export sales. These are your external revenue. Pre-tax operating result has been given. Head office cost reallocated is given. Interest cost is given. Right. Then your fixed asset, net current assets, long-term liabilities, all of that is given. Now we have to prepare a segment report. Right. Now when it comes to segment report, what happens is these are the three segments. These are the three segments that we are reporting. And to arrive at the total number for the final balance sheet or final P&L expenses, what we will do, we will eliminate the inter-segment revenues. Okay. Now, as far as the forging shop is concerned, forging shop has your Bright Bar segment sales, other domestic sales, and export sales. So what we will do, sales, external sales, your 90,6135, total is 6225. So what is the external sales that we have written? What is the external sales that we have given? Then what is the inter-segment sales we have given? 4575 and 40. For this, 45 for this. So external sales and inter-segment sales. Now this inter-segment sales total of 4620 will be eliminated when we have to calculate the total enterprise revenue, because you have to give a reconciliation, right? So we'll do inter-segment elimination of 4620. This will not come in the total column outside. Total will show export and external sales. That's the first step. Then segment result, pre-tax operating result 240, 30, 12 is already given. So that will present as it is, segment result. Then head office cost we allocated. See, this is head office cost. So it has to come in the external column, will not allocate it to the individual segment. So that will be considered in the external column only. We'll get the final operating profit. Then interest cost again will not form part of the segment cost. We all know that it does not form part of segment cost. So it will form part of the total enterprise level cost, which is 16. And then finally we get the 98 as profit before taxation. Right. Then we have to give the assets breakup. Fixed asset, net current assets is given. Sorry, this is head office. Forging shop division 300, 180, 30. 300, 180 and segment liabilities. Same way, these two segment liabilities, this and segment liabilities. Then we have the 75 plus 72 unallocated cost or unallocated corporate asset will show in the outer column. Liabilities also will show in the outer column. This is what we will do. Right? Then we also need to give. See, here we give business-wise segment information. So we also need to give the geographical sales by geographical market. So when it comes to sales by geographical market, how and what we will give? Only the external sales. So 90 is domestic sales, export sales 6135, 300 and 270 the total sales. Now you may say, sir, it is not more than 10%. Can we exclude it? You can exclude that also, because more than 10%, less than 10% is not required. Out of total revenue, you only need to consider 10% or more. So you may just give the export sales total. Exports again, if Rwanda and Maldives are significant geographical location, you may only say export sales of forging division. That information itself is sufficient. Revise it once before the examination, and very good testing ability for MCQs. Okay, so this 12 also you can do it once on your own. Not very significant from examination point of view. They may not give you full-fledged question, but just have a look at it once before the examination. All right. Okay, so we conclude here today's session. We completed AS 13 and AS 17. Tomorrow we'll continue with AS 15 and AS 18. Tomorrow we'll have class at 10:30 till 12:30. Okay. I'm at a different location, so timing has become slightly odd. So 10:30 till 12:30. I'll put the message in the group also. Okay. Thanks a lot. All right. So now moving on to the next standard today that we'll be taking up, which is Accounting Standard 18 on related party disclosure. Now, this is a disclosure. This is a disclosure-based standard where we have to remember the definitions of who is a related party. If you know who is a related party and what are not related party transactions, rest of the standard there is nothing, to be frank. Okay. So when it comes to related party, right? These are specific relationship which have been defined in the standard, and you need to remember this. There is no other way. Okay. If it comes for an MCQ, we can definitely, figure out based on our understanding. But if it comes for a written, descriptive question, we need to know the definition, right? Now, when we say related party, basically, we are talking about one reporting entity or reporting enterprise. This is the entity which is preparing financial statements, and we are trying to figure out who are related to this particular related party, who are particularly related to this particular entity. Okay. Now, what AS18 says is parties are related if at any time during the reporting period, this is very important, which means if I'm looking at a reporting period of 1st of April till 31st of March, anytime during the period, if there is a reporting, if there is a relationship between these two, we consider them to be related party. Even if the relationship has ended, for example, at this point, let us say the holding subsidiary relationship has ended. Even if the holding subsidiary relationship has ended, because there was a relationship in this period, we call them to be related parties. We call them to be related parties. Okay. Now, who are related parties as per Accounting Standard 18? See, this is minimum disclosure. If the entity wants, they can disclose more, they can disclose as per listing agreement, all of that is fine. These are but minimum requirement. Enterprises that directly or indirectly through one or more intermediaries control or are controlled by or are under common control with the reporting enterprise. This basically covers if you have a holding company and if you have a subsidiary company. Let us call it H, let us call it S. Enterprise that are directly, so H controls S directly. H controls S directly. There is related party relationship. There is a related, these are related parties. Okay. If H is controlling S, not only H is related to S, means when H is preparing financial statement, H should say S is my related party. And when S is preparing financial statement, they would say H is my related party. You can think of it as a parent and child relationship. So parent is related to child, child is also related back to the parent. Okay, that is one. Second is, let us say you have parent, you have grandparents, and then you have child. Now, grandparent controls the parent. I'm not talking about real life scenarios. Okay, I'm just giving you for your understanding purpose. Grandparent control parents. So there is a related party relationship. Grandparents are related to the parents. Parents are related to the grandparents. Similarly, parent is related to child and child is related to parent. Now, because the grandparent control the parent and this parent ultimately control the child, grandparent has indirect control over the child. Now, this for our under technical terms, this is holding company, this is subsidiary company, this is called sub-subsidiary company. This is also understood as chain holding. So, grandparent controls parent, parent controls child. So, grandparent is related to parent, grandparent is also related to child. Child is related to parent, child is also related to grandparent. So, holding is related to subsidiary, holding is also related to sub-subsidiary. Okay. Same way sub-subsidiary is also related to holding. Okay. Then, if there is a parent and the parent has two children, children 1, children 2, these two are also considered to be related. So, first definition covers parent subsidiary or holding subsidiary, holding sub-subsidiary, and co-subsidiaries or subsidiaries who are commonly controlled by one separate entity. So parent is related to this child, parent is related to this child. These subsidiaries which are controlled by a single parent or single holding company, which we call to be a fellow subsidiary, these are also called related party. That is the first thing. Second, so first covers what? Holding subsidiary relationship. Second,
associates and joint venture of the reporting enterprise. Associates and joint venture of the reporting enterprise. If my reporting enterprise is Reliance Industries Limited, any joint venture of Reliance Industries and any associate of Reliance Industries are related party. Okay. Then the investing party or venturer in respect of which the reporting enterprise is an associate or a joint venture. So associate and joint venture, that is the first set, associate joint venture, and the investing party. Who is the investing party? Reliance Industries, or venturer. Reliance Industries is a venturer when there is a joint venture. Okay. Of which the reporting enterprise is an associate or joint venture. So to simplify this, we can say any associate or joint venture of the reporting enterprise is related party. These are called related party. Okay. Then these two talk about entities, means holding subsidiary, subsidiary holding sub-subsidiary, then fellow subsidiaries. These are holding subsidiary relationship as per first. Now, when you talk about subsidiary, we have to evaluate the control dimension. Then associates and joint venture of the reporting enterprise, associates or joint venture of the reporting enterprise, and investing party or venturer in respect of which the reporting enterprise is an associate or joint venture. So JVs are also related party. Associates are also related party. Any doubt so far? Okay. Now, if JV is associated to this RIL, if JV is related to RIL, RIL is also related to JV. So it is two-way relationship. You cannot just say that for Reliance Industry only this JV is related. For JV, the investing party is also related. Okay. Third, here we talk about individuals. Individuals owning directly or indirectly an interest in the voting power of the reporting enterprise that gives them control or significant influence over the enterprise and relatives of any such individual. Now, this is slightly of wider scope. What it says is, just understand, let us say Suraj has, for example, 51% stake in Indigoland. So Suraj is a related party as far as when Indigoland prepares the financial statement, Suraj becomes related party. Okay. Or if Suraj holds 25% in, let us say, OneFin, another entity, then also Suraj is a related party for OneFin. So when OneFin prepares financial statement, they would say Suraj is related party. So first is who directly and indirectly have an interest which gives them control or significant influence over the enterprise. Meaning to say, if I have controlling interest or if I have significant influence. Directly or indirectly means it can be through me, maybe me and my wife put together, we have control, then also I am a related party. That's the first thing. And any relatives of such individual. So if I am a related party, my relatives are also considered to be related party. Then key management personnel and relatives of such personnel. Now, key management personnel basically means someone who is in a key position in the enterprise, directors, your chief financial officers, okay, the one who have the ability to direct the financing and operating policy decisions of the entity. Those are key managerial personnel. Then, so here it is, I gave example Suraj and relatives. Key management personnel, let's say I am the director of Indigoland, so I also become a related party. And with relation to C and D, if there are enterprises over which C or D is able to exercise significant influence. So meaning to say, Suraj is a director in Indigoland. Suraj has significant influence in OneFin. Suraj has significant influence in OneFin. Now, Suraj is related to IL because I'm a director. I have a significant influence over OneFin, so also I'm related. But what they're saying is, any enterprise over which any person described in C or D. So Suraj has significant influence over another enterprise. So for now, for IL, Suraj is related. For OneFin also, Suraj is related because there is directorship, KMP, and there is significant influence. Now, one more thing that what they're saying is, these two parties are also related parties because there is one common person who is a KMP and has significant influence, or who has control and has significant influence. Again, repeating, Individuals having directly or indirectly an interest in the voting power of the reporting enterprise that gives them control or significant influence. So if I have control, I am related to Indigo Learn. I have control in one entity, I have control in another entity. So we have Suraj here. Suraj controls OneFin. Suraj also controls Indigo Learn. So Suraj is related to OneFin and Indigo Learn. So when OneFin prepares, Suraj is a related party. When Indigo Learn prepares, Suraj is a related party. But because I have control here and I also control the other enterprise, these two are also related party. These two are also related party. Okay. So if there are any enterprises over which any person in C or D is able to exercise significant influence, means 20% and above, if there is any influence, then they become related parties. Okay. So if there are any enterprise owned by directors or major shareholders of the reporting enterprise, an enterprise that have a member of KMP in common with the reporting enterprise. So few more examples. Suraj is director here in Indigo Learn. Suraj is also director in OneFin. So for IL, I am a significant, I am a related party. For OneFin also, I am a related party. Now, are these two related? If I am able to control or have significant influence over both these entities, then I am related. Then these two entities are related. Okay. So that is what is covered by 5. A quick recap. Holding subsidiary, associate and joint venture of the reporting enterprise are related, and when associate and joint ventures are preparing their financial statement, the investing party or the venturer is also related party. Then if one person has control or significant influence and their relatives, if there is a key management personnel and their relatives, then lastly, if there are common enterprises over which anyone from C or D, that is, if I have control and if I have significant influence in another enterprise, both those enterprises are also related. All right. Now, this also is important. Who are not deemed to be related parties? This is the exclusive, the list for exclusions. Who are not deemed to be related parties? Two companies are not related parties simply because they have a director in common. So I gave you an example. Common directors, these two will be related when the director is able to affect the policies of both the companies in their mutual dealings. Only in that case, we say both these entities are related. Okay. So, but if you have control here, Suraj is a director, Suraj also has control here, and Suraj has significant influence here, then these two entities are related. If the common director is able to influence the policies of both the companies in their mutual dealings, they are related parties. So that is one thing you have to keep in mind. Single customer, supplier, franchisor, distributor, or general agent with whom the enterprise transacts a significant volume. So, if I have significant transactions with one enterprise, let us say I have 85% of my sales to one entity, just because of my transactions, they are not related parties. Now, here in this case, a lot of students made a mistake in the previous attempt, September attempt, thinking that if one entity, let us say H and S, H has 51% control over S. Now here, you don't need to apply this exception. Just because there is a control relationship, we know that these are related parties. A lot of students, what they did was, they said because it is a single customer supplier which has a significant volume of business, they said the parties are not related. That is not applicable. What you need to understand is if there is holding and if there is subsidiary, there is a relationship, they are related parties. The transactions, what this means is if there is no control, if there is no significant influence, okay, if there are no associates, no joint venture, but there is, let us say, 90% business with one party. Just because of this business, these two parties will not become related parties. Okay, is this point clear? Absolutely. The second exception point. Then the following parties in the course of their normal dealings with an enterprise by virtue only of those dealings. So just because they are dealing with these parties, they are not related. Providers of finance, like I have one bank which gives me loan. That doesn't mean the bank is a related party to me. All right. Same way, trade unions. Now, trade unions have a lot of control. We have seen how they can stop operations, how they can say that, you pay us so much of salary and all of those things. Just because of that, these two parties do not become related parties, right? Then public utilities, electricity department, water board, and all of that. Government departments, government agencies, including government sponsored bodies, these are also not the related parties, right? So in this entire standard, what we need to understand is what is the definition of a related party? Okay, what is the definition of a related party? First thing, who are not related parties? We saw three situations, right? Now, after this is done, after you have remembered all of those things, the rest part of the standard only talks about disclosures. Okay, only talks about disclosures. Now, there are certain exemptions for disclosures. One, if it is in conflict with the reporting enterprise duties of confidentiality. For example, one entity is related to another entity, they manufacture defense equipments. Just for example, okay, I'm not saying that is the case, it has to be. The other party manufactures defense equipments. Now, it is a matter of, let us say, national interest that you should not disclose whom we are dealing with and all of that. In that case, we can say, okay, we will not disclose. Okay. Or, so if you're providing something to, let us say, you're a related party and you're providing something to a government entity or a government sponsored entity, but the government does not want this fact to be disclosed outside, right? In that case, it need not be disclosed. Then in the consolidated financial statement, here the exception is, let us say we are holding a subsidiary. In standalone financial statement of holding company will disclose transaction with subsidiary. Subsidiary will disclose transaction with holding. But when you're preparing the consolidated financial statement, they're looking at HNS as a group. So there you don't need to separately disclose. It is assumed that we are looking at HNS as a single entity. So no intra-group transaction are to be reported. Okay. For example, H has sold goods to S. H will say related party transactions, sales, so much. S will say related party purchases, so much. But in the consolidated financial statement, because you eliminate those transactions, those are not disclosed separately. And lastly, state controlled enterprise. Now, state controlled enterprise means, let us say we have Government of India. Okay. Government of India, we have BPCL and we have HPCL. Government of India controls BPCL, they control HPCL. This does not mean both of these are related party for disclosure purpose. Otherwise, government owns thousands of companies. Government controls thousands of companies. So for this, there is an exemption. All right. Now, what is to be disclosed? As far as the standard is concerned, we need to disclose related party relationship and transaction in different categories. Okay, that will come to it. And what is a related party transaction? A transaction between the two related parties which involves transfer of resources regardless of whether or not price is charged. So sometimes in the examination, they'll give questions like a holding and subsidiary transactions happened at arm's length price. Transactions happened at arm's length price. That does not mean that we need to not disclose. If transactions it did not happen at arm's length price, we need to disclose. There is nothing like that. Any transaction has to be reported. If the holding does not charge something from the subsidiary, we don't need to report it. No, that is also not how it works. We have to disclose all the transactions. Any government, I gave an example of Indian government for understanding. So here, when they say state control enterprise, this can be central government or state government or your municipal authorities, anything. Then control, when we say control, either you need to have more than 50% of voting power, that is one, or control of the composition of the board of directors in case of company or any other governing body in case of other enterprise. For example, if it is a trust, of course, trust is, you generally don't have that way, but let's say there is a trust. If you control board of trustees, that could be possible. Or there is some other, a firm where you can control by way of, partnership stake, something like that. So ownership directly or indirectly of more than one half, that is 50% of voting power. Control of composition of board of directors, this is what is relevant for exam. And lastly, substantial interest in voting power and the power to direct by agreement or statute the financial and operating policy decisions of the enterprise. So control is received by, or you have control when you have ownership of more than 50% or more than one half of the voting power. Second, you control the composition of the board of directors. Third, you have a substantial interest in voting power and the power to direct either by statute, means law, or by agreement, the financial or operating policies of the enterprise. So if I have significant influence, let us say 25%, and I can direct. Now, sir, why is it important? If it is 25%, anyways, it is related party. I know. But for control, there is a separate disclosure required. For control, there is a separate disclosure required. So if it is significant influence plus power to direct the financial and operating policy decisions, then also there is a control. So this will fall under control category. For substantial interest, we have also understood that 20% or more interest is required when we learned about associate. Associate we have already discussed earlier. Then key management personnel. Who is a key management personnel? These are the ones who have the authority and responsibility for planning, directing, and controlling the activities of the reporting enterprise. So they'll plan, they will direct, they have the authority, they have the responsibility, they do all of those planning activities, directing, how much to invest, where to invest, how to expand, all of that. Typically, you will see in the nature of board of directors, chief executive officers, CFOs, and all of those who are considered to be key managerial personnel. So you'll have maybe managing director, whole-time director, manager, and any person in accordance with whose directions the board of directors of the company is accustomed to act. Okay, so these are one. Then a non-executive director of a company is not considered as key managerial personnel under the standard, because when you say non-executive director, they don't have the power to direct and all the finance, operations, and all of them. These are independent directors. They are not involved in day-to-day operations. So non-executive directors are not considered to be your key management personnel. They're not considered to be key management personnel. And because they are not key management personnel, they will not be considered to be related parties. But if they have authority to plan, direct, and control the activities of the enterprise, then they are KMP. But in that case, they would not be independent directors. See, non-executive means they are not involved in execution. They are not related to day-to-day operations or strategies of the enterprise. Then relative, remember this definition, spouse. So if you look at an individual, spouse, then son, daughter. So individual and spouse, you have kids, you can say. Brother, sister, individuals, brother, sister, siblings. Father and mother. So father and mother. Now this is another part of definition, which is who may be expected to influence or be influenced by that individual in his or dealing with the reporting interface. Now I have a 5-year-old daughter. Do you think, not 5, 9 year now? Do you think that 9-year-old daughter will be able to influence my decision with the dealings of my company? No, right? So though she is a relative, for age 18, you will not say that my daughter is a related party. Okay. So you have very much understand that who may be expected to influence or be influenced by that individual. So if at all that influence is there, one is the relationship, second is the influence, only then those are relatives. Joint venture, joint control, we have already seen, when we learned the accounting for joint venture. Holding subsidiary we have seen, fellow subsidiary also we have seen. Okay. So one quick recap. Related parties, holding subsidiary by virtue of control, direct control, indirect control, and fellow subsidiaries. Associate and joint venture of the reporting enterprise, and for associate and joint venture, the investing party or the venturer. Then individuals who directly or indirectly hold voting power that gives them control or significant influence, and relatives of those individual. Key management personnel and their relatives. An enterprise who come from over which, so any other enterprise over which C or D is able to exercise significant influence. All right. Now let us see the one more thing. Let us say holding subsidiary 60%, holding and subsidiary 60%. This has 10% in A. H has, let us say, 12% in A. Are these related parties? So what you have to see is H controls S. So because H controls S, so here H and S are related. Because H controls S through the 60%, S to A 10% is also indirectly controlled. So H, we would say H has direct control of 12% and indirect control of indirect voting power of 10% over A. So 12% plus 10% is equal to 22%. That is what is the significant influence. Identify the related parties in the following case as per AS 18. A holds 51% of B. So in examination, one good way to do to not to get confused is draw a diagram. A holds and you put holding subsidiary upper niche so that it is easy for you to understand. A holds 51% of B. So for A, B is what? B is a subsidiary. B is a subsidiary. A is the holding. Okay. Then B holds 51% of O. You come down one step more. B holds 51% of O. So when B holds, this becomes subsidiary. Grandfather, father, children, or grandparents, parents, children. Z holds 49% of O. So there is one more entity called Z. Z holds how much? 49% of O. Okay. That's it. That's what they're doing. Now, identify the related party. As far as A is concerned, A directly subsidiary B, another subsidiary O. So B is the related party, O is the related party. Then for B, B for B, B to O, related party, B to A, related party. So holding company, subsidiary company. As far as O is concerned, O is related to B because B is the holding company. O is related to A because it is the ultimate holding company. And for Z, Z has 49% in O. So for Z, O is an associate. So for Z, O is related. And because Z is the investing party, O says Z, for O, Z is also related. So for O, B is related, A is related, Z is related. B is related, A is related, Z is related. And for Z, O is related. Is this example clear in terms of how to identify? Just draw this, chart. It will make your thought process very clear in the examination. Okay. Any confusion why O is related to Z and Z? See, Z has invested 49% in O. So O is the associate of Z. That is related. Z is for Z, O is related. But for O also Z is related because Z is my investing party. Okay. A has 60% in B. A also has 22% in C. In C, you have 22%. B has 30% in C. B has 30% in C. Now, for A, B is related because 60%. A and C, we have to check the relationship because A controls directly 22% and indirectly 30%, 52%. So A and C are also related because of the holding subsidiary relationship. Because of the holding subsidiary relationship, and B and C anyways are related. Okay. X Limited holds 20% in Y. So because X holds 28%, X is related to Y and Y is related to X. Same way, Y holds 32 in Z. Y is related to Z, Z is related to Y. Now, is X and Z related party? No, because there is no control. There is no control. Given the organizational structure below, P Limited, Q Limited, R, S, X and Y, identify related party relationship if R Limited is the reporting enterprise from point of view of whose R. Now, P has Q. So, P is holding. So, what you do? You can say holding of P. Q is subsidiary of P. Then Q holds 60% in R. So if Q holds 60% in R, Q is parent of R and R is subsidiary of Q. Okay. Now, because this is a chain holding, P also becomes a related party to R. R has 65% in X. This is subsidiary of R. This is parent of X. So here also it is parent of S, subsidiary of P, parent of Y, subsidiary of Q. Here it is subsidiary of S. And these are co-subsidiaries. Now, we are required to identify R Limited's related parties. Now, as far as R is concerned, immediate holding company, related party. Immediate subsidiary company, related party. Ultimate holding company, also related party. Then fellow subsidiaries who are under the same control, they are also related parties. Okay, so for P, for R, P is related, first entity. Q is also related because ultimate holding. S is related because of fellow subsidiary. X is related because it is a subsidiary. And lastly, Y is related. Now, Y related? Because both of these X and Y, they are under the common control of Q or common control of P. So we have seen, right? If there is a common control, they can also be called to. So X is common, Y is common. So X is controlled by Q, Y is controlled by Q, R is also controlled by Q. So X and Y are also related one way. R is controlled by Q. Y is also controlled by Q. So these are also, you can say these are fellow subsidiaries. So Y is related to R as well. Okay, so if you do these kind of revisions a couple of times, it will be very clear for you when it comes to examination. See, this is one standard where it is either 5 or 0. That kind of scoring you will have. Consider the following organizational structure related to UH Limited, ultimate parent. Investment in two of the wholly owned subsidiaries, subsidiary 1 and 2. Investment in JC1, which is joint control, and this is associate. Given the above structure, identify related party relationship for each of the above entities. So for UH, it is very clear. Subsidiary 1 to JC1, AS1, very clear. For subsidiary 1, UH Limited is related party. These two are also related parties because they are fellow subsidiaries. Okay, so UH Limited, all 4 entities. Subsidiary 1, for subsidiary 1, this is related, UH is related. Only 2 of the entities. Same with subsidiary 2, only 2 of the entities are related. Then joint JC1, for JC1, UH Limited is related. For associate 1, UH Limited is related. Okay. Consider a scenario wherein Mr. Robert holds 70% shares in P Limited and she is the spouse. See, if someone controls an entity P Limited and this person has a spouse who is, we'll assume that. So normally what happens is we assume that they are expected to exercise significant influence, okay, especially in the question, unless it is mentioned. So the spouse will influence Robert. So these two are P Limited. For P, Mrs. Andy is also spouse of Mr. Robert is also related party. Mr. Robert is managing director of P Limited. So Robert is related. Andy received a remuneration of 5 lakhs from P Limited for services rendered to P Limited for the period April through June. Andy left services on July. Consider March 31st as year end. Now, anytime during the year, if there is any transaction, that has to be reported. Okay, even if the person has left the entity and the salary is no longer being paid, for the period for which the salary has been paid, you need to report. So for this period, the transactions has to be reported. Okay, now coming to what are the disclosure requirements under accounting standard 18. What are the disclosure requirements? First, name of the related party and nature of relationship where control exists should be disclosed. So first thing, keep in mind control. Now your control means more than 50% controlling the board of directors. Then the third category, significant influence plus power to influence the operating financing decision of the entity. This category also comes under control. So these 3 categories, if there is any related party where control exists, where the relationship of control exists, whether or not there has been transaction, you have to disclose the name and the nature of relationship. Then apart from this, if there have been any transactions between related parties during the existence of a related party relationship, we should disclose name, relationship, nature of transaction, volume of transaction, either in terms of money or value, any other element which may be necessary, amounts of outstanding items pertaining to related parties at the balance sheet date, and provision for doubtful debt. This is very important. So if there is a sale transaction, you will say what is the nature of transaction, what is the nature of who is the party, what is the nature of relationship, what is the transaction, sale transaction, what is the value of sale, what is the amount outstanding, and if there is any back date, and if there are any amounts written off or written back in respect of amount due from related parties. Now this is required for all transactions. Control disclosure is required whether or not there are any transactions. Okay. Items of similar nature may be disclosed in aggregate by type of related party, except where separate disclosure is necessary for understanding of the related party relationship in the financial statement. So sometimes what happens is they can aggregate all the values together, but if the entity believes that separate disclosure is needed for understanding, they have to give a separate disclosure. Okay, very important. Remuneration paid to KMP is a related party transaction, but for non-executive directors, they are not related parties. Remuneration should not be considered as a related party transaction. Some examples given. This is more for our understanding: purchases of goods, sale of goods, fixed asset, rendering of services, agency, leasing, transfer of rights, finance guarantees, management controls, all of those things. Okay, let's look at this question. P Limited hold 22% shares and voting rights in Q Limited, and hence Q Limited is an associate. So P is related to Q, Q is related to P. On 1st April, P Limited sold certain goods to Q Limited amounting to 5 lakh. 1st April. On 30th June, P Limited sold its entire stake in Q Limited, hence the related party ceased to exist. P Limited continued to supply goods to Q Limited subsequent to 30th of June and sold goods worth 15 lakhs during the 9-month period. Now, as far as we are concerned, what is the value of transaction in the period where related party relationship had existed? So when the related party relationship existed, what was the value of transaction? The value of transaction is 5 lakhs. So this 5 lakhs has to be disclosed. This 15 lakhs is a normal transaction that need not be disclosed. Determine whether transaction for the entire year is to be disclosed, not the entire period. Only 5 lakhs has to be disclosed. Narmada Limited sold goods of 90 lakhs to Ganga Limited during the financial year ended 31st March. The managing director of Narmada Limited owns 100% of shares of Ganga Limited. So, Narmada Limited, Ganga Limited. Narmada Limited has who? He has a managing director, holds 100%. This managing director is KMP, point number D. And this KMP has significant influence. 100% means more than 20%, right? So this party, Ganga and Narmada, are related because the KMP has significant influence. The sales were made at normal selling price by Narmada Limited, and the chief accountant contends that these sales need not require a different treatment from other sales, and hence no disclosure is necessary. See, sales made at normal price, abnormal price, whatever is the price, disclosure is required. Disclosure is required. Now, in this type of question, is the chief accountant correct? That is the final question. So your answer should be contention of the chief accountant is wrong or is not correct. This itself will have 1 mark. If you don't write this, if you just say that they have to disclose, you will not get full marks. Requirement is what? Is the accountant contention correct? Answer should be yes, it is correct, or no, it is not correct. Okay, so we have covered all varieties of questions as required, and you need to learn those 5 parts and the exceptions that we have seen. That is it about accounting standard 18. Any question or any tricky point you feel in this standard, let me know. Okay, so we'll take a break. We'll assemble back at 11:25 and we will continue with the next standard. Okay. Now, when it comes to accounting standard 15, this deals with employee benefits, and I understand a lot of us, we face challenges in understanding this standard for the first time. Whenever you're doing it for the first time, you still feel, what is it being told and how do we need to comprehend and how do we need to understand. I'll give a base framework so that you don't hate this standard. It is actually a very logical standard, very, very logical standard. I'll give you a framework. With that framework, you'll be able to understand the key concepts, and then we'll get into what are the various items that we need to consider whenever we are looking at a employee benefit question or accounting standard 15 related question. Okay. Now, whenever we say AS 15, there is an employer and there is an employee. Employee provides certain services to the employer. Employer pays something called as, we generally call it remuneration, or you can call it benefits in common terms, right? Now, whenever the employer provides service, payment to the employees, and you would have learned this as a part of taxation as well, that in the salary breakup, you have basic pay, you have HRA, you have some allowances, right? These are a part of your monthly payment. Then you have bonus. Apart from this, you have also learned about something called as gratuity payment, then leave benefits, not leave travel allowance. Leave benefits is basically leave encashment, right? Then you would have also heard about provident fund contribution by employer. Provident fund contributed by employee is out of his earnings, so that is not a benefit provided by the employer to the employee. But PF paid by employer on behalf of the employee is a part of benefit. Right? This is the breakdown of normally any salary that you see. Now here what happens is basic pay, HRA, allowances, these are generally paid on monthly basis. Every month you will get this payment. Bonus generally paid once in a year. Now, anything which is paid within 12 months or within 1 year is called a short-term employee benefit. It is called a short-term employee benefit if you're settling it within 12-month period. Okay. Then there are something like gratuity, you have leave encashment, PF is also contributed monthly by the employer. This I'll discuss separately. Then you have something called as gratuity. Now, gratuity is like the formula for gratuity, all of you would have seen. 15 days salary, you take it 15 by 26 or 15 by 30, multiplied by number of years of service. Okay. Now, here what is happening is gratuity is not paid immediately. Generally, they require a service period of 5 years for someone to be entitled for gratuity. So when will be gratuity paid? If I join today, I'll get gratuity after 5 years. This is beyond the period of 12 months. And hence, this is called long-term benefit. Even for PF, employee doesn't get monthly payment. Employer contributes to a fund. At the time of retirement, that will be paid. So these are also long-term benefits. Okay. Now, if it is a short-term benefit, if it is a monthly payment kind of a thing, accounting is very simple. Whatever amount you pay, that is your expense, you will be done with it. This payment of gratuity or payment of PF, what happens is, in case of gratuity, the employer says, I will give you 15 days salary for every year completed. And what will be the salary? This will be last drawn salary. This will be last drawn salary. Now, based on that, when you're making a payment, here, the employer doesn't know 100% what will be his liability. This number, because it is coming after 5 years, I don't know how much salary I need to pay or how much gratuity I need to pay. That's the first thing. So here we have to do some estimation. Okay. Second thing is, if I work for 5 years, 1, 2, 3, 4. If I work for 5 years, I will get gratuity payment at the end of 5 years for each year of service. So one part will be related to first year, second part will be related to second year, similarly for third year, for fourth year, and for fifth year. For every year completed, I will get some payment at the end of the fifth year. Okay. Now, here, the benefit that the employee gets is defined. The benefit that employee gets is defined, meaning to say, my benefit, the amount that an employee will receive is defined as 15 days of salary for every year completed. For every year completed, this part is defined. Employer cannot say, I don't have money or my money is shortfall. I thought only this one has to pay. Nothing doing. Whatever is my last drawn salary, based on that, what I receive is called gratuity. Here, the benefit is defined, and hence these kind of plans are called defined benefit plan. These are called defined benefit plan. Okay. Another thing that you have to keep in mind is, let us say my last drawn salary is 10,000. Okay. And for easy calculation, I am taking 15 by 30 days of salary will be paid. So I will be paid 5,000 into 5 at the end of fifth year. That is the final amount that will be paid to me. That is the final amount that will be paid to me. How much will I receive? 5,000 into 5, I will receive here. But think of it, this 5,000 into 5 that I am receiving at the end of fifth year pertains to 5,000 comes from this year, 5,000 comes from this year, 5,000 comes from this year, 5,000 from this year, and 5,000 from this year. Each year is contributing 5,000 towards the end. So we need to account for the expenses of these 5,000 in the respective year. So far, any questions? Now, this 5,000 that I'm calculating here, these are all in future values. But if I have to account for in year one, I need what? I need present value. So this 25,000 that is ultimately payable, this is my defined benefit obligation. But every year, if I say 5,000 is for the first year, 5,000 I'll pay after 5 years. What is today's value? I'll calculate present value. So we calculate something called as present value of defined benefit obligation, which represents my liability. Now, this present value of defined benefit obligation that represents my liability. So let us say, for argument's sake, let us say this 5,000 is the future value. Present value becomes 4,000. Every year I need to add interest. So that this 4,000 becomes 5,000. So 4,000 plus interest for year one plus interest for year two. Like this, when I do, let us say it reaches 5,000. This present value is my liability, and whatever pertains to year one, this is called my current service cost for year one. On this current service cost, every year I charge interest, not on current service cost. On the present value of the defined benefit obligation, I'll charge interest, that is called interest cost. So this obligation plus interest plus interest plus interest, when I do like this, finally it will reach the settlement value. So the way I calculated present value for year one, in the same way I'll calculate present value for year two, year three, year four. Whatever is the present value of that obligation pertaining to that period is called current service cost. Okay. This accounting for defined benefit plan is the most complicated because I don't know what will be the employee's last round salary. I don't know how many years will the employees stay in the organization. I don't know how many employees will leave the organization. So because of that, here we need something called as actuarial estimates and actuarial valuation. Okay, technicalities of this, the depth of this is not required for the examination. Just understand that there is some actuary who will give us an estimate that, see, for your organization, for your enterprise, this is the expected outflow, this is the expected obligation. Okay, that is about defined benefit plan. When it comes to the other plan, let us say PF. In case of PS, what is the rate? PF is 12% of, let us say, basic plus DA forming part of retirement benefits and all of that. Okay, 12%. Now, once the employer contributes, so you have this employer, you have PF trust, and then you have the employee. Once the employer contributes the amount to the PF trust, employee has to take the amount from the PF trust. Employer has no further liability. Here, contribution that is to be made is defined. This is called defined contribution plan. And once the employer has made the payment, employer is no longer responsible. Whether the PF trust has money, whether the PF trust does not have money, it is none of the employer's take. So, in the defined benefit plan, the benefit is defined and employer is responsible. In case of defined contribution plan, the contribution is defined. After the contribution, the employer is not responsible. So that is the difference. Second difference is for defined contribution plan, because every month I am contributing, whatever amount I contribute is my expense. But in case of defined benefit plan, I am not doing any contribution to any fund or something. I'll have separate investments, but I'm not contributing anything. So here I need actuarial to give actuaries to give me an estimate of what is the defined, what is the amount to be treated as my liability and as an expenditure. So when it comes to long-term plan or post-retirement plan, we have defined benefit plan and defined contribution plan. Here, what is defined benefit? Here, what is defined contribution? Benefit contribution. Here, employer has
liability. Here, employer has no further liability. Means after I've contributed, you go and you deal with the PF authorities. I am not bothered. I am not responsible. All right. Then for accounting of defined benefit plan, we need actuarial assumption. Here it is directly expense the contribution. Okay. Now, when we come to defined benefit plan, you have present value of defined benefit obligation. This is your liability. On whatever is the liability, you will add interest cost. Why interest cost? See, I'm calculating present value. I have to go to the future value. So I'll add interest cost. So this will increase my liability. Then I will add any other current service cost. So this present value of DBO, let us say this is my opening balance of liability. On the opening balance of liability, I will add interest cost. I will add interest cost. That will increase my liability. Then if the employee has worked for a year, I will add the service cost for the year. Means whatever is the ultimate amount payable which pertains to my current year, the amount that I add is called current service cost. That will increase my liability. All right. So present value of DBO is the opening liability. Any interest cost that I incur, it will increase my liability. If any current service cost is there, that will increase my liability. Then what happens is you have settlements or you have, let us say, payments. Payments meaning if some employee leaves, I'll make the payment to him. So if I made the payment, my liability will come down. If I made the payment, my liability will come down. Then what happens is I have to make certain estimates to have this opening DBO, the defined benefit obligation. I would have made estimate of like so many employees will work in the organization. This will be the last on salary. Every year this estimate will change, and because of which I can have either gains or losses. So if there is a gain, this will reduce my liability. If there are losses, that will increase my liability. If there is gain, it will reduce my liability. If there are losses, that will increase my liability. So the benefit obligation, whatever I have at the end of year 5 or year 10 or year 15, first I'll have the opening balance, which is nothing but the present value of the obligation. Then whatever cost I incur, I will add the current service cost. Whatever is the interest cost, I will add it to my liability. If I made the payments, I will reduce the liability. If there are any losses, I will increase my liability because losses will increase my expense and that will increase my liability. If there are any gains, means my liability has come down. Then we have something called as prior service cost. Now this basically what it means is, let us say company started in year 0. Till year 2, there was no gratuity plan. In year 2, In year 2, the company came up and said that we'll introduce a gratuity plan. And if you work for 5 years from the original date, we'll give you gratuity. Now, I introduced in 2. I am also giving benefit for the period already completed. So the benefit for period already completed is called prior service cost. So that will also increase my liability. So I will add it to the liability. Okay. This will give me the closing liability. This will give me the closing liability. Now, as far as interest cost is concerned, we take the expected value for calculation of interest cost. Okay. Is this part clear or is there any question here? We will again have a relook at it because sometimes students find it that this is very fast, but you don't need to remember much more other than these aspects in this particular standard. Okay. And when it comes to examination, there is a lot of theory which you should actually ignore. Because if you focus on all those theory, this standard you'll find it very dry. Okay. So I'll as we discuss, I'll use the study material here also. As we discuss, I'll mark things that you need to focus on when it comes to revising for the examination.
Don't waste your full energy on revising everything from the standard. Okay, it is not worth the efforts at your level in CA intermediate. Let me just move the file. Okay. Now, as far as ACE 15 is concerned, it covers employee benefits. Employee benefits can come from formal agreement, legislative requirement, or informal practices. Formal agreement means agreement between the employer and employee. So, whenever you join an organization, you sign an employment contract. Or there could be a formal plan. The company may have a plan where they say, okay, these are the benefits that is provided. Then it can come from legislative requirement, for example, gratuity. For gratuity, the government says that for specific kind of enterprises, gratuity has to be paid at so and so rate. So that is what is called your, for as far as gratuity is concerned. Then informal practices. Now, informal practices is something which they have not defined anywhere, which they have not defined anywhere, which they have not documented anywhere. But what happens is, let us say every 5 years, an employee who completes 5 years, the company has a policy of giving a gold coin. Okay, that is an informal practice. So even informal practice, if at all there is an informal practice and there is an expectation from the employees that I'll be getting these benefits arising once I complete the employment, even these have to be considered as a part of employee benefits, and the company must record the liability. Now, when it comes to employee benefits, we have short-term employee benefits which are payable wholly within a period of 12 months, payable within 12 months of the year end. That is what is the current short-term benefits. Then we have long-term benefits payable after 12 months. We have post-employment benefits, and we have terminal benefits. Now, short-term employee benefits, your normal salary, wages, PF contributions, and all of those things that is made, which is payable within 12 months period, covered under short-term benefits. Then we have post-employment benefits, which covers benefits payable after your employment is completed, gratuity, pension, medical care, etc. And long-term benefits, which are payable after 12 months from the end of the reporting period. Okay. And then there are terminal benefits or termination benefits, which are paid if the services of the employee are terminated by the enterprise. Okay. These are the 4 categories. So when we say termination here, service has to be terminated by the entity. It can be in the form of retrenchment, I'm firing the employees, or if I'm asking the employees to take voluntary retirement. Whereas post-employment benefit means the agreement comes to an end, or the employment relationship comes to an end by agreement between both the parties. It is not that employer is saying employee to leave. Okay, let's say 60 years is completed, or my tenure after 6 years, 7 years, I resign. Then it is post-employment. But if the entity asks me to leave because they have terminated, we cover it as a part of terminal benefit. Short-term employee benefits are benefits other than termination benefits, which are payable within 12 months after the end of the period in which the services are rendered. And quickly, what are employee benefits? Employee benefits are benefits which are provided for services rendered to an entity on a full-time, part-time, permanent, casual, or temporary basis. So, for anybody who provides, whether directors, whether management personnel, whether key management personnel, anybody who provides services to the entity to whom the benefit is being paid, that benefit is called employee benefit. And employee benefit, we saw first category is short-term benefit. Now, short-term benefit, because we are paying it within the 12 months period, anything which falls due within the 12 months period, that is a short-term employment benefit. Now, my entry will be very simple. I would say salary expense, or I would say employee benefit expense to bank or to payable. So if I have to pay salary expense to bank. If I have to pay, if I'm making PF payment, or if I'm making that monthly contribution, or if I'm making a bonus payment, all of that, you will debit to the employee benefit, credit bank or credit payable. Accounting is straightforward. No discounting is required, no bringing it to the present value, no actual valuation, nothing is required. Nothing is required. Very, very straightforward. You are accounting for employee benefit for short term. Okay. As I discussed, it is generally straightforward because there are no actual assumptions are required. Then, as far as short term is benefits are concerned, there is one more benefit which is short term paid absences. Now, short term paid absences, what it means is, if I join an organization, the company says you will get 12 casual leaves, then you will get, let us say, 24 paid leaves. Okay, 12 casual leaves, 24 paid leaves. These 12 casual leaves you will be given, you can take whenever you want. It's a casual leave, so you can just take the leave. You will be paid even though you have not worked on those days. You will be paid even though you have not worked on those days. Okay. Then second one is paid leaves. Now, paid leaves generally what happens is if you avail those leaves, you get paid for even for days not worked. Or if you do not avail, you can be paid for leaves not taken. Now, this might sound confusing because you have not yet worked. I'll just give an example. Let us say in a month, there are 30 days. In a month, there are 30 days, including Saturdays and Sundays. Okay. Out of these 30 days, except the holidays, I am entitled to, and I'm doing a monthly basis, same calculation holds good for annual basis also. I'm entitled to 1 CL and 3 PL. For example, I'm entitled to 1 CL and 3 PL in 30 days. If I take this CL, they'll not deduct my salary. If I take this CL, they will not deduct my salary. I have not worked for 1 day, still I'll get payment for 30 days. As far as PL is concerned, assume for a moment that I took 2 PL and balance left is 1 PL. If I have taken 2 PL, I have taken 2 PL. If I have taken 2 PL or 2 paid leaves, what does that mean? I have not worked for 2 days. Even though I have not worked for 2 days, they will still pay me salary. That is why it is called paid leave. Okay. Then, or they also call it privilege leave. Okay. Paid leave, privilege leave, multiple names are used. Then, whatever this balance 1 paid leave, because I have not taken that 1 leave, I'll get extra payment. So I'll not get payment for 30 days. I'll get payment for 31 days. So why 31? 30 days is my month. 1 CL I have taken, 2 PLs I have taken. So 3 are anyways paid leaves for me. That 1 extra that is left, company says, because you have not taken that leave, I will pay you. That's why you get 31 days. Or the company can say, this 1 PL I'll carry forward to the next month. In the next month, if you want, you take. If you don't take subsequently, at the end of the period, I will make you some payment. Okay. So this is how the leaves work. So short-term paid absences can be accumulating or non-accumulating. Accumulating means like 3 PLs, I took 2, 1 can be carried forward. That is called accumulating. Non-accumulating means like CL. If you don't take, it is lapsed. That is called non-accumulating. One is accumulating, which can be carried forward, accumulated and carried forward. Non-accumulating cannot be carried forward. Okay. Then we have vesting and non-vesting. Vesting means there is no further condition required to me. I can directly take the leaves next year. Non-vesting means it doesn't vest upon me unless I complete certain conditions. Maybe unless I work for 3 months or 6 months in the next period, it doesn't come to me. Right? This is not really relevant. What is relevant is this part. So, if there are short-term paid absences, if it is non-accumulating in nature, no special treatment is required. If it is non-accumulating in nature, just a moment. If it is non-accumulating in nature, no special treatment is required. If it is accumulating in nature, then for the closing balance of leaves, whether the employee can encash or take it in the next period, we will create a liability. So why liability? Because in the next year or in the next month, I'm saying, even if the employee doesn't work for 1 day, I will pay him full salary. So that becomes my liability. Okay. So as we discussed, there are vesting and non-vesting. Vesting means you can get cash payment if at all you don't take the leaves. Non-vesting means no cash. You can take extra leaves in the next year. So generally what happens is in organizations, you see, if 24 leaves are allowed, paid leaves, and out of these 10 are taken, for the balance 14, they become accumulated. They are carried forward to the next year. In the next year, you can either take cash if you want to, that is what is called leave encashment. Okay. Or you can take these leaves. So if they are not entitled to a cash payment for unused entitlement, this is called non-vesting. If it can be encashed, it is called vesting. Right. Now, simple thing is for non-accumulating, no special treatment. For accumulating, you will provide for liability for the unused balance. An enterprise has 100 employees who are each entitled to 5 working days of leave for each year. 5 days. Very bad organization. Unused leave may be carried forward for 1 calendar year, The leave is taken first out of current year entitlement and then out of any balance brought forward from the previous year on last in first out basis. What does that mean? If you say current year 2000, let us say 25, I have entitlement of 5 leaves. I took 3 leaves, 2 will be carried forward. In 2026, I'll get 5 leaves of 26 plus 2 carried forward. Now in 2026, when I take the leaves, first they will knock off this balance, then they will knock off the opening. And how long can it be carried forward? It can be carried forward for 1 calendar year. After that 1 calendar year, it will lapse. After the 1 calendar year, it will lapse. At 31st December, the average unused entitlement is 2 days per employee. So each employee has 2 days of unused leaves. Means this can be carried forward. If this can be carried forward, in the next year, they can take leave. For this, we need to create a liability. So why to create a liability if you're not paying cash? The simple logic is, in the next year, I'm telling the employees, even if you don't work for 2 days, even if I don't get benefit for 2 days, I will pay you full month salary. So I need to, because it is next year, they may not work. And because of the leaves earned in the current period, I need to create a liability. The enterprise expects, based on past experience, which is expected to continue, that 92 employees will take no more than 5 days of leave in year 5, and that the remaining 8 employees will take an average of 6.5 days each. So next year, 92 will take only 5 days of leave, and balance will take 6.5 days of leave. The enterprise expects that it will pay an additional 12 days of pay as a result of the unused entitlement that has accumulated on 31st March. Now, how does this work? How does this work? I have 100 employees. Out of 100 employees, there are 92 employees and 8 employees. Okay. These 92 employees, they will take only 5 days of leave. Now, if they take only 5 days of leave, do I have any obligation to give them extra leave for the previous period balance? No, because we will first consume this 5. So this 2 is worthless. And my advice is, when you start working, no, don't allow your leaves to lapse. Plan your holidays and vacations and off days in a way that you utilize all the leaves which cannot be encashed. Companies will not stop working because you are on leave. Okay, so please keep that in mind. I have suffered. In the second entity where I work, 5-6 days of leaves every year used to go waste. Don't let the leaves go waste. Okay, so out of this 92, 5 out of this 92, out of this 100, only 92, 5 days of leaves will be taken. If only 5 days of leaves are taken, I don't have any additional leaves to be given to these employees for the next year. So there is no liability. This entire thing will lapse. But these 8 employees, they're saying they will take 6.5 days. So for the 6.5 days, they will use 5 days from the current year and 1.5 days from the previous year. So now the entity has an obligation to give 1.5 days of leave to 8 employees. So we will make a provision for 12 days. We have to pay 12 days pay extra to the employees next year, even though if they don't work. That is why we need to create a liability. How? 12 days multiplied by the salary. Okay. Any question in the leaves calculation part? Okay. So I'll just recap it once again. When it comes to leaves, when it comes to paid absences, when the employee says that even if you don't work, I'll make you the payment, it can be accumulating or non-accumulating. Accumulated means it can be carried forward. It can be carried forward. Non-accumulating means no carry forward. If leaves cannot be carried forward, there is no further obligation on the enterprise and hence no accounting treatment is required. Whereas if it is accumulating, it can be carried forward. In the next year, the employee can be paid cash or employee can be given leaves. Even if I give leave to an employee, basically what I'm saying, you don't work for 5 days, I'll give you full payment. So it is kind of an obligation on my part, right? So if it is accumulating for the subsequent period, whether vesting or non-vesting, vesting is cash paid, non-vesting is cash not paid. You need to make a provision. As far as vesting is concerned, I need to make the provision for full amount because if the employee doesn't take leave, I need to pay cash. But for non-vesting, I need to estimate how many days of leave will the employees take, and accordingly, I need to make a provision. Then we have profit sharing and bonus plans. These are basically straightforward that you give some percentage of profit as employee compensation, or you give bonus based on the salary as a compensation. Now here, you need to create a liability when you have a present obligation to make such payment as a result of past events, similar condition account as per accounting standard 29, and you can make a reliable estimate of the obligation. Then the next part that we have understood, or that we discussed a lot about it, is the defined contribution plan and the defined benefit plan. Defined contribution plan is where contribution is defined, means the employer, what the employer will contribute to the other party, that is what is defined. If that is what is defined, whenever I make the contribution, what I will do, as and when I make the contribution, I will say, okay, this is my expenditure, right? Now this contribution, when it is defined, you will have a funded plan means I have to pay the money to the plan. That is why it is called funded plan. It can be controlled by the entity if it is a trust within the entity, or it can be non-controlled. It could be a state plan. This is generally what happens, which is employee provident fund organization, or you can have multi-employer plan, two and more employers coming together and having a plan, or it can be an insurance company which is doing it. Okay, this is more for one-time understanding purpose. Don't waste too much of time in trying to understand and figure out this particular aspect. Defined contribution plan, they said there are fixed contribution and they have no obligation to pay further contribution. Definition you need to remember. Defined benefit plan are post-employment benefit plans other than defined contribution plan. And here you can add benefit is defined. Benefit is defined and the risk falls on the employer. Means if the amount contributed is not sufficient to pay the benefit, employer has to bear the risk. Employer has to settle the liability. Gratuity, whether it is a defined contribution or benefit plan, here benefit is defined and hence it is a defined benefit plan. We have already discussed. Now, as far as the accounting is concerned, this is for defined benefit plan. This is the most complicated part in this particular standard. Okay. Now, as far as the balance sheet is concerned, you have to show a liability of the following amounts. What are the liability? Present value of defined benefit obligation at the balance sheet date. We saw, right? 25,000, we have to discount it and bring it down to present value of at the end of the current period. First year contribution is 5,000. So 5,000, present value of 5,000 becomes my present value of defined benefit obligation at the balance sheet date. Okay. Then if at all there is any past service cost which is not yet recognized. Not recognized means what? I have not yet recognized the past service cost. So that is that is not yet my liability. I'll reduce it. Typically, you will not get this kind of adjustment. Then when I have a liability to pay the employees some gratuity, what I also do is I make certain investments. Investments meaning I invest some amount in some assets like securities, as allowed under the Trust Act, fixed deposit and all of that. So to settle this liability, I keep money aside into some investment. This is called plan assets. So on one side, I have liability to pay employees. On the other side, I make some investment in some securities, some defined assets which are called plan asset. Now in the balance sheet, what I'll do is I will take the present value of defined benefit obligation minus the plan assets. I will show the net amount only. in the balance sheet. Now, generally, this net amount will be a defined benefit liability or present value of defined benefit obligation net liability. It generally cannot be an asset because I generally will not have an higher amount invested for paying my liability. So my liability will be higher. Normally, you will have a net amount of liability, which is nothing but defined benefit obligation minus the plan assets. Okay. Only so much is relevant. You can run through it once, but again, till here you can run through it once, but not very relevant as far as exams are concerned. Our focus is purely how to handle this question from examination point of view. Then we talked about balance sheet. Balance sheet is what? My defined benefit obligation present value minus the plan asset, the net liability I will show in the balance sheet. I also need to see what has to go to the P&L. Now, as far as P&L is concerned, we understood that we will take current service cost. This is cost pertaining to current year. So whatever that 5,000 present value was there, that is called current service cost. It will be added. Then if at all there is any interest cost, if at all there is any interest cost, that I will add, because interest cost increases my liability. Interest cost is my expense. I will add. Then if at all there are any plan assets on which I am expecting some return, this I will reduce from the P&L expenses. So current service cost I will add to the P&L expense. Interest cost I will add to the P&L expense. The expected return on plan asset I will reduce. I will reduce. Please remember expected. Interest cost also I'll use expected only. And this generally is done on opening balance. This also is done on opening balance. Okay. Then if there are actuarial gains, I will reduce the expense. If there are losses, I will add to the expense. If there are any past service cost which has been recognized for the current period, I'll add it to the expense. If there are any curtailment or settlements, now curtailment and settlements generally what happens is, say for example, I am shutting down a branch. There are 10 employees in that branch. Now when I'm shutting down that branch, all of them have served 3 years in my organization and I have closed that branch. Now employees say, sir, we thought 5 years you'll work and we'll get the gratuity plan. Now you're shutting down in 3 years. You have to please settle it. You cannot say that you're not entitled because you're firing me. So we negotiate. When we negotiate and we come, we say that, okay, we will settle at some amount. We will settle at some particular amount and in future, nothing else will be paid. Because you have worked for 3 years, I'm being generous and I'm paying you, let us say, 2 years of gratuity. So I've done the settlement. Now, whenever I've done the settlement, instead of 3 years, I paid only for 2 years, there is a settlement gain. This gain I will reduce from the expense. Similarly, there could be curtailments. Curtailments means I have reduced some benefits under a plan. This also I will reduce from the, I'll also reduce from the expense. And when I've given all of this information in the examination, last part you can ignore it. No need to break your head again. Okay, now it is slightly at a higher level when it comes to intermediate, testing. Okay, so when it comes to P&L, you will take current service cost. What is the current service cost? Interest cost will increase my expense. Expected return as on asset, whatever in return I get, it will reduce my expense. If there are gains, actual gains, it will reduce my expense. If there are actual losses, it will increase my expense. If there are past service cost, it will increase my expense. And if there are any curtailments and settlements, it will reduce my expense. That is how I will recognize the P&L items. Now, how does this relate to the liability? Current service cost will increase my liability. Interest cost will increase my liability. Expected return on plan asset will increase my asset because it is return on investment. Actuarial gains will reduce my liability. Actuarial losses will increase my liability. Past service cost will also increase my liability. Curtailments and settlements will generally reduce my liability. If there is a settlement loss, it will increase my. Okay, so these are the components. A to F is what you need to remember from the examination point of view when it comes to components to be recognized in P&L. Any questions here? Now, whenever we do the accounting for defined benefit plans, there is a lot of importance on actual assumption because I'm estimating how many employees it work, what will be their salary, what will be their age, and all of those things, right? For just for gratuity. If something comes like pension, for pension, you need to estimate some more things. How many years they will retire, when will they retire? Of course, 60. After retirement, how many years will they stay or will they survive? Because pension is dependent on that. Correct. So you make certain actual assumptions like demographic assumptions, mortality, death during and after employment. If someone dies during the employment, we have to pay some extra amount. So that also needs to be estimated. Rates of employee turnover and early retirement and disability. How frequently will the employees change the resign from the job? How many new employees will come? Proportion of plan members with dependents who will be eligible for benefit. How many kids they have? For kids, what kind of benefits we need to provide? Claim rates under medical plan. How much will be the claim rate? So these are related to demography or population. Then financial assumption. See, we have been talking about present value. We talked about interest cost. We talked about return on plan asset. For all of these things, we need something called as interest rate. Without the interest rate, how will we estimate? So we need to estimate the discount rate. That is one assumption. Then we need to estimate the future salary and benefit level. When the employee retires, what will be his salary? When the employee retires, what will be his salary? That needs to be estimated. Then for medical benefits, future medical cost, how will the medical cost increase? Okay, then expected rate of return on plan asset. All of these are financial assumptions. So these are the assumptions. Now what happens is actuary will come and say in year one that liability is 2000. Okay. In year two, he may say liability is 2200. Now 2000 to 2200, it could be because of, let us say, 100 of current service cost, 50 of interest. Okay, so 2000 plus 1000 plus 50, it becomes 2150. But now he's saying 2200 because some assumptions changed. Now, if 2000 plus 100 plus 50 becomes 2200, it should have been 2150 only. This extra 50 is on account of actuarial losses. So any loss which arises because of actuarial assumptions changing are called actuarial losses. Any gain which arises because of actuarial assumptions changing is called actuarial gains. Actuarial gains and losses arises because of experience adjustment. Means I was thinking something else happened. I'm more experienced now. Earlier I thought 3% employees will leave. Now I know because of experience only 2% employees will leave. Or so because of that, I'll adjust the people who will leave the organization, and hence there will be a gain or loss. Same way, there could be changes in actuarial assumptions. I would, I'll assume demographies and all related thing. There could be actuarial assumptions which I have changed. Because of this whatever gain or losses that arises, it is called actuarial gains and losses, and this should be recognized in the statement of P&L as income or expense. Now, please keep in mind, if it is actuarial loss, it is an expense, it will increase my liability. And if it is an actuarial gain, it is a benefit and it will reduce my liability. Okay. Right? So that is about actuarial gains and losses. Let's look at this question. Omega Limited belongs to the engineering industry. The company received an actual valuation for the first time for its pension scheme, which revealed a surplus of 6 lakhs. It wants to spread the same over the next 2 years by reducing the annual contribution of 2 lakhs instead of 5 lakhs. Average remaining life of the employees is estimated to be 6 years. You are required to advise the company on the following items from the viewpoint of finalization for taking note of standards, not the following items. Basically, what has happened is it is an engineering company. Okay, that doesn't matter. They have done the valuation for the first time, and then there is a surplus of 6 lakhs. Surplus of 6 lakhs basically means what? The actuarial gain. Okay. Now, what the entity is saying is, I will not book this gain in the same year. I'll spread it over a 3-year period. Is that allowed? Not allowed. Actual gains or losses has to be recognized in P&L in the same year. In the same year. So if you have to recognize it in the P&L in the same year, there is no question of deferral. Any actual gains, any actual losses will be recognized in the statement of P&L in the same year. So it is not a correct treatment. Okay. Right? So that is how we treat actual gains and losses. If it is gain, it will reduce my liability. If it is loss, it will increase my liability. This type of questions are important from exam point of view just because of the fact that if this question comes, you will be able to score 5 out of 5. You'll be able to score 5 out of 5. As on 1st of April of year 1, the fair value of plan assets was 1 lakh. So this we are talking about plan assets. See, on one side we have defined benefit obligation. This is the liability side. This is the plan asset side. In respect of a pension plan of GLS Limited, on 30th September, the plan paid out benefits of 19,000 and received contribution of 49,000. So whenever the plan asset receives contribution, means the company is making investment into the plan, the asset will increase. Whenever the plan asset is making out benefit payments, when they are settling the benefit, it will reduce the plan asset. On 31st March of year 2, the fair value of plan asset was 1,50,000 and the present value of defined benefit obligation of 147,920. Actual losses on the obligation for the year 1-2 were 600. On 1st of April, the company made the following estimates on its market studies based on prevailing prices. Interest, dividend, and income after tax payable by the fund 9.25%. Realized unrealized gain 2%. Administrative cost 1%. Expected return is 10.25%. This expected return is on what? Is on plan asset. Is on plan asset. You are required to find the expected and actual returns on plan asset. So what I have said, what is the expected return? What is the actual return? Now, generally, the way it works is you take the opening balance, and on the opening balance, you will calculate what is the return. But in some specific questions, Institute has done for during their contributions also, they have calculated separately. So accordingly, you can do it in the examination. But most of the cases I've seen, expected return is on the opening balance only. Okay, that is how it works. That is the expected. Actual return may be different. Actual return may be different. Now, what have they said? They have said to find the expected and actual return on the plan asset. Expected and annual return on the plan asset. Now, when we talk about expected return, we'll take the expected rate and we'll multiply it with the opening balance, and if at all there is a contribution, for the contribution during the period. So expected return will be, what is the opening balance? 1 lakh. At what rate? 10.25%, 10,000 to 50. That's the first thing. Second thing is, we have contributed how much? 49,000, and we have paid 19,000. 49,000 was given to the fund. Fund paid 19,000 to the employee. So the contribution is 30,000. On that 30,000, you will calculate for 6 months. Now here you can have two assumptions. You can say it is 10.25% per annum. So you can calculate for 10.25% by 2. That can be done. Or here the assumption they have taken is it is 5% compounded 6 months. Means if it is 100 at the beginning, after 6 months it will become 105. Then after another 6 months, you will add another 5%. So 105 into 5% is 5.25. So this will make it 110.25. So the return comes to 10.25. The compounding effect, basically 1 plus rate by 2 multiplied by 1 plus rate by 2 minus 1. You have learned in compound interest. Okay. So you can do 10.25 by 2 and do the calculation. In that case, it will be 30,000 into 10.25 divided by 2. That is 1537. That you can do and write an assumption. Or you can take it is 5% for 6 months period because it is compounded annually, semi-annually. And hence it will be 5%, which is 1500. So total expected return is 11750. 11750. Now, what is the actual return? For calculating actual return, you can do in two ways. Okay, one is you can prepare a ledger. Second one is you can prepare a statement. Okay. Now, how we'll do the actual return is, first you will see what is the opening balance. What is the opening balance? Opening balance is 1 lakh. On this position of 49,000 and reduce the benefit payment of 19,000. So 1,49,000 minus 19,000 is 1,30,000. This should be your closing balance on 31st of March. Actual fair value is how much? 1,50,000. So 130 to 150, the difference is 20,000. Okay, that is what is called the actual return. How to calculate actual return? Take the opening balance, add contribution, minus settlement or payment. This will give you some number. Okay, that number, if you compare with the closing balance, whatever is the difference, that is called actual return. Now, if you have to prepare in the ledger format, what you can do is plan asset, opening balance, how much? 1 lakh. To opening balance, 1 lakh. Contribution made, 49,000. You will debit the asset. Settlements made, 19,000. Closing balance, 1,50,000. So 169 minus 149, you have 20,000 here. This is your actual return on plan asset. Actual return on plan asset. So you can calculate either by preparing a statement or by preparing a ledger. This question, please mark it important. Please revise it once before the examination. Any question on the calculation of actual and plan returns? So we'll pause here. Okay. And the remaining part of the standard will continue on Monday, 10:30. One, sir, the 2% is included in 9.25. No, it is not included in 9.25. This is realized and unrealized gains. This is interest and dividend. So this 9% is separate. This 2% is separate. So 9.25 plus 2 makes it 11.25 minus 1% of cost. When you do, you get 10.25. Okay. Clear? Yeah. So see, there are only 2 or 3 types of questions you need to bother about when it comes to AS 15. That is more than sufficient as far as your examinations are concerned. Okay. Sure. Thank you. Now, continuing from where we left in the previous class, this is also an important question which you need to have a quick look at it before the examination at least once. Rockstar Limited discontinues a business segment. So here what has happened? They had a business segment which is being discontinued. Under the agreement with the employees union, the employees of the discontinued segment will earn no further benefit. So we're saying there is no further benefit that will be attributed to the discontinued segment. This is a curtailment. Curtailment means we have reduced the benefit without settlement. We did not do any settlement. We just said we will not pay you. Okay. Settlement happens when we say we are reducing your benefit and we are paying you something to compensate you. That is when we say settlement. But curtailment is we are cutting down the benefit, but no settlement. Why there is no settlement? Because employees will continue to receive benefits for services rendered before discontinuance of the business segment. So what they're saying is, before the business segment was discontinued, whatever benefits were accrued, that you will still get. Curtailment reduces the gross obligation for various reasons, including change in actuarial assumptions made before the curtailment. Because I've curtailed, I've cut down, it will reduce the DB or the liability. So always remember, whenever there is curtailment means to reduce. This will reduce my defined benefit obligation. If the benefits are determined based on the last pay drawn by the employees, the gross obligation reduces after the curtailment because the last pay earlier assumed is no longer valid. So earlier we thought pay of year 5. We thought we'll pay year 5 salary, but we are curtailing at, let us say, in year 3 itself. Now, because we have cut down in year 3 itself, salary that is relevant is year 3 salary. There is no, the year 5 salary, which is a higher salary, is no longer relevant. Now, this is the background, hardly anything to do here. When you get a question in case study, you have to understand what are the items to be ignored. Now here, only thing relevant for us is curtailment. There has been a curtailment and that is what is relevant. Apart from that, nothing else is relevant in this particular paragraph. Rockstar estimates the share of unamortized service cost that relates to the part of the obligation at 18. Calculate the gain from curtailment and liability after the curtailment to be recognized in the balance sheet of Rockstar Limited on the basis of given information. Immediately before the curtailment, gross obligation is estimated at 6,000. So before curtailment, obligation is estimated to be 6,000. Fair value of plan asset on the date is estimated to be 5,100. So what is the net liability? 6,000 minus 5,100. This actually should be, they should have given present value, but they have given gross number. The unamortized past service cost is 180. Unamortized past service cost means sometimes what happens is the enterprise or the entity has amended plan retrospectively, because of which past service arises. We already understood what is the meaning of past service cost. Now, past service cost, if it is vested, then you will recognize immediately. But if past service cost requires some more conditions to be fulfilled, or it requires some more year of service to be fulfilled, past service cost is deferred and amortized. Like an asset in the balance sheet, you will present it. So unamortized past service cost means that portion of past service cost which has not yet been expensed. Curtailment reduces the obligation by 600, which is 10% of the gross obligation. So what they're saying, from this 6,000, there will be a 10% reduction. There will be a 10% reduction, right? Now, we are required to calculate the gain from curtailment. Reduction in gross obligation, what they have told us is 10%. So if 10% is reduction, 6,000 becomes 600. See, this actually they should have given present value. Okay, not the gross number. It has to be actually in the present value. Then, whenever there is a reduction in benefit, please understand past service cost, the one which represents the past service cost, is also reduced proportionately. Past service cost is also reduced proportionately. Why? Because this past service cost represents the service benefit or the benefit that will be paid for the past service for all the employees. Now, when I'm reducing the benefit by 10%, I will also reduce the past service cost, or the past service cost also will be reduced by 10% because I will no longer be incurring that cost. So what happens is my liability is reduced by 10%. If you see the balance sheet, the past service cost, it is not an asset, but it has a debit balance 180. Liability has a balance of 6,000, and plan assets have a balance of 5,100. This will be knocked off by 10%. This past service cost is 180. This will also not be knocked off by 10%. So if you see, liability reduces by 10%, which is a gain, and this cost which was not yet amortized, that balance also reduces by 10%. It is opposite of reduction of liability. It is opposite of reduction of liability. So this is the reduction. So what is the net gain from curtailment? 582. The net gain from curtailment is 582. Now, what is the final liability? Please understand. Out of the 6,000, we wrote off 600. We are left with 5,400. And we have assets. See, asset side, nothing will change. Asset side, nothing will change. Why nothing will change? Because on the asset side, we have 5,100. We did not pay anything. We did not pay anything. When we did not pay anything, nothing would reduce on the asset side. So asset side remains as it is. Gross obligation comes from 5,400. I'm again repeating that it should be actually present value, not the gross obligation, but instead has given the question that way. Fair value of plan asset 5,100. This comes down to net liability of 300 minus the unamortized past service cost, which is left over 162. So the net liability is 138. Sir, how do we remember, or how do we present that in the balance sheet? As I told you, plan asset is this side, liability is this side, past service cost is this side. So when you present in the balance sheet, it will be your liability minus plan asset minus unamortized past service cost. Okay. This is one is important for your examination. Now, based on what we understood in the previous class when we talked about defined benefit plan or defined benefit obligations, we'll have a look at this particular question where we will understand how does this recognition of expense happens. Okay. An employee joined a company in the year 1. The annual emoluments of Roshan as decided is 1490,210. This is the annual payment. The company also has a policy of giving a lump sum payment of 25% of the last drawn annual salary of the employee for each completed year of service. So, how many number of years you complete? Based on that, 25% of the last drawn salary you will give. Something like gratuity, which we discussed in the previous class. Like, if I work for 5 years, 1, 2, 3, 4, 5. If I work for 5 years, right? Last drawn salary, whatever is the salary, 25% of that for each of this year. For each of the year completed, we will be paying. And we understood that this will be in future value. We have to bring that down to present value. Right? This we already discussed. The salary of Roshan is expected to grow at 10% per annum. He joined at this. Every year it will go by 10%. Right? So what we need to know? We need to know salary at the end of year 5, that is 14,90,210. This is growing by 10%, so 1.1 for 5 years. Basically, future value is equal to present value multiplied by 1 plus r to the power of n. That formula we need to use. So if you use that, 1490,210 into 1.1 to the power of 5, or you do this up to you, you get a salary of 24 lakhs at end of year 5. So basically, salary here is 24 lakhs. Salary here is 24 lakhs. Now, what the policy says is 25% of this, that is 6 lakhs, for every completed year of service. So 6 lakhs into 5 years of service, you will be paid 30 lakhs. You will be paid 30 lakhs. Now, one thing that you have to understand is this 30 lakhs that you will pay here is coming from 6 lakhs, 6 lakhs, 6 lakhs, 6 lakhs, 6 lakhs. For each of the year, you are saying 6 lakhs is the component. Now, this 6 lakhs, which is a part of your 30 lakhs, this is future value. I need to know what is the present value. I need to know what is the present value. But present value at which date? At the end of year 1, year 2, year 3, year 4, and year 5. At the end of year 1, 2, 3, 4, 5. At the end of each year, we need to know what is the present value. So, final amount paid 6 lakhs. If this is paid when? This is paid at end of year 5. Paid at end of year 5. I need the present value at end of year 1. I need present value at end of year 1. If I need present value at end of year 1, means I need to discount it by from 5. Look at this. End of year 5, end of year 5 to year 4, then end of year 4 to year 3, then end of year 3 to year 2, end of year 2 to end of year 1 for discounting. So 6 lakhs, you have to discount it for 4 years. This is for the first year. For second year, for 3 years. For third year, for 2 years. For the fourth year, for 1 year. This is end of year 5, no need to discount. So when you do this, what you get is present value of defined benefit obligation, the breakdown of it. So for at the end of first year, you will say, sir, my present value is 4,41,000 for what I will pay after 5 years. Means 6 lakhs, which is attributable to year 1. 6 lakhs, which is attributable to year 1. When I pay it after 5 years, that is the 6 lakhs value. If I have to bring it to present value, I need to discount it by 4 years. So this becomes the present value, right? Now, this is the service cost for year 1. This is the service cost for year 1. Now, when you have to calculate how will you reach the closing balance of 30 lakhs, for year 1, there is no opening balance. There is no interest cost because there is no opening balance. Current service cost is 4,41,000. Closing balance also is 4,41,000. Then next year opening balance is 4,41,000. On this 8% interest, what the question says, 8%. Okay, 8%, discount rate of 8%. What the question says, 441 into 8%, you will get 35,280. Right? Then current service cost. Now, when you come to the second year, you're paying at the end of year 5, you need the value at end of year 2. So you'll discount it by 3 years. You'll discount it by 3 years. How 3 years? Again, you're paying here 1, 2, 3. You need at the end of year 2. So when you discount it at the end of year 2, you will get 476. That becomes the current service cost for the company. Closing balance is opening balance plus interest plus current service cost, closing balance. This is your present value of DBO at the end of year 2. Like this, every year when you calculate, you will get present value or the obligation at the end to be 30 lakhs. Okay. Always remember when you're preparing this table, this last number will be your balancing figure. These numbers 441, 476, 514, 5556 and 6 lakhs. This is current service cost charged to P&L every year. Interest cost is also charged to P&L every year. And please remember, interest cost increases my liability. Current service cost also increases my liability. Past service cost, which I'm amortizing, increases my liability. Actuarial losses will increase my liability. So this framework you should have in mind to compute the liability. This also, you please mark it as important for practice and let me know if you have any question in this particular question. Sir, can you please explain how did we get 30 lakhs figure once again? Okay. What are they saying? They are saying 14,90,000 is the joining salary. Every year salary will grow by 10%. So last run salary will grow by 10% for 5 years. When I calculate 1490 to 10 into 1.1 to the power of 5, or you can do 1.1, 1.1, whatever the way you do, ratio and proportions calculation. So your final salary is 24 lakhs. The question says you will get 25% of this 24 lakhs for every completed year of service. 25% of 24 lakhs is 6 lakhs. 6 lakhs for 5 years is 30 lakhs. Now, when you break up 6 lakhs, this you are getting at the end of year 5. I need present value at the end of year 1, end of year 2, end of year 3, end of year 4, end of year 5. So that is how we calculated the present value. And you take the opening balance, add interest, add current service cost, you will get the closing balance. And then it is 5 increments, no? So when did you join? He joined in the year 1. So we'll assume beginning of year 1. And you have to complete 5 years of service. So this 0, he has joined here. So end of year 1, 5% increment, 2 increment, 3 increment, 4th increment, 5th increment. Not 5%, sorry. 10%. 10% for 5 years. Is it clear? Okay. So we have covered almost everything. The last few concepts remaining. So far what we have done, we have talked about short-term employee benefits. This is directly expense. Then we talked about post-retirement plans, pension plan. We have defined benefit plan, defined contribution plan. Defined contribution plan, contribution is defined. This also is directly expensed. Then defined benefit plan, just remember the example of gratuity or pension. Here benefit is defined. Here we need actuary. And one last time, your defined benefit obligation, when you calculate, you will take opening balance plus current service cost. Current service cost will increase the liability, plus interest cost. Interest cost will also increase the liability, minus actuarial gains plus actuarial losses. Actuarial losses will increase the liability, plus past service cost will increase the liability. Then if there is any settlement, minus settlement gain, or gain will be reduced, losses will be added, right? Then if any benefits are paid, that will reduce my liability. This way you will get the closing defined benefit obligation. Okay. For plan assets, you will take opening balance, add contributions, add expected return, you will get closing balance expected. That closing balance expected, when you compare with the actual closing balance, the difference will give you actual gain. So we talked about short-term employee benefit or retirement post-employment benefit. Then we have other long-term benefits. Now, other long-term benefits are something which are long-term in nature, but which are not your post-employment benefit. It could be long-term compensated absences. So, for example, they can give sabbatical leave, long period leaves for senior employees, 1 year leave, 2 year leave, something like that on paid basis. Jubilee or other long-term service benefit. So this could be like, let us say, gold coin scheme. Long-term disability benefit. If at all there is any disability, you will have benefit for that. Profit sharing and bonus payable 12 months or more. Anything payable after 12 months. Deferred compensation paid 12 months or more. These are other long-term employee benefits. Just remember what are included here. Calculations and all are not important. Okay. Then termination benefits. Termination means I have asked the employee to leave. That is termination. Or I have given an option to voluntarily leave. Employee, I'm giving a scheme. I'm giving a scheme such that employee says, okay, I will leave the organization. Okay. Termination benefits are employee benefits payable as a result of either an enterprise decision to terminate an employee's employment before the normal retirement date. So either I have decided to fire my employee, or an employee's decision to accept voluntary redundancy in exchange for those benefits. That is voluntary retirement scheme. If I'm resigning, normally that is not part of termination benefit. That is not a part of termination benefit. So if the employer asks me to leave, I'll say, I will not leave like this. You pay me some compensation. termination benefit. Or the employer gives out a voluntary retirement scheme saying that, you'll work for 5 years, you'll get so much of salary. Don't, waste your time. I'm giving you an attractive offer. I will give you 3 years salary for free. No need to work. No need to work. You can leave the organization. Okay. So that is what is called voluntary retirement scheme. Now, whenever the termination benefits are announced, they are recognized by an enterprise as a liability and expense when the enterprise has a formal plan for termination which is approved and a reliable estimate can be made of the amount of the obligation. These are basically your AS29 conditions. Okay, same conditions. Where the termination benefit fall within 12 months, you use undiscounted value. If it is falling due more than 12 months, you will use a discounting value. That is what it is done. Okay. Now, termination benefits are basically again recognized. If it is immediately paid, you recognize. If it is paid after 12 months, you will calculate the present value. The thing here to understand is once I have communicated to the employee that, okay, I am firing you, you are leaving my organization, then in that case, the benefit is triggered. Immediately, I have to recognize the liability and corresponding expense. Okay. Now, there are much more other things which are in AS 15 as far as the bare text is concerned, but that has not been kept in a syllabus because those are slightly advanced concepts. This similar thing we have already done, how to calculate. So please practice how to calculate actual return and expected return. That is one favorite question for the examiner. Same thing, this also we have already completed. Okay, right? Any questions on AS 15? And say, no need to worry about excessive theory. One simple reading is more than sufficient for the examination. Okay, no need to break your head on trying to remember everything. What you need to focus on in this particular chapter is calculation of DBO. We have already seen plan assets, expected versus actual. Then defined benefit plans, calculation of current service cost. Okay, now let us look at a couple of theory questions and then we'll move. Entity XY is required to pay a salary of 2 crore for the year 1-2. It actually paid a salary of 1.9 crore up to 31st March, balance in April year 2. Determine the actual cost to be recognized and any amount to be shown to the balance sheet. Very simple. Expense is 2 crores. So my expense will be 2 crores. How much did I pay? 1.9 crores. So what I paid is 1.9 crores. Balance 10 lakhs is my liability. You will show it under current liability. Okay. Whether an entitlement to earn leave which can be carried forward to future period is short term or long term. So here the simple thing is, can I encash it within the next 12 months? Can I utilize it in the next 12 months? If I can do that, it is short term, otherwise it is long term. In case an enterprise allows unutilized employee benefits, example Medicare, leave, travel to be carried forward. So current year can be carried forward. Whether it is required to recognize a provision in respect of carry forward benefits. Okay, so here if we are carrying forward something, should we recognize a provision? So where accounting standard 15 and 29, both of them get triggered. So if at all there is an obligation on the part of the employer that they need to provide these benefits, they need to allow, for example, medical care, some benefits are there. The amount is not yet utilized. It is carried forward. Then in that case, for future, you need to create a provision. Okay, so a provision should be recognized for all benefits which an employee becomes entitled to as a result of rendering the service and should be recorded as a part of cost of service rendered during the period in which the service was rendered. So we have seen earlier also, in leave which will be encashed in the next period or whatever will be carried forward, if it is already vested, means if the employee is entitled to get it, then you should recognize. You should recognize what? A provision. Okay. That's a simple AS 15 and AS 19 combined question. Yes. So that brings us to the conclusion of accounting standard 15. Right. Next, we'll start with accounting standard 25. Okay. So now we'll start with the next standard. Very simple standard. There is nothing complicated in this standard. Generally, two types of questions, what are asked or what are presented. Okay. That is what we need to understand. And some bit of theory, that is what is relevant. I'm talking about accounting standard 25, which deals with interim financial reporting. Now, interim financial reporting is basically financial reporting for an interim period. Interim means which is not a complete set of period or which is not for the full year. So if I'm talking about, let us say, one full year,
April to March, if you are presenting financial statements from April to June, that is called interim financial statement. Even if you are presenting financial statements of only April, that is also interim financial statement, right? Typically, what happens is listed companies, they are required to present quarterly financial statement, and that is where this interim financial statement comes into picture. Now, one thing you need to understand or keep in mind is for listed entities, Ind AS is applicable. There also we have a similar standard which talks about interim financial statement. So as far as AS25 is concerned, they don't mandate, they don't tell which enterprise should be required to present interim financial report and how frequently they should prepare. But what they say is, if any enterprise is preparing interim financial statement or interim financial report, then you need to comply with the provisions of AS25. We are not saying who has to prepare or for what period, for how frequently we need to prepare. But if you are preparing, then you have to follow the guidelines given in Accounting Standard 25. Interim period is a financial reporting period shorter than a full financial year. Interim financial report means financial report containing either a complete set of financial statement or a set of condensed financial statement for an interim period. So standard talks about two things. First option what they give is, if you want, prepare complete set of financial statement. Now please understand, for companies, larger companies and all, to prepare complete set of financial statement, what happens is, if you're preparing complete set of financial statement, you need to do a lot of adjustments, closing entries, valuation of inventories, depreciation, so many workings and all has to be done. You have to review the work also. So that itself will take 1.5 months. So if you have to prepare a full-fledged financial statement, it will take a longer period of time. You have to get it audited and all of that. So instead of preparing a complete set of financial statement, they say you can prepare a condensed financial statement, set of condensed financial statement. Condensed means what? You can take, for example, the main headings and subheadings of the balance sheet and show it only to that extent. Okay, that is what is allowed. No need to show the breakup of inside, let's say the detailed breakup of each of the line items. You can give it at the heading and subheading level. Sir, I want to prepare complete set. Does the standard prohibit? The standard does not prohibit. The standard says if you want full set, prepare full set. But if you don't want full set, you at least have to prepare condensed financial statement. If you are preparing a complete set of financial statement, it will include balance sheet, statement of P&L, cash flow statement, and notes, including notes related to accounting policies and explanatory material. Everything is what is included, and it has to be in the format that you prepare the annual financial statement if you are preparing a full set. Whereas a preparation of interim financial report, which is condensed, should have minimum set of condensed financial statement, which talks about new activities, events, and circumstances. And when you prepare the condensed financial statement, you should include at a minimum each of the headings and subheadings that I was mentioning earlier. You have to cover each of the headings and subheadings that were included in its most recent financial statement and the selected explanatory notes as required by the standard. If you are preparing full-fledged financial statements, then give full explanatory notes, give full notes to accounts, give full accounting policy disclosures, everything in full. But if you are preparing condensed set of financial statement, then only selected explanatory notes as required by the standard is more than sufficient. You should include additional items or notes which if omitted would make the condensed interim financial statement misleading. What does this mean? Again, I'm coming back. If it is full set of financial statement, prepare full financial statement, balance sheet, P&L, cash flow, notes, accounting policies, everything. Sir, I don't want full. Okay, prepare condensed. Condensed means take heading and subheading. That's enough. Heading and subheading. You can give more information if you want, but minimum headings and subheadings should be given. Headings and subheadings should be given. That is the first thing. Then you should not omit something which will make the financial statement or interim financial report misleading. That is another aspect. So two choices are there to prepare the interim financial statement. The recognition and measurement principles set out in this standard apply to complete financial statements for an interim period, and such statements should include all disclosures required by the standard as well as those required by accounting standard. Now, what does this mean? I am preparing a full set of financial statement. Okay. Follow all the standards.
Follow AS25 also. Follow AS25 also. Give disclosures of AS25 also in addition to other standards disclosure. See, if I am preparing a full financial year financial statement, AS25 is not applicable. So I don't need to give disclosures as per AS25. But if I'm preparing Q1, I'm giving complete set of financial statement. Give all the disclosures that you give here, plus give accounting standard 25 related disclosures also. Follow the principles given in accounting standard 25 as well. Right? Selected explanatory notes, what we discussed in case of condensed financial statement. An enterprise should include the following information as minimum. Minimum, these should be given. No need to remember this. I would suggest you to read it at least once or twice so that you get the essence of important explanatory notes. To its interim financial statement, if material and if not disclosed elsewhere in the interim financial report. So it has to be material, and if it is already disclosed somewhere else, no need to duplicate the disclosures. First, a statement that the same accounting policies are followed in the interim financial statement as those followed in the most recent annual financial statement, or if these policies have changed, a description of the change. So first declaration is we have followed the accounting policies that was used in the recent annual financial statement. Can we change? Yes, you can change the accounting policies as per AS5. If you want, you can change it. If you have changed it, then you have to make that necessary disclosure. Explanatory comments about seasonality of the interim operations. Now, what happens is if you're preparing quarterly financial statement, sometimes there can be seasonal business. Seasonal business, for example, let us say ice cream. Ice cream may be doing really great in Q1 and maybe some part of Q4 because of the summer season. Q3 it may not be great. Okay, or let us say umbrella sales. It may be very high during Q2 monsoon season. So if at all there is seasonality, make a separate disclosure. First disclosure, same accounting policy. Second disclosure, seasonality. Third, nature and amount of items affecting assets, liabilities, equity, net income, or cash flows that is unusual because of the nature or size or incidence as per S5. Basically, any exceptional, extraordinary items that are there, disclose separately. Nature and amount of changes in estimates of amounts reported in prior interim period. If there are any changes in estimates, report that. Now, one more thing that you need to understand is when we are preparing interim financial report, we consider the interim financial report as if it is the full financial year. That is how we do the preparation of the financial statement. If there are any issuances, buybacks, repayments, and restructuring of debt, equity, and potential equity shares, debt issued, equity issued, potential equity shares, ESOPs and all issued, we should mention that. Dividend, aggregate or on a per share basis in absolute or percentage terms, separately for equity shares and other shares. So what is the dividend that you have to disclose? So if at all you get a 5-mark question, explanatory notes. First is same accounting policies have been followed. Same accounting policies have been followed. Changes have happened, if at all, it is required by the other standard. That's the first thing. Then, if there is any seasonality in the business, that has to be disclosed. Then, changes in estimates have to be disclosed. Then, unusual items of assets, liabilities have to be disclosed. So, basically, what is happening? We are disclosing here as per AS5, right? Then, if there are any issuance of shares, buyback of shares, disclose that. Dividends, disclose that. Segment revenue, segment capital employed, segment assets minus segment liabilities, and segment result. For business segment or geographical segments, whichever is the enterprise primary basis of segment reporting as per accounting standard 17. So segment reporting also should be given. Then the effect of changes in the composition of the enterprise during the interim period, amalgamation, acquisition, disposal of subsidiaries, etc. So if there is amalgamation, merger, disposal, all of that you have to disclose. And any material changes in contingent liabilities since the last annual balance sheet date. Remember at least 5 of these. And this has to be minimum. Can we disclose more? Yes, you can disclose more. There is no harm in disclosing more, but minimum these amounts have to be disclosed. Okay. The information is disclosed on a year-to-date basis, means not only for the quarter, on a year-to-date basis. This is about explanatory notes. So when you're preparing a condensed financial statement, you will have headings, subheadings, explanatory notes being disclosed. Okay. Now, the next important question is, for which period should we prepare interim financial statement? For Which period? See, they don't say, do you prepare for this quarter, this half, that half, and all of that. They have not mentioned that. They're saying minimum period for which the financial statement should be prepared, whether it is condensed or complete. Whether it is condensed or complete, you will prepare for this particular period. First, when it comes to balance sheet, end of the current interim period. Basically, let us say if you are preparing for Q2, Q2 is July to September of, let us say, 25. So balance sheet as on 30th of September of 25 has to be presented. Okay, then end of the immediately preceding financial year. So 30th, 31st of March of 25 has to be presented. Okay, so balance sheet as on date as at the immediately preceding financial year, right? Then statement of P&L. Statement of P&L is for the current interim period. So if I'm doing for Q2, it will be for Q2, and cumulatively for year to date, it will be till from 1st of April till 30th of September. So balance sheet end of the period and end of the preceding financial year, immediately preceding financial year, P&L current interim period and year to date basis, plus comparable interim period and year to date of the immediately preceding financial year. So Q2 of 24 and 1st of April of 24 till 30th of September of 24. P&L will be cumulative. Cash flow cumulatively for current year to date, comparable year to date of the immediately preceding financial year. So for easy understanding, just think of it that only in case of P&L you have two items. You have two items: current period, cumulative year to date. Current period, year to date. Balance sheet, it is only year to date. Cash flow, year to date. Here it is current and year to date. Okay, see, balance sheet technically is not year to date, but when you remember it as year to date, you know it is as at the end of the interim period. Comparative previous period for balance sheet, end of the previous financial year. For P&L, year to date, comparable interim period means immediate to preceding period, and year to date, here also comparably year to date. So here you have as on YTD plus the quarter that you are reporting. If it is for 6 months, same logic applies. Remember this for exam. Any question in this particular table? Then comes materiality. Okay. Now materiality is very important. Okay. So whenever we prepare financial statement, materiality is one of the threshold. Now one very important thing is materiality should be assessed in relation to the interim period financial data. So if I am to decide materiality, don't decide materiality for interim period based on the annual financial statements. See, my annual turnover may be 100 crores, but my quarterly turnover is only 20 crores for this quarter. My materiality has to be linked to 20 crores of revenue, not 100 crores of revenue. Now, since your corporation is dealing in seasonal products, sales pattern of the product quarter-wise are given below. So one more thing, when we do this question, I'll give you one more context on how to, answer the questions in the examination. First quarter, 30th of June, 10%, 10%, 60%, 20%. This is the higher number. Information regarding first quarter ended on 30th June is as follows. This is as on 30th of June for the first quarter. Sales 80 crores, salary 60 crores, advertisement 4 crores, advertisement and selling, administrative and selling expenses 8 crores. While preparing interim financial report for the first quarter, Sincere Corporation wants to defer 10 crores of expenditure to the third quarter on the argument that the third quarter is having more sales, therefore the third quarter should be debited by more expenditure. Now, one thing you have to keep in mind is for any expense, whether to defer or not, to answer that question, you should ask, will I defer at year end? Meaning to say, will I defer advertisement expenses at the year end? I will not. So even quarterly advertisement expenses should not be deferred. Quarterly advertisement expenses should also not be deferred. Or any expense, for example, salary and other expenses. Just because I have paid higher salary, I should not defer it. If I will not defer at the year end, I should not defer it at the quarter end. But let us say there is insurance. Insurance I have paid for 12 months. Now for insurance, current period expense is only 3 months. Balance is prepaid expense. Will I record a prepaid expense for insurance at the end of the period? Yes. So for quarter also, I will record prepaid expenses. Is this logic clear, everyone? Is this logic clear? Okay. If I will not defer at year end, I should not defer it in the quarter period. So, okay. Considering the seasonal nature of business and the expenditure are uniform throughout all the quarters, calculate the result of the first quarter and give a comment on the company's view. Now, for the first quarter, sale is how much? Sales of the first quarter is 80 crores. So you will take 80 crores as it is. Then expenses. What are the expenses? Salary and other expenses 60 crores. You will take 60 crores. Advertisement expenses 4 crores. And administrative and selling expenses 8 crores. 4 plus 8, 12 crores. We cannot defer these expenses just because there is seasonality involved. Okay. So we will recognize income and expenses as and when we earn the income or we incur the expenditure. We will not defer the income or we will not defer the expenditure. All right. Then we have one treatment for tax calculation. For this, we need the average annual tax rate. Whenever you get a question on taxation, tax rate, first you calculate tax for the full period and use the average rate. Okay. Now, if it is falling in 2 different financial years, then we will calculate for the respective financial year as per applicable taxation. The accounting year of X Limited ends on 30th September and it makes its report quarterly. However, for the purpose of tax, year ends on 31st March. Okay. Taxation is April to March. Accounting is October to September. For the accounting year, 1st of October to 30th September, quarterly income is 200, 200, 200, 200. Now, please understand, this is quarter, but this has 2 tax years. This falls in the previous tax year, this falls in the next tax year. If it is falling in 2 different tax year, here will be a separate rate, here you will take a separate rate. Average actual tax rate for financial year ending 31st March is 20%. So here you will apply 20%. And for the financial year ending 31st March of year 2 is 30%. Here you will apply 30%. Calculate tax expense for each quarter. So for the first 2 quarters, you will take 20%. And for the next 2 quarters, 30%. Sir, why did we not calculate average annual tax rate? Average tax rate is for full tax year. It will be calculated for the full tax year. Now, sometimes what happens is you may have Q1, Q2, same year, Q3, Q4. Tax and finances are same. Tax and financial statements, financial year are same. Q1, loss of 100. Q2, profit or let us say loss of another 100. Q3, gain of 300. Q4, gain of 100. Tax rate applicable is 30%. Tax rate, average tax rate is 30%. So what we will do in the first year, the first quarter, 100 of loss into 30%, you will calculate 30 of tax benefit. Here also 30 of tax benefit. Here 100 of tax expense, not 100, 30, 90 of this. And here 30 of tax expense. Like that you will calculate. Okay. So even on loss, think of it as if you are creating some kind of deferred tax set. Any question on tax rates? Sometimes what happens is you may have, for example, capital gain is taxed at 20%. Normal is taxed at 30%. Okay. And capital gain is 100. Normal is 200. So for capital gain, you will calculate separately. For normal, you will calculate separately. Then sometimes what happens is up to 1 lakh, for example, tax rate is 20%. Then 1 lakh to 2 lakh, maybe tax rate is 25%. And 2 lakh plus tax rate is 30%. So this is for individuals. No, see, some entities may be individual also. They may be sole proprietorship also, where accounting standard become applicable if they cross a specific threshold. Okay. But for this, what you will do, you will calculate total tax. You will divide that by total income, and you will get something called as average tax rate, and that is what will be presented in the financial statements. Coming to disclosure in annual financial statements. So as per AS5, we have to disclose the nature and the amount of change in an accounting estimate which has a material effect in the current period or which is expected to have a material effect in the subsequent period. Similarly, if an estimate of an amount reported in an interim period is changed significantly during the final interim period of the financial year, but a separate financial report is not prepared and presented for that final interim period, the nature and amount of that change in estimate should be disclosed in a note to annual financial statement. Now, this is a slightly long paragraph. What you need to understand is you may prepare Q1, Q2, Q3 financial statement, but for Q4, you are not preparing a separate interim financial statement. You are preparing a full year financial statement. Now, there was some estimate made in Q2. There was a change in estimate in Q3, for example. Now, this change of estimate in Q3, or let us say change in the estimate in Q4, if it has a material impact in the subsequent period, you have to disclose. But here, because you are preparing full year financial statement, all of these are changes in estimate in the same year. So there will be no separate disclosure. So just for further clarity, I made some estimate in Q2. In Q3, say there is no change. In Q4, there is a material change. If there is a material change in Q4, what the standard says is, if you are not preparing a separate Q4 interim financial statement, then in the annual financial statement, itself, make the disclosures as per the interim financial statement. Because for annual financial statement, these are in the same period, there is no change in estimate. But because Q4 would have had an impact, make the disclosures accordingly. As far as accounting policy is concerned, same accounting policies are used as the annual financial statement. Okay. Now, what if accounting policy changes happen? If there is an accounting policy changes that is happening, you have to make the disclosures accordingly. If revenue is to be received seasonally or occasionally, it should not be deferred. If cost is incurred unevenly during the financial year, it should be, if costs are incurred unevenly during the financial year, it should be anticipated or deferred for interim purpose only if it is appropriate to anticipate or defer that type of cost at the end of the financial year. So prepaid expenses at the end of the financial year, I will defer it. So in interim financial statement also, you can defer it. Okay. And if I have to make a provision, if you are making it at the end of the financial year, same thing you can do for the end of the interim period. So then restatement of previously reported interim periods. Restatement means I have already reported a financial interim financial report. I have already prepared that. Now can I subsequently restate it? Okay. Now when it happens that there is some accounting policy change. Now if it is an accounting policy change, right, in the middle of the year, so let us say Q1 is already completed, you are in Q2. In Q2 there is an accounting policy change. Now whenever there is an accounting policy change in a particular financial year, you will apply it from the beginning of the financial year. You'll apply it from the beginning of the financial year. So if you have an interim financial report prepared and there is an accounting policy change, previous number also should be restated so as to ensure consistency, right? So these are the few things you have to remember. Now let us see some examples. See, in this case, you will get most of the time theory question with judgment requirement. Whether the enterprise can defer, whether the enterprise should recognize, all of those things will be asked in these type of questions. And in these type of questions. And your answer for each point, you'll have a separate mark. So try to answer all the questions. Accountants of Poonima Limited showed a net profit of 7,20,000 for the third quarter after incorporating the following. Means these have already been incorporated. First, bad debts of 40,000 incurred during the quarter. 50% of the bad debts have been deferred to the next quarter. Now, what is the bad debt? Bad debt has been incurred in the current quarter. Bad debt has been incurred in the current quarter. Can we defer? Can we defer this particular bad debt to the next quarter? Entire 40,000 belongs to current quarter. So I cannot defer. So what will I do? From the 7,20,000, I have already deducted 20,000. Balance 20,000 also I should deduct because I cannot defer bad debt. At the end of the year, you do not say that I will defer bad debt. Do we say that? We do not say that. So that should not be considered. Extraordinary loss of 35,000 incurred during the quarter has been fully recognized in this quarter. Now here, there is a loss. The loss has been fully recognized in the quarter. Is it right or wrong? It is absolutely fine. You can recognize the loss in the same quarter, no problem. Then additional depreciation of 45,000 resulting from the change in the method of charge of depreciation, assuming that 45,000 is the charge for the third quarter only. So what happened? You have charged additional depreciation of 45,000 resulting from change in the method of charge of depreciation, assuming that 45,000 is the charge for the third quarter only. So based on the revised depreciation, quarterly charge for the third year is 45,000. Quarterly charge for the third year is 45,000. Is it correct? Yes, it is absolutely correct. So no adjustment required. So 7,20,000 minus 20,000 of bad debt, you should report a profit of 7 lakhs. This we already discussed earlier. Same thing. Adjustment 3, depreciation. Additional depreciation of 45,000 resulting from the change in the method of charge of depreciation, assuming that 45,000 is the charge for the third quarter only. So they have changed the method of depreciation, because of which there is an additional depreciation charge, and that additional depreciation charge relates to the third quarter only. That is what the statement says. If it relates to the third quarter only, you will give the impact in the third quarter. So it is correctly done. Clear? Now, let's look at this one. On 30th of June, Ashmita Limited has incurred 2 lakhs net loss from disposal of a business segment. Now, this has happened in which period? 30th of June. So this has to be reported in the interim financial statement of 30th June only. Also on 31st July, the company paid 60,000 for the property tax assessed for the calendar year, year 1. Now this 60,000 is for the full calendar year. 60,000 is for the full calendar year. How the above transaction should be included in the net income of Asmita for 6 months interim period ended 30th of September. So this 2 lakhs will come in the same period. Then on 31st of July, they paid 60,000 for full calendar year. Now we are looking at 6 months interim period, means April year 1 to September year 1, 6 months. So 6 months means if I paid 60,000 for 6 months, it is how much? It is 30,000 only. So the property tax should be expensed only to the extent of 30,000. The balance being prepaid expenditure, and for the first 3 months, it is for the previous period. So since the property tax relates to the entire calendar year, 30,000 will be reported as an expense for the 6 months ended 30th September. Out of remaining 30, 15,000 is for Jan to March, should be shown as payment of outstanding, and another 15,000 is for the prepaid number. Then 2 lakhs as loss on disposal of its business segment should be disclosed in the same quarter. Then this one, the next one, this is important. An enterprise reports quarterly estimates of annual income of 10 lakhs. Assume tax rates on first 5 lakh is 30%, balance income is 40%, and estimated quarterly income are 75, 250, 375, 3 lakhs. So 75 plus 253, 75 plus 250 is not 3, 325, 325 plus 375 is 7 plus 310. This is the breakup. On first 5 lakhs, it is 30% and balance is 40%. So what we will do is, we'll calculate on first 5 lakhs 30%. First 5 lakh 30%, 1,50,000. Remaining 5 lakhs 40%, 2 lakhs. So total tax expense is 35 lakhs. This 35 lakhs on a total income of 10 lakhs, average rate works out to 35%. So in Q1, if you have earned 75,000, apply 35%. Don't do 75,000 into 30%, then 250 into 30%, then 375, you will split. 2 lakhs pay 30% and balance 1.75, you will charge 40%. This should not be done. You should calculate the average tax rate, and as per the average tax rate, you should do the computation. Then this one,
Antarbatti Limited reported a profit before tax of 4 lakhs for the third quarter ended 30th September. On inquiry, you observe the following: give the treatment required under AS 25. So these kind of questions, a lot of time, these kind of questions is what you can expect in the examination. Okay, so for each one, you should explain what should be the treatment and how you should account for it. Dividend income of 4 lakhs received during the quarter has been recognized to the extent of 1 lakh only. Now tell me one thing: if you have received the dividend, that dividend is for what period? Dividend is for the full period, or for the entire financial year or whatever it is. But when do we recognize dividend? We recognize dividend. We recognize dividend when do we recognize dividend? When there is a right to receive which has been established. So if right to receive has been established in this quarter, entire 4 lakhs has to be recognized in the same quarter. You cannot defer it. Okay, so first one, you cannot defer it. 80% of sales promotion expense of 15 lakhs incurred in the third quarter has been deferred to the fourth quarter. This we know should not be allowed. This you can just blindly remember. Then in the third quarter, the company changed depreciation method from WDV to SLM, which resulted in excess depreciation of 12 lakhs. The entire amount has been debited to the third quarter, though the share of the third quarter is only 3 lakhs. Now tell me, what should be the treatment for this? Now, one thing that you have to understand is, what do we do with respect to depreciation? Depreciation, is it a retrospective adjustment or prospective adjustment? Depreciation is retrospective or prospective? Depreciation is always prospective. Okay, depreciation is always prospective. Now, if it is prospective, in the quarter when the change happened, in the quarter in which the change happened, then the entire 12 lakhs of depreciation has to be debited to third quarter, because in that quarter there is the change. In that quarter there is a change, and everything has to be debited to the same year of change itself. It is like, if it is change in depreciation in a financial year, okay, you will not defer it to the next financial year. Same way, depreciation change of 12 lakhs has to be debited in the same period. You should not defer it to the next financial period. Okay, see, we are not talking about the annual depreciation. This is about change. This is about change in the depreciation method. Because it's a change in accounting estimate. Are we clear? And it has happened in the third quarter. It is not that it has happened in the first quarter. All right. Then 2 lakhs of extraordinary gain received in third quarter was allocated to third and fourth. That is not allowed. It has to be in the same quarter itself. So 1 lakh here you will add back. Cumulative loss resulting from change in method of inventory valuation was recognized in the third quarter of 3 lakhs. Out of this, 1 lakh relates to previous quarters. Now, please understand, here it is accounting policy. Change in the method of valuation of inventory is accounting policy change. This you will restate from beginning of the period. Depreciation is change in estimate, prospective. Accounting policy, retrospective. So out of 3, 1 lakh relates to previous quarter. So that 1 lakh which is relating to previous quarter should be adjusted in the previous quarter. Sale of investment in the first quarter resulted in a gain of 20 lakhs. The company had apportioned this equally to the 4 quarters. Now this cannot be done. It has to be the gain, whatever sale of investment in the first quarter, 20 lakhs, it has apportioned equally to the 4 quarters. So they have apportioned 5 lakhs to the current quarter. That is not allowed. This has to be adjusted in the first quarter only. This has to be adjusted in the first quarter only. So accordingly, you will do plus and minus. Important question from examination point of view. Any doubt here? So the thing you have to remember is, if it is a policy change, do a retrospective adjustment. If it is a change in accounting estimate, do a prospective adjustment. Okay, so now we'll move to the next standard. A pretty simple standard, to be frank. Okay, but I've seen students not being able to answer the questions from this standard, or not being able to write down the keywords. Okay, very simple standard. If a question comes, it should be like, okay, 5 out of 5 marks is in my pocket, or 4 out of 4 marks is in my pocket. That simple standard is this one. But please ensure, don't neglect this standard. Don't neglect the keywords of this particular standard. All right. So the next one that you're going to do is accounting standard 1. Now, as far as accounting standard 1 is concerned, accounting standard 1 talks about the first one it talks about is the fundamental accounting assumption. This all of us know. We have been learning from our foundation days, going concern, consistency, and accrual. Going concern, consistency, and accrual, or if you can't remember GCA, remember CAG. Okay, CAG. Consistency, going concern, consistency, accrual. Okay, these are the three fundamental accounting assumptions. If these three accounting assumptions are followed, we don't need any separate disclosure. But if this is not followed, disclosure is required in the financial statement. What does that mean? Say, for example, the enterprise is no longer a going concern. Means we don't expect that the enterprise will continue for the foreseeable future. Okay. If that fact is disclosed and the financial statements are prepared according to the information that going concern is no longer valid, it is prepared on something called as liquidation basis, then no need to worry because the financial statements disclose, they have already disclosed that going concern is no longer applicable. All right. So what is going concern? And here, please note down the keyword that you need to remember and write in the examination. The financial statements are prepared on the assumption that an enterprise will continue its operation. This is the first one. It will continue its operation in the foreseeable future. In the foreseeable future, that is the first part. And neither there is an intention nor there is a need. No intention, no need to materially curtail the scale of operation. So this definition you have to learn it by heart. Okay, then only you'll get marks. So assumption that it will continue its operation in the foreseeable future and has neither any intention nor there is any need to materially curtail the scale of operation. Means they will continue foreseeable future, more than 1 year you can consider that the enterprise will continue to run its operation. Financial statements are prepared on going concern basis, and when we recognize financials, when we prepare financial statements on going concern basis, what we are trying to represent is we have assets at the value for which we will get future economic benefits. That is one thing. Second important thing is we have profit to replace the assets consumed in operation and for making settling the liability. Basically, we are saying that we have money, we have sufficient pooled of resources. With that money, we can run the business, we can run the operations, and we can purchase assets in the future as well. That is the first assumption, which is the going concern assumption. The second one is consistency. Consistency means we are using the same accounting policies for similar transactions in all accounting periods. Same transaction, same accounting policy. Same transaction, same accounting policy. Or same nature of transaction, same accounting policy. Does that mean we cannot change the accounting policies? We are not saying that. We can change accounting policies if it is required by a statute or law, if it is required by an accounting standard, or for more appropriate presentation of financial statement. These 3 points you need to learn by heart. Required by statute, required by accounting standard, and if it results in better presentation of the financial statement. So first one, going concern, will continue for foreseeable future. We don't have the intention nor there is a need to materially curtail the operations. That's the first one. Consistency, we have followed same accounting policies for similar transactions on year-to-year basis. Can we change? Yes, we can change. We can change provided there are 3 conditions which are satisfied in one of these 3 cases: required by the law, required by accounting standard, or for better presentation of financial statement. Okay. Then third one is accrual basis of accounting. Now this is also required under the Companies Act, that the transactions are recognized as soon as they occur, whether or not cash or cash equivalent is actually received or paid. So basically, income is recognized when earned and expenses are recognized when incurred, irrespective of whether cash has been received or cash has been paid. Irrespective of whether cash has been received or cash has been paid, income and expenses are recognized. Okay. So this also results in matching between revenue and expenses and profit and loss. Okay, that is the first part of the standard, talking about 3 fundamental accounting assumptions. Then accounting policies. Accounting policies are specific accounting principles and method of applying those principles adopted by the enterprise in preparation and presentation of financial statement. Accounting policies are what? These are specific accounting principles and method of applying these principles adopted by the enterprise in preparation and presentation of financial statement. For example, simple case, inventory accounting policy could be you use the FIFO method, you use the weighted average method. That could be one accounting policy choice. Then if you talk about foreign exchange, there could be a accounting policy choice as to which rate will we use to measure the transaction, or whether we will capitalize. If you refer to paragraph 46A, whether we will capitalize, we have already discussed this, or whether we will expense the exchange losses. That is a part of accounting policy. Okay. How will we recognize sale transaction? That is an accounting policy. So all of these are called as accounting policies. Now, whenever we have to choose accounting policy, standard sets out that some specific principles needs to be followed. For example, prudence. Prudence means you have to be careful. When we say prudence, you have to be careful. That is, you should not anticipate income. You should not anticipate income in advance, and you should make provisions for all anticipated expenses. So, if there are uncertainty associated with future events, profits are not anticipated, but losses are provided as a matter of conservatism. This is called the concept or principle of prudence. So, accounting policy should be, adhering to the principle of prudence. Accounting policy should be adhering to the principle of prudence. You should not have accounting policies where you are, maybe accounting for some specific items which are, let us say, you are anticipating gain in advance, or if you are doing, if let us say it is the pencil went off, just allow me a minute. Okay. So first principle is prudence, which you need to remember. Prudence means we will not anticipate profits, but we will provide for all anticipated losses. So if there is a provision to be created, you will create the provision. But this does not mean you will create unnecessary provisions and expenses. That is also not allowed. Okay. Just in the name of prudence. That is the first thing. Second, substance over form. Now, the best example of substance over form is what we have understood already in accounting standard 19 when it comes to finance leases. So the accounting policy should reflect the substance of the transaction rather than the legal form of the transaction. Now, when we learned accounting standard 19, we said in case of finance leases, we will recognize an asset. Now, when you say legal form, in legal form, there is no sale. In a finance lease also, there is no sale. But in substance and the underlying essence of the transaction, what the transaction actually mean, in that case we say that okay, the substance of the transaction represents that there is a sale that has happened, so accordingly we will recognize a sale. Then materiality. Now, as far as the third principle is concerned, financial statement should disclose all material items. What are material items? Material items are those items which can impact the decision making of the stakeholders. It is not just about the size. If something is to do with, let us say, payment or transactions with related parties, then almost all the transactions become material. If it is something to do with, let us say, non-compliance of some laws and regulations, that can be material. So we should disclose the items which are material in the financial statements. So our accounting policies also should be based on similar parameters. And then lastly, all significant accounting policies should be disclosed while preparing the financial statement. Why? Because the user should know how have they prepared the financial statement, and hence it should be disclosed. All the accounting policies should be disclosed. The consideration in selection of a policy, prudence, then your substance over form. After substance over form, you will talk about materiality, and then we will talk about the manner of disclosures. Now, this is another important part of the standard, which talks about disclosure of changes in accounting policies. Accounting policy can be changed, and whenever there is a change in accounting policy, if it is material change in the current period, if the amount is determined, you will disclose the amount. If amount is not determined, you will disclose the fact that amount cannot be determined. So if there is a change in accounting policy which has a material impact in the current period, you will disclose. You will disclose the amount of change and impact of the change in accounting policy. Sir, we cannot determine the amount. Then you will disclose the fact that amount cannot be determined. Then
If there is a change which is not material in the current period, but it could be material in the later periods, or it could you'll be able to ascertain the materiality in the later periods, then you will disclose the fact of change in later period. So whatever is the change impact in the later period, you will disclose in the current period. So any accounting policy changes, the impact that it will have in the current period as well as in the future period, you will have to. Then, if there is a deviation from the fundamental accounting assumption of going concern, consistency, and accrual, if there is a deviation, means if you have not followed, then you will have to give specific disclosures. The fact that you have not followed the accounting policy, that has to be disclosed. All right. Now, in the examination, you may get question mostly related to change in accounting policy. Now, whenever you get a question related to change in accounting policy, what you should do is you should define what is the accounting policy. Then what is the disclosure requirement whenever there is a change in the accounting policy. So what we should say, if there is any change in accounting policy which has a material effect, it has to be disclosed in the financial statement. Okay, it has to be disclosed in the financial statement. The change, the impact of change also has to be disclosed. So you will disclose change and what is the impact of change in accounting policy, that has to be disclosed. So let's look at this. In the books of Prashant Limited, closing inventory amounts to 1,63,000 on basis of FIFO method. The company decides to change FIFO method to weighted average method for ascertaining the cost of inventory from year 1 to. On the basis of weighted average method, closing inventory as on 31st March amounts to 1,47,000. Realizable value inventory as on 31st March amounts to 195. Discuss the disclosure requirement of change in accounting policy as per accounting standard 1. Okay. Now here, this question has specifically asked about disclosure of change in accounting policy. Okay. They may also ask you, can they change? Because fundamental principle, consistency. Are we being consistent? No. So can we change the accounting policy? 3 reasons: statute, law, and better presentation of financial statement. That we have to write. But here it is about disclosure requirement. So what should disclose? Whenever there is a change in accounting policy, which has a material effect, should be disclosed in the financial statement. Whenever there is a material effect because of the change in accounting policy, the fact has to be disclosed. Okay, that's the first thing. Then the amount should also be disclosed to the extent ascertainable. The amount of impact, whatever impact the change will have, that should also be disclosed. If the amount is not ascertainable, then the fact should be disclosed. So the Prashant Limited should disclose the change in valuation method of inventory and its effect on financial statement. Sample disclosure. Company values its inventory at lower of cost and NRV. This is as per accounting standard 2. Since NRV of all items of inventory in the current year was greater than respective cost, the company valued the inventory at cost. In the present year, the company has changed to weighted average method, which better reflects the consumption pattern as compared to the earlier practice of FIFO. The change in policy has reduced the current profit and value of inventory by 16,000. This is the impact. How do I calculate the impact? See, closing inventory as per FIFO would have been 163. I have done it at 147. I have reduced the value of inventory. If I reduce the value of inventory, my inventory will be lower, my profit will be lower. Okay. Then Jagannath Limited had made a rights issue in 2002. In the offer document to its member, it had projected a surplus of 40 crores during the accounting year ending 31st of March of year 2. The draft result for the year prepared on hitherto means so far, followed accounting policy and presented for perusal of the board of directors showed a deficit of 10 crores. The board, in consultation with the managing director, decided the following: value year-end inventory at work cost instead of method of valuation at prime cost, 50 crores instead of 30 crores. That will increase the valuation. Provide for permanent diminution in the value of investment which had taken place over the last 5 years, the amount of provision being 10 crores. As chief accountant of the company, you are asked by the managing director to draft the notes to account for inclusion in the annual report. Now, you may say, sir, is this the right thing to do? See, you can change the method of valuation of inventory. There is no problem. Okay. The only thing that the standard requires is you're changing the inventory from 30 crores to 50 crores. That additional 20 crores should be disclosed in the financial statement. If you disclose it in the financial statement, it is the user's headache. The users will understand, yes, this has been the change. Earlier, they used to do something else. Now they are doing something else, because of which the profit has been impacted. Okay. So again, same standard answer. Any change in accounting policy which has material effect in the current period or expected to have material effect in the later period should be disclosed. If it has material effect in the current period, amount by which any item in the financial statement is affected by such change should also be disclosed. So that is a broad answer. Amount not ascertainable, even if you don't write, it is okay. Notes. During their inventory has been valued at factory cost against the practice of valuing it at prime cost, as was the practice till last year. This has been done to take cognizance of the more capital intensive method of production on account of heavy capital expenditure during the year. Sir, where will we get this information from? Even if you don't write this information, it is okay, right? As a result of this change, the year-end inventory has been valued at 50 crores and the profit for the year has increased by 20 crores. Now, the second one is not a change in accounting policy. It is an estimate that we are making. So that has to be separately disclosed, saying that we have provided for 10 crores as permanent diminution. This is an item of exceptional feature. That is why we have disclosed it separately. Clear? Right. Now, sir, how do we remember? No need to remember everything. Just write the principles and give your conclusion. XYZ company is engaged in the business of financial services. It is undergoing tight liquidity position since most of the assets are blocked in various claims petition in a court. They have accepted intercorporate deposits and making best effort to settle the dues. There were claims at varied rate of interest from lenders from the due date of ICDs to the date of repayment. So what has happened? There is an issue date. There is a maturity date or a due date. On the due date, you have not yet paid. So the lenders are asking that till the date of payment, you have to pay us interest. The company has provided interest as per the terms of contract till the due date, and a note for non-provision of interest on the due date to date of repayment was affected in the financial statement. On account of uncertainties existing regarding the determination of the amount and in the absence of any specific legal obligation, the company considered that these claims are in the nature of claims against company not acknowledged as debt, and the same has been disclosed by way of notes to accounts instead of making a provision. Now here, please understand, even if the contract doesn't have any requirement, after the maturity is done, you have to repay the loan. If the loan is not repaid, the interest will continue. The interest will continue. Okay, so what you need to understand is, if interest will continue even after the due date, because the lenders will not leave you. Okay, you cannot say that as per the terms of contract, there is no interest after the due date. Then, as per the terms of contract, you are also required to pay the loan by the due date. If you have not paid the loan by the due date, the other party will definitely ask interest. So whatever is the amount which is on the overdue interest, that also needs to be provided for as a matter of, you can say, prudence and also accrual concept. Okay, you can draft the answer accordingly. Slightly complicated way that they have written there, but the essence should be captured in the examination. ABC was making provision for non-moving inventories based on issues for the last 12 months up to December 31st March of year one. Company wants to provide during the year ended 31st March year two based on technical evaluation. Now, so far you are doing based on what? Slow moving, non-moving. Non-moving means inventories which is not being sold. That is what is called non-moving inventory. We were making provision based on non-moving inventory. Okay. Now, we want to change the method of making that provision to technical evaluation. Technical evaluation. Now, is it a change in accounting policy? Please understand. We were earlier also providing, now also we are providing. Just that measurement has changed. Just that measurement has changed. So when the measurement has changed, it is not considered to be a change in accounting policy. It is more about change in accounting estimate. So whenever there is a change in accounting estimate, which is material, if at all it is material, it has to be disclosed separately. It has to be disclosed separately. This is also an important question from examination point of view. Okay. So AS1, though we, a lot of time it happens that, we consider it to be a simple accounting standard. As I told you, we miss out. Now with this, we have completed almost all the standards. I think we are left with accounting standard 24. Accounting standard 24 is one that we are left with. Then, yes, I think we are left with only accounting standard 24. Then buyback of securities, that is what is left. And the introductory part, which we'll try to cover it as quickly as possible. Okay. So tomorrow we'll cover, AS24 and the introductory part. Then we'll complete buyback of securities on 2nd. Okay. And on second as well as on third, we'll discuss how to handle case studies and MCQs in the examination. All right. I have been preparing solely from our study material. Is it sufficient? Yes, it is sufficient. Just do one thing. Practice some questions from the compiler that we already have provided. Okay, that will be more than sufficient. So Vijay, when is your attempt?
Sir, Jan.
When is your attempt, Vijay?
Sir, Jan, sir.
Yeah. So what you do is we have provided compiler also. It is there in the resources section. Take some questions from compiler past papers and solve them. That will help you to handle the questions in the examination. Not to worry. Okay.
Sure.
Yeah. Okay. Thank you. Thank you, everyone.
We'll start with Accounting Standard 24. Now, as far as this particular standard is concerned, again, it is a disclosure-based standard. This does not tell us largely as to what to compute, how to. They say what to compute, but largely it is based on disclosure. Okay. Now, what is the disclosure about? Disclosure is about something called as discontinuing operation. Now, what is this discontinuing operation? Discontinuing operation, basically what it means is, if an enterprise, for example, has operations in, let us say, multiple different type of products. Okay, so let's say I take the case of ITC. ITC has cigarette business, they have hotel division, they have paper business, they have FMCG. All right, now they have multiple divisions in which they are operating. Now when we say discontinuing operation, if ITC decides, for example, let us say hotel business they are shutting off, or cigarette business they are selling it off to somebody. Now, cigarette contributes one of the highest profit margins as far as the industry business is concerned. If I'm disposing of this particular cigarette division, then I have to inform my shareholders, I have to inform my investors that, see, I am selling off this particular division. This is one of the most important divisions of my business, but I am selling it off, right? So that part, whenever an enterprise decides to discontinue an operation, now discontinue could mean I will sell to somebody else. For example, Citibank sold its banking operations to Axis. Okay, that could be one scenario. Or I may gradually sell off the assets of an operation such that the operation ceases to exist. Or what can I do is I can actually abandon it. Abandon means do nothing, just leave it as it is and exit from that particular place. So multiple outcomes are possible, which is called as discontinuing operation. Now in this standard, the things that you have to understand or remember is, number one, what is a discontinuing operation? You need to learn the definition. Then which is the initial disclosure event? Then what happens subsequently when we present the financial statements, and what do we present in the financial statements as far as the discontinuing operation is concerned. Discontinuing operation is a component of an enterprise. Now this component could be a branch, it could be a division, it could be a subsidiary. It is a component of an enterprise. It is a component of an enterprise that the enterprise pursuant to single plan. So first thing, enterprise has a plan. Enterprise has a plan to do one of these three things. It is a component for which the enterprise has a plan to do one of these three things. What are one of those three things? First, disposing of substantially in its entirety. Means disposing means what? Sale. Disposing of, or selling it off, or transferring it off substantially in its entirety. Means if I talk about, let us say, ITC selling the paper division or cigarette division, 90% of the business is transferred. Substantial in its entirety, I am disposing of. That is the first thing. So when I dispose of, I can sell it, I can transfer it, I can get into a demerger, I can do multiple things. That is the first. So first condition talks about disposing it entirely. Second, disposing of piecemeal. Now what is the meaning of disposing of piecemeal? I want to sell the paper division. I am not selling the business as it is. What I'm doing, I'm selling fixed assets separately to some entity. Inventory, I sold it off to somebody differently. Liabilities, I'm settling separately. So here it is happening on a piecemeal basis. One by one, the parts of the business, I am selling it off. When I say sale in entirety, I am transferring the full paper business. I'm transferring the entire business along with the assets and liability. But when I'm disposing of piecemeal, I'm doing one by one. I'll sell some asset,
I'll settle some liability, then I'll sell off inventory, I'll realize money from the debtor, I'll pay off the loan, something like that. Okay. And last one is terminating through abandonment. So the last one is terminating through abandonment. Terminating through abandonment means I have just left it. You would see a lot of factories and all, they don't sell it off. They just leave it as it is. Okay. Why do they leave it as it is? Because by selling the factory, they are not able to realize sufficient money, or there is some legal issue, they are not able to sell it off. So they'll just leave it as it is. That is called terminating through abandonment. So first part what we have learned is it is a component of the enterprise, and the enterprise has a plan either to sell it off in its entirety, or selling off piecemeal, disposing of piecemeal, or terminating through abandonment. Terminating through abandonment. That is the first thing. Now here, please understand, it has to be a part of a single plan. It has to be a part of a single plan, means it is single plan. It is not that today I have a plan to sell off machinery, tomorrow I have a plan to sell computer, then some other day I go and plan to sell off furniture. That is not a single plan. It has to be a part of a single plan, right? So that is the first thing, first part of the definition. Second is that represents a separate major line of business or geographical area of operations. Now this we have seen in A17 also. It is a major line, separate major line of either business or geographical area of operation. Geographical area could be, for example, for Citibank exiting Indian operations. That is the third one. Second one, then, which can be distinguished operationally and for financial reporting purpose. So first thing is, you should be operationally be able to distinguish it. You can say, okay, this is my paper business, operationally distinguished. And also for financial reporting purpose. Generally, let's say you prepare something like segment revenue and all of that. That has to be considered. So component, single plan, major line of business, and it has to be distinguished operationally and financially. Now please understand, it has to be major line. If I'm selling off small one, I'm closing down one branch out of 100 branches. If I'm closing down 2-3 branches out of 100 branches, that is not a major line of business. Okay, so that is one thing, right? So what you need to understand is, if I am not selling off a major area or major geographical area, major business line, then it does not come into the category of discontinuing operation. Okay, so this definition, please make a note of it and try to learn it. Now here in the first example, they talk about a famous chain of restaurant decides to sell its stake in one of the restaurant. You have many restaurants, you are selling stake in one of the restaurant. Now when I'm selling stake in one of the restaurant, I may not be selling it off in entirety. Second thing is, it is only 5% of total revenue, hence it is not a major line of business. Okay. Group operates in various industries including hotel, airlines, software through its subsidiaries, decided to sell its airline business to be able to concentrate on other verticals. Now here you're selling off in a single plan, component, subsidiary is a component, and one business, airline business. So as a result, it has started to sell its aircraft and paying off the associate liabilities. During the year, it has sold off 5 aircrafts out of the fleet of 50. As a part of the sale, airline business constitutes 25%. We have 50 aircrafts. We have to sell 50 aircrafts, but we have been able to sell only 5 aircrafts. Only 5 aircrafts. But then there is a single plan. It has decided to sell its aircrafts and it has decided to sell its airline business as a part of a single plan, and 25% of the group revenue, major part of the overall business, hence can be considered to be a discontinuing operation. Now, how do we identify separate major line of business or geographical area? If it is a reportable business segment or a geographical segment as defined in A17, normally you can say that it is a major line of business. Okay. Out of the entire business segment, a small part of the segment may also be considered to be a part of your, it also could satisfy the thing of major line of business. For an enterprise that operates in a single business or geographical segment, a major product or service line may also satisfy. So if it has to be, basically what you need to understand is, it has to be a major line of business or area of operation. Now here, if you see this example, they were operating in a single state, sales of 1 lakh, 14 lakhs and 20 lakhs. Now if you see, this is not major.
It is only 1 lakh. But 14 lakhs, 20 lakhs, these are major because, out of 35 lakhs, 14 lakhs means a good, 40%, good 40% of revenue comes from here. Profitability also, if you see 1,50,000, major. So that is where if you discontinue Y and Z, it can be major, X will not be major. Then this is important again from examination point of view. Examples of activities that do not necessarily satisfy the criteria of the definition but might do so in combination with other circumstances. So this basically means these 4 items may necessarily not be a discontinuing operation. First, gradual or evolutionary phasing out of a product or a class of service. If I'm gradually discontinuing a product or a service, that may not form part of my discontinuing operation because it is gradual. It is not a part of a single plan. And generally in such situations, what happens is I'm phasing out one product line. I'm replacing that with the other product line. Okay. Discontinuing several products within an ongoing line of business. So I have, let us say, 5 products in, let's say in Indigo, if I have to tell you, let us say I have CA, CMA, ACCA, CFA, these 4 products for 4 services we are offering. We decide to shut down, let us say CMA, but we are continuing with other 3. So that needs not be a part of my discontinuing operation. Shifting of production or marketing activities for a particular line of business from one location to another. So if I have operations in Bangalore, now I want to move my operations to Delhi. Such shifting is also not a discontinuing operation because my operations are continuing. Closing of a facility to achieve productivity improvements or other cost savings. So even this need not be a discontinuing operation. Now, what you need to understand is if I'm closing of a facility, but if it is a part of a single plan to dispose of a segment, dispose of a component, then it will be discontinuing operation. Then in the previous thing, we said that we have to operationally and financially be able to distinguish the segment. When can we be able to do that? We'll be able to do that when the operating assets and liabilities can be directly attributed to it. So the discontinuing operations that we are talking about, assets and liabilities, we should be able to directly attribute. Revenue, we should be able to directly attribute, and majority of its operating expenses we should be able to attribute. So we should be able to attribute assets, liabilities, revenue, and majority of the expenses. Then we say it is distinguished for operating and financial reporting purpose. Okay, so just one last time, it is a component. In as per a single plan, we are disposing of in its entirety or piecemeal, or we are terminating through abandonment. It represents major line of business and it can be distinguished operationally and for financial reporting purpose. Now, after we have defined what is a discontinuing operation, the next important thing in this standard is initial disclosure event. Now, initial disclosure event, basically what it means is, and because this standard requires us to disclose the discontinuing operation, when we say initial disclosure event, first time, when should we disclose? First time, when should we disclose? So the standard says, gives us 2 conditions, A or B. In B, we have 1 and 2. Okay, A or B. In B, we have 1 and 2. So first, if they have entered into a binding sale agreement for substantially all of the assets attributable to the discontinuing operation. Binding sale agreement means we cannot withdraw. We cannot withdraw. We are bound by the agreement. So if we have a binding sale agreement, then we should consider it to be a part of discontinuing operation. If I have agreed with someone that I'll sell off this particular asset or sell off this particular component, then that is a discontinuing operation. So here the key term is binding sale agreement for substantially all of the assets and assets attributable to the discontinuing operation. Agreement means the other party has also agreed. We have also agreed. We have decided that we will sell off the thing. The second thing is the enterprise board of directors or the governing body has approved a detailed and a formal plan and made an announcement. So second is board of directors have approved the plan of discontinuance and the announcement also has been made. So generally what happens, the moment board of directors approve, you have to file within some specified period of time with the registrar of companies. The company has approved the plan.
the company has come out and made an announcement of the plan. So either of these two conditions being satisfied, we call it to be an initial disclosure event. Now, when we say formal plan, what should the plan include? The assets to be disposed, method of disposal, period expected to be required for completion. How long will we take to complete the disposal? Location affected. The location, function, and number of employees will be compensated for terminating their services, and the estimated proceeds or salvage value to be realized by disposal. So basically, the plan has to tell us which are the assets we are disposing, how are we disposing, when we are completing the disposal, which are the locations affected, how many employees will leave, what is the money we will realize. Correct. So this is what is a part of the plan. But most importantly, if there is a binding sale agreement, then it is initial disclosure event. Or if the board of directors has approved a plan and made an announcement of the plan, that is a disclosure event. Whom should we announce it? To lenders, stock exchanges, trade payables, trade unions, etc. So these are the parties who are affected to whom we will be announcing. Okay. Now, this standard is purely a disclosure standard. So recognition and measurement part, there is nothing from this particular standard. This talks about only presentation and disclosure. Now, as far as presentation and disclosures are concerned, I would recommend that you remember at least 5 to 6 points of the initial disclosure event, so that if at all a question comes in the examination, you will be able to write it. Okay. Now, what should be disclosed? A description of the discontinuing operation. Which operation are we discontinuing? That has to be disclosed. Then the business or geographical segment in which it is reported as per AS17. So when we are reporting under 24, we have to consider the AS17 requirement as well. So first, description. Describe the nature of the discontinuing operation. Then business or geographical segment in which it is reported. Third, date and nature of the initial disclosure event. When did this initial disclosure event occur and what is the nature? So it could be agreement, it could be announcement by the board of directors. The date or period in which the discontinuance is expected to be completed, if known or determinable. By when are we planning to complete? So what is the discontinuance? Which business and geographical segment? What is the date of initial disclosure event? By which date are we going to complete? Then the carrying amount as of the balance sheet date of the total assets to be disposed of and the total liabilities to be settled. What is the asset and liability breakup of the discontinuing operation? Then the amounts of revenue and expenses in respect of the ordinary activities attributable to the discontinuing operation during the current financial reporting period. This is very important. What this basically says is, what is the revenue and expenses attributable to the discontinuing operation only from ordinary activities during the current financial period. Okay, that's the first thing. Then, so here you talk about revenue and expenses. Here you talk about asset and liabilities. Then the amount of pre-tax profit or loss from ordinary activities attributable to the discontinuing operation during the current financial reporting period and income tax related expense. So here we are talking about profit before tax and the tax component. Profit before tax and the tax component. Then here we are talking about cash flow attributable to the different activities of the discontinuing operation during the current financial reporting period. So what all did we disclose? Description, the business and geographical segment, the date and nature of the initial disclosure event, the date in which the discontinuance, the date by which the discontinuance is expected to be completed, the amount of assets and liabilities in the balance sheet, then the amount of revenue and expenses, pre-tax profit and tax expense, and the next net cash flow. This has to be disclosed, right? Now, as far as the P&L items are concerned, they can be disclosed on the face of the balance sheet as a single line item, and subsequent disclosures can be given in notes. All the disclosures should be presented in the notes to financial statements except for the amount pertaining to pre-tax profit or loss of the discontinuing operation and the income tax expense, which should be shown in the face of the statement of P&L. So in the P&L, you can show, okay, this is the profit or loss from discontinuing operation, and this is the profit, this is the tax expense, and this is the profit after tax. This, when we did schedule 3, there also you can see in the format which is given. Okay, right? Then this is the first initial disclosure event where we said what is the discontinuance, what is the nature, what is the date, by when will we complete, what is the amount of asset and liability, revenue and expenses, pre-tax profit and tax, and cash, net cash flow.
Now, when the enterprise disposes of assets or settles liabilities attributable to a discontinuing operation or enters into binding agreement for the sale of such assets or settlement of liability, it should include in its financial statement the following information when the events occur. Now, what is the meaning of this? This basically means that after the initial disclosure event, whenever we are, selling off an asset, settling a liability, entering into an agreement to sell off asset or to settle the liability, as and when the subsequent event occurs, then you have to disclose the following. What are the disclosures? Any gain or loss that is recognized on the disposal of asset or settlement of liabilities attributable to the discontinuing operation. So, what is the gain or loss? Amount of the pre-tax gain and income tax expense related to the gain or loss. So, if I am selling off, for example, there is a PPE. This PPE is a part of discontinuing operation. PPE is a part of discontinuing operation. We have sold this PPE as at a gain of, let us say, 10,000. This gain has to be disclosed on a pre-tax basis. Then tax expense, let us say 3,000. This has to be disclosed separately. Same way, if there is a loss, whenever an asset is being sold or a liability is being settled, report the gain or loss and the income tax implication. Okay, so now that this is for what? This is for sale or settlement. Then the net selling price or range of prices of those net assets for which the enterprise has entered into one or more binding sale agreement, what is the timing of receipt and the carrying amount of those assets in the balance sheet. So here, if you have sold the asset or settled the liability, then the gain and tax expense. If you have entered into an agreement, here it is just an agreement. When we have entered into an agreement, we'll not recognize gain or loss, correct? So what we have to show, we have to tell them what is the net selling price or range of prices, means how much are we going to get from that, and when will we receive the money, and what is the carrying amount of those assets in the balance sheet. The idea is the user should know that whether there will be a gain or loss when they have completed that particular transaction. All right. So what have we discussed so far? We discussed what is a discontinuing operation, which is a component is as a part of single plan either disposed of in entirety or piecemeal or termination through abandonment, which represents a major line of business or geographical area of operation. That is the part. Then we talked about initial disclosure event, where either the company has entered into a binding sale agreement or the board of directors have approved a detailed formal plan and the announcement has been made. Announcement to whom? The lenders, the bankers, the creditors, the payables, all of those things, right? Then we talked about disclosures at initial disclosure event, description, the timing by which we will complete, right? Then timing by which when we will complete, then what are the assets and liabilities, income and expenses, the profit attributable to the discontinuing operation, before tax, after tax, and cash flow, right? Then subsequently, whenever we sell the asset, disclose the gain or loss and income tax expense, or when we enter into a binding sale agreement, disclose the range of selling prices and when we will receive those cash flows. Any questions so far? Next thing is, when should we update the disclosure? See, initially we gave some disclosure. We said we'll realize the money by so much period of time. We will, finish up the discontinuance by this point of time. Then, if subsequently, if there is anything or any event which occurs, you have to describe any significant changes in the amount or timing of cash flows relating to the assets to be disposed or liabilities to be settled and even causing those changes. So for subsequent period, whenever there are significant changes in amount or timing of the cash flows, earlier we thought we'll finish everything by, let us say, 31st March of 25. Now we believe we'll be able to complete only by 31st of March of 26. There is a change, so that has to be updated. The disclosure should continue in the financial statements for the period up to and including the period in which the discontinuance is completed. So till the time you complete, keep on disclosing. Then, once the plan is substantially completed or abandoned, either you have completed sale or you have abandoned the component, then you can stop the disclosures. Okay, but whether you receive a cash or not is not relevant. All right. If an enterprise abandons or withdraws from the plan that was previously reported as a discontinuing operation, the fact, the reasons, and the effect should be disclosed.
Any disclosure required by AS24 should be presented separately for each operation. Now, where should we disclose? The disclosure should be presented in the notes, except you show the pre-tax profit or loss from ordinary activities and the income tax expense. This has to be shown on the face of balance sheet. Amount of pre-tax gain or loss recognized on the disposal should be disclosed on the face, not on the balance sheet, sorry, disclosed on the face of P&L. So on the face of P&L, you have profit or loss from discontinuing operations. So as a separate line item before tax, and the tax expense has to be disclosed. Now, one more thing what you need to understand here is, if let us say in 2025 we are discontinuing some operation. Okay, we are discontinuing some operation. The previous year you should restate, meaning to say you should identify the profit, the loss, the assets, the liabilities of the previous year, that the comparative period, and you have to disclose it separately. Comparative information for prior periods that is presented in the financial statement after the initial disclosure event should be restated. So you have to restate, segregate the asset, liabilities, revenue, cash flows separately. As far as interim financial reports are concerned, interim financial reports means quarterly reports and all that is happening. You should disclose the required thing as per AS 25. So as and when you sell off an asset, settle a liability, the gain or loss, you should disclose in AS 25. And you should also disclose any significant activities or events since the end of the most recent annual reporting period. So after the balance sheet, if there has been any significant activities that you have to disclose, and any significant changes in the amount and timing of cash flows should also be disclosed. So interim period also you should treat it as if it is a full financial reporting period. And if there is any significant change as compared to the recently annual period which has been reported, or previous year end you can consider, then you should disclose any significant activities or any significant changes in the cash flows that has to be disclosed. AB decided to dispose its clothing division as a part of its long-term strategy. Board approved 1st of March. Formal announcement to effective parties 15th March. Date of binding sale agreement 1st of July. Reporting date 31st of March. The date of initial disclosure event will be, so formal announcement made to the effective party. Date of board. Board approved on 1st. But approval plus this has to be satisfied. So when did we communicate? On 15th of March. When did we enter into sale agreement? 1st of July. So 15th March is earlier. So it will be 15th March. Rohini Limited is in the business of manufacture of passenger cars and commercial vehicles. Passenger car and commercial vehicles. Company is working on a strategic plan to close the production of passenger cars and to produce only commercial vehicles over the coming 5 years. So gradually you want to shut down passenger cars and you want to produce only commercial vehicles. However, no specific plans have been drawn up for the sale of neither the division nor its asset. It's very important. There has to be a single plan. The question itself says there is no single plan. As a part of its prospective plan, it will reduce the production of passenger cars by 20% annually. It also plans to establish another new factory for the manufacture of commercial vehicles and transfer surplus employees in a phased manner. So a gradual phasing out is what we can see in this particular case. You are required to comment if mere gradual phasing out in itself can be considered as a discontinuing operation. Will we consider? No, because we are gradually phasing out. We have not said that. We have not formed a plan to settle it off or to dispose the operation in its entirety. You think gradually we'll remove this product, we'll add new product. So that cannot be called to be a discontinued operation. Okay, so answering this question, discontinuing operation, the definition that we have understood, we have already revised it twice, two or three times. This is important. Mere gradual phasing out is not considered as discontinuing operation under AS 24. Okay. So in this, do we need to write all of these things? That depends on the question. Here, we can say gradual or evolutionary phasing out of a product line or class of service in itself is not a discontinuing operation. Same way, shifting of production or marketing activities for a particular line of business is also not a discontinuing operation. Third is not relevant for this particular answer. Third is not relevant in this particular case. Okay. Then
If the company passes a resolution to sell some of the assets in the passenger car division and also to transfer few other assets of the passenger car division to a new factory, does this trigger? So again, here they're not talking about disposal in its entirety or disposal in piecemeal. Okay, the sufficient information is not given. Sufficient information is not given as to whether there is a definite plan that they will complete the disposal or they will transfer it, completely to another entity or something. If I'm moving from one department to another, that is not a part of my discontinued operation. I'm just shifting the product lines. Okay. Would your answer to be different if the company resolves to sell the assets of the passenger car division in a phased but time-bound manner? So if you have a time-bound sale, and if there is a formal plan, then it can be AS24 covered. The resolution is silent about the stoppage of the car segment in definite time period. Though sale of some assets and some transfer proposal were passed, a resolution to the new fact through a resolution to a new factory, but the closure roadmap and new segment starting a roadmap are missing. So closure is very important. Closure is important. In the third case, there is a phased and time-bound program resolved. So if there is a time-bound program, it may be phased, but it is a time-bound program, single plan. It's a single plan, time-bound that we will dispose of, and the plan has been approved. And if it has been communicated, that will form part of discontinuing operation. Okay. See, we don't see many questions from this standard in the examination, but I would want you to remember the definitions that we have, so far done, so that you get some clarity. See, initial disclosure event, then discontinuing operation. What is not a discontinuing operation? These 3-4 things, if you remember, you'll be able to handle. And more likely or most likely, you would be getting questions based on your, what do you call, MCQs. That is what I am expecting from this particular standard. So here you can see July 21 5 marks question. Analyze the disclosure presentation requirement of AS24 for discontinuing operations, any 5. Okay, so we have learned all of this. You have to give any 5. You have to give any 5. This we just now discussed. This was again for 5 marks in the July 21 examination. Again, initial disclosure requirements, again for 5 marks. So here, a consumer goods producer has changed the product line. Now, when you're changing product line also, it need not be a part of your discontinuing operation. Disclosure requirement in interim financial statement given in RTP. Again, disclosure requirement. Examples that do not necessarily satisfy the criteria of paragraph 3 that might do so in combination of other circumstances. These 4 things you have to represent. So it's more about learning. Okay, there is nothing great in analyzing and evaluating. It is more about learning. Okay, right? So now we'll take a 5-minute break and then we'll continue with the next part of our discussion. Now we are left with, as far as the standards are concerned, the first one, that is introduction, and then we have the framework, and then we have the applicability. These are not really great importance in the examination, but if at all a question comes, it will come for 4 or 5 marks. All right. Now the second thing that you need to do in this particular standard is the study material is slightly bulky. Okay, if you're comfortable with that, you can read through it. But as far as the examination revisions are concerned, our notes are more than sufficient for you to capture the essence of the points given in the study material. And no need to break too much of head in trying to remember these things. That will waste unnecessary time. Right. So that is the thing. So moving to the first one, that is introduction to accounting standards. So the reason I suggest students to do this later is there are a lot of things about what are the standards, what do they give, and all of that. Till the time you know what is there in the standard, this introduction doesn't make sense. Okay, that is why we generally do it towards the end. MCQs again can be tested from this particular area because it is a lot more text heavy, right? So when you talk about accounting standards, we have GAAP, which is called the generally accepted accounting principle, which are a common set of accepted accounting principles, standards, and procedures that business reporting entity must follow when it prepares and presents its financial statement. So what is GAAP? Generally accepted accounting principle. These are common set of accepted accounting principles. So these are accepted principles. These are accepted standards, procedures that a reporting entity must follow when it prepares the financial statement. Okay. Now, accounting standards are a part of your GAAP, which are policy documents with respect to accounting transactions or event in the financial statement of entities. So accounting standards are what? Accounting standards are policy documents. They are policy documents with respect to transactions or events in the financial statement of the entities. So they deal with accounting transactions and event regarding recognition of events and transactions, measurement, presentation, and disclosure. So if you see, almost all the standards have this: recognize, measure, present, disclose. Sir, what is recognition? This is when you pass the journal entry in the books, when you record a transaction in the books, when you record an event in the books, that is recognition. Measurement talks about at what amount you should recognize. Presentation talks about how you should present in the financial statements. Simple example could be presentation of current and non-current liabilities. Disclosure is what is the additional information that has to be disclosed or shown in the financial statement or notes to accounts with respect to assets, liabilities, revenue, expenses, and any other item in the financial statement, that is largely equity. So that is what an accounting standard does. Okay. Accounting standard helps to standardize alternative accounting treatments and comparability of financial statements. See, if there are no standards given, each entity would do accounting as per their own wish. Each entity would get their own accounting treatment. Let's say, for example, leases. Somebody may use some other kind of rate, depreciation may not be consistent. All of those problems could be there. So for that, we have accounting standards that helps to standardize the treatment and ensures comparability in the financial statements. As far as accounting standards are concerned, we have seen there are AS1 to AS29. AS1 to AS29, these are the standards. Out of this, accounting standard 6 and accounting standard 8 are no longer applicable. They have been withdrawn. Okay. These we already have seen through. So you'll be able to understand, right? So these are accounting standards. And if it is a listed company, what is applicable is Ind AS that we'll discuss subsequently. Now, some terminologies that you need to be aware of. One is IFRS. IFRS stands for International Financial Reporting Standards. These are global standards which are accepted or which are implemented in lots of countries across the globe. Okay, that is what is called International Financial Reporting Standards. Then we also have something called as US GAAP. This is specifically for US, generally accepted accounting principles for US. That is what is called US GAAP. Okay. Now, in India, what happens is you have two sets. One is called Ind AS, another one is AS. Ind AS is IFRS based standard. Ind AS is IFRS based standard, and accounting standards are separate. Accounting standards are not directly based on IFRS. Okay. So Ind AS is a recent addition. Recent means not very recent. Okay. We started implementing these from 2016 onwards. Okay. That is when we started Ind AS, but it is linked to IFRS. We say these are IFRS converged standards. These are IFRS converged standards. So Ind AS are IFRS converged standards issued by the government under the supervision and control of the Accounting Standard Board of ICAI in consultation with NAFRA. So finally, National Financial Reporting Authority, they recommend that yes, Ind AS has to be applicable. We will see to which all companies Ind AS are applicable. Accounting standards are applicable to other entities where Ind AS is not applicable. So that also will come to it, right? Now, as far as Ind AS is concerned, globally we have International Accounting Standards Board. We have International Accounting Standard Board. Okay, they are responsible. So International Accounting Standards Committee is responsible for developing international accounting standards. It was established in 1973. It is presently known as International Accounting Standard Board. It is currently known as International Accounting Standard Board. Now, earlier what used to happen is they used to issue something called as International Accounting Standards. Okay, who used to do it? International Accounting Standards Committee. After International Accounting Standards Board took over, they started issuing IFRS. So IAS we have 1 to 41, no need to remember. Okay. IFRS as of today, when we're talking, we have 1 to 17, right? When it comes to Ind AS, Ind AS have been numbered alongside IAS or IFRS. So if it is IAS 1, it is Ind AS 1. If it is IAS 41, it is Ind AS 41. If it is IFRS 1, it is Ind AS 101. If it is IFRS 17, it is Ind AS 117. So like that we follow the Ind AS. Okay. Now what are IFRS? IFRS are issued by International Accounting Standards Board. International Accounting Standard Boards. These are the standards which are globally taken or globally adopted. Now some countries, what they do is they directly adopt international financial reporting standards. They directly adopt international financial reporting standards. For example, you go to UK, other European countries, they take it as it is IFRS. The second technique is convergence process. This is used by other countries where the government feels that adopting IFRS as it is not advisable. So let us converge. Converge means what? Take IFRS, add few more items to the IFRS, remove some items from the IFRS, and create a new set of standards. So in India, we have IFRS plus or minus some things that has resulted in Ind AS. So either IFRS or IAS. Whatever we add is called a carve-in. Whatever is removed is called carve-out. Whatever is added is called carve-in. Whatever is removed is called carve-out. Okay. So a carve-out is a difference from the practices and principles of international standards. International standards say something which we don't follow. All of these you'll understand at final level. So no need to worry about what is there and what is not there. A carve-in is additional guidance given in Ind AS that is not given in IFRS. There are something which is peculiar to Indian economy. There are something peculiar to Indian companies. For that, there are additional guidance available. That is called carve-in. Carve-out, we don't want to follow something in the IFRS. We call it carve-out. We want to follow something extra which is not given in IFRS. That is called carve-in. Okay. So that is the comparison between Ind AS and IFRS. Now, why is there a difference between IFRS and Ind AS? One thing we said, there is carve-in and carve-out. That is one thing. There are some terminology differences. Like we say statement of P&L, they use statement of comprehensive income. Okay. Then we say balance sheet, they use statement of financial position. So that is one kind of difference. Then some options given in IFRS have been removed in Ind AS. This is not a carve-out. So IFRS said 3 ways you can do it. We took only 2 days, 2 ways. That is not carve-out. Then because our economic environment is different, we have removed some accounting treatments and some principles we have changed. That is called carve out. Okay, and no need to spend too much of time in understanding. Just understand there is something carve in, there is something carve out. Removal of option is not a carve out. Now, why did we converge towards global standards? We converge toward global standards so that the Indian financial statements which are prepared, they are comparable with the global financial statements. Also, with the economy booming up, a lot of foreign investment coming into India, foreign investors want financial statements which are IFRS compliant, only then they have this faith on the financial statement. Okay, so for that, what the government thought is, because the economy was opening up and foreign investors were coming up, and then you have this global accounting bodies meet and all of that, hence they thought it is the right time to move towards global standards. Now the need comes because first, we are raising funds from international markets. Companies these days are raising funds from international markets. Each country has different way of preparing financial statements. But if you want to raise money from global markets, then you need to have some common set of financial statements which can be compared. So that is why we move towards international financial reporting standards. Okay, comparability of financial statements. So international investors and all, they want to compare the financial statements. Now, if India is preparing some other basis financial statements, UK is preparing something else, China is preparing something else, comparability becomes difficult. That is why a common set of accounting principles were considered. This also makes filing with the registrar of companies and similar authorities easier. It ensures uniformity, comparability, transparency, etc. So this is again, continuation of comparability, but uniformity. So because you are following a common set of principles, the way you prepare the financial statements are also uniform. See, if you don't do this, what happens is government may want to twist its financial, reporting principles in the way it wants the entity to present the financial statements. So you learn about this, right? Paragraph 46A in Accounting Standard 11. Now here, the government said, okay, we will not take exchange losses to P&L, but we will capitalize, right? Such kind of things are not right if you look at the global financial reporting framework. So that is why IFRS was implemented. And global investment. So because we want global investment to flow in, that is why the convergence is needed. So that is the need for convergence. Remember the side heads and one sentence each, if at all it comes in the examination. What is the benefit now? See, we talked about need. Why did we go? What was the benefit? It improves investor confidence across the world with transparency and comparability. Similar points. Improves inter-unit, inter-firm, inter-industry comparison. Group consolidation will be easy with the same standard by all companies. So just imagine there are multiple different companies following each accounting standard separately. Consolidation will become a nightmare. So with the help of this, consolidation becomes easier. Then acceptability of financial statement by stock exchanges across the globe. So Indian companies, when they want to list in international exchanges, this actually smooths the process. Now, having said all of this is theory, a lot of it. There is still one big country, United States, which follows a different set of accounting principles under the name US GAAP. Okay, so they're still following their own way, and the rest of the world is following IFRS. Indian accounting standards are converged standards issued by the government. We have already seen this. The numbering part also we have already disclosed. No need to remember this. Okay, so these are just for your reference. No need to remember this. When it comes to final, you will, understand this. Any doubt so far? Any question? Then you could also get a theory question on benefit of accounting standards. Now, these accounting standards are your accounting standards which are applied in India. Okay, first, standardization of alternate accounting treatment. This is one of the most important benefit of having an accounting standard. Standardization means each one will follow a standard approach, or you know that there are only limited options available. For example, if you talk about, let us say, inventory valuation, FIFO weighted average, LIFO is not allowed. So you know that there is some kind of standardization when there are alternate accounting treatments. So this is the first benefit, standardization of alternate accounting treatment. Okay, then disclosure requirements, additional requirement for disclosures. So for some items, if you don't disclose additional information, it may not give a full picture. For example, leases. Okay, there is an aging analysis which is required. Related party disclosures which are required. So these disclosures, if it was not mandated by the standard, and if it is not mandated by any other law, then it can be missed. So it will help in getting the additional disclosures which are required. Then comparability. You can compare multiple financial statements between different companies year to year basis for the same company. Then reduction in scope of creative accounting. Creative accounting is basically window dressing or manipulating the financial statements. Because you have limited the options that are available, there is a scope in reduction of creative. There is a reduction in scope of creative accounting. All right. So when you get a benefit question in the examination, please remember standardization and comparability. That is there in almost all the points. So standardization, comparability, the two things. Then reduction in scope of window dressing and your additional disclosures if at all required. Then we have how are the standards set? What is the standard setting process? Okay. Currently, what happens is you have the accounting standard board. You have the accounting standard board. The accounting standard board will frame the accounting standards. They will notify and all of those things. Then NFRA recommends the standards to the MCA, and MCA notifies the standard for the companies. So ICAI will frame the standards. They will submit it to NFRA for the consideration and thing, and then they will recommend standards to the MCA, who will notify. Now, when we talk about the process, first you identify the area in which you need the standard. So
the accounting standard board, first thing we need to identify where do we want to set up the accounting standard or which area requires accounting standard. So that is what is done first. Okay, then we constitute something called as study groups. Study groups means who? These are the groups who will take up the area, they will do research, they will create multiple drafts, and they will have preliminary draft ready, which will be submitted to various other parties as a part of the next step. So first you identify the area. For example, we need a standard on agriculture. So we'll identify, okay, we need agricultural based standard, first thing. After we have done that, we'll prepare a draft and circulate the draft. Sorry, after that, we'll constitute the study groups. What will the study group do? Study group will prepare the preliminary draft of the accounting standard. Those preliminary draft will be circulated. It will be circulated. Circulated to whom? To the council members of the institute, MCA, SEBI, CAG, CBTT, Standing Conference of Public Enterprises, and all other entities. Okay, that is how they will be circulated. Okay, then you will take the views of all these bodies. Then we will finalize something called as the exposure draft. This is a draft. Now it is an exposure draft. This exposure draft will be given to public. So first, they create a group, they will have a draft, they will circulate amongst the bodies, they will take the views of all the different bodies, and then you will create an exposure draft of the proposed accounting standard. That exposure draft will give it to the public. Then you will receive comments from the exposure on the exposure draft. Then again you will evaluate that and all of those things, and then you will submit it to the council. Then finally, the final draft that is available, it is proposed, and once you take all the viewpoints and all of that, you'll modify the draft, and the final draft you will consider, and that will be finally concluded as issuance of accounting standard. For non-corporate entities, accounting ICAI will take care, and for corporate entities, MCA in consultation with NFRA. This is very important from MCQ point of view. For non-corporate entities, ICAI will issue. For corporate entities, MCA will issue in consultation with NAFRA. A small point, again, no need to be too much bothered about this. Implementation roadmap for Ind AS, it is a pretty old roadmap. When did we start? On voluntary basis for any company from 1st of April, or even after that, if company wants to incorporate Ind AS on voluntary basis, it is allowed. From 1st of April on a mandatory basis. From 1st of April on mandatory basis for whom? For companies having net worth of 500 crores or more. Listed, unlisted. Companies which are listed in the process of listing or unlisted having net worth of 500 crores or more. Or parent, subsidiary, associate, and JV of the above. So for if Ind AS is applicable to one company, it gets applicable to the parent entity. It also gets applicable to the subsidiary entity, associate, and joint venture of the entities. Okay. So on mandatory basis from 1st of April, threshold is 500 crores for both listed and unlisted. In phase 2, they cover all listed or in the process of listing companies. If any company which is listed or is in the process of getting listed, you will cover them. But here there is no limit. Here there is no limit. So as of today, if there is any company which is listed or is in the process of listing in any stock exchange in India or outside India, is covered. Okay. But if there is some company on SME exchange, they are exempted. That's the first thing. Then if it is an unlisted company, you need to have 250 crores, but less than 500 crores of net worth. So as of today, if you ask me, to which all companies does Ind AS apply? First, all listed companies, all companies in the process of listing, except those listed on SME. Unlisted company having net worth of 250 crores or more, but less than 500 crores, and parent, subsidiary, associate, and JV of the above entity. Then, very important, once Ind AS is applicable, the entity shall be required to follow Ind AS for all subsequent financial statements. And if Ind AS is not applicable, you will apply accounting standard as per the as per the notified by the Companies Act.
Okay, this part you can leave it. In BF, it's an advanced version for India's application. This you can just leave it as far as the examination is concerned. Or if you want, you can give one reading. You can give one reading if you want to, but I would not recommend as far as the examination is concerned. For first time, you'll definitely read it. For examination purpose, you can just ignore it. So that is the introduction part, what we did. The next part is framework for preparation and presentation of financial statement. Now, framework basically is something that gives the structure. So the role of this framework is twofold. One is, if something is not given in the accounting standards, and you have to interpret few things, you can come and refer to the framework. That's the first thing. Then the framework serves as the basis for preparation of accounting standards. Okay, so what is the purpose of framework? This you can remember for theory purpose. Assist the enterprise in preparation of the financial statement in compliance with accounting standards and dealing with the topics not covered by AS. So if something is not covered by AS, if something is not defined in the AS, you can come to the framework. Assist the ASB, Accounting Standard Board, in task of development and review of accounting standards, not SA, accounting standards. Assist Accounting Standard Board in promoting harmonization of regulations, AS, and procedures relating to the preparation of financial statement. So, regulations as in, let us say, Schedule 3. They can give recommendations to the ministry how it is to be done and all of those aspects. Helps us auditors in forming an opinion as to whether the financial statements conform to AS. So some definitions, you can pick it up from framework and see whether true and fair view are there. And users can interpret financial statements used on basis the framework. Okay. The framework applies to general purpose financial statements which are prepared for external user. General purpose means a common financial statements which is prepared for the multiple users. Okay. If it is a special purpose financial statement, let's say preparing something for projected financial statements and all of that, those are not covered by the framework. The framework defines users of financial statements or indicates users of financial statements as investors, the shareholders who have given the money, lenders, loan given, government, public, employees, customers, and suppliers. These are the users of financial statements. And the framework is used to prepare financial statements for these users. Okay. Now, if accounting standard says something else and framework says something else, then accounting standard will prevail over the framework. There are some cases, and no need to remember these, but there are some cases where definitions in framework is different from the definition in the accounting standard. So what will prevail? Accounting standard will prevail, okay, as compared to the framework. Now, coming to the first part covered by the framework, components of financial statement. Now, if you see, Schedule 3 already prescribes the financial statement format. Companies Act already tells us what are the components of financial statement. But again, this gives us a general guidance of what is included in financial statements, what should be the qualitative characteristics of financial statement. So that is what is given in this particular framework. When it comes to components of financial statement, you have balance sheet, profit and loss, cash flow, notes and other explanatory statement. This is again only for MCQ. All of us know what are included in each one of this. They are required to show a true and fair view of the performance and financial position and cash flow of an enterprise. So financial statement should give a true and fair view of what? Performance. Performance is given by P&L. Financial position is given by balance sheet. Cash flow is given by cash flow. So performance, P&L, financial position, balance sheet, cash flow. Okay. Now, what should be the characteristics of financial statement? They should be understandable. Understandable means users should be able to understand. They have to be relevant. It has to be relevant for the users. Relevant means the information that you give, that has to be relevant. You should not be giving irrelevant, unnecessary information that is not relevant for the users of the financial statement. For example, let us say Reliance Industries. Reliance Industries turnover is 250,000 crores. In crores. There is printing and stationery expense of
2000, just for example. This is not relevant. Okay, so that is how you have to see what is relevant to the users of the financial statements, and that is how you have to give the information. They have to be reliable. The users must be able to rely on the financial statements, the information given in the financial statements to take decisions. And lastly, they must be comparable. Comparable means must be able to compare the financial statements of one entity with another entity, or with this within the same entity on a year-to-year basis. So characteristics, they should be URRC: understandable, relevant, reliable, comparable. Understandable, relevant, reliable, comparable. Components: balance sheet, P&L, cash flow, notes. P&L shows the performance, balance sheet shows the financial position. Then we talk about fundamental accounting assumptions. This is as given by Accounting Standard 1: going concern, consistency and accrual. Accounting policy can be changed. We have already discussed this as well. Then comes elements of financial statement. What are the elements of financial statement? Elements of financial statements are basically balance sheet elements, P&L elements. Balance sheet elements are assets, liabilities, and equity. Assets is equal to liability plus equity. This is the accounting equation. Then you have income and expense. Income minus expense gives you the profit. What is an asset? Asset is a resource controlled by the enterprise as a result of past event from which future economic benefits are expected. Resource controlled by the enterprise as a result of past events from which future economic benefits are expected. What is liability? You have seen this in AS 29 as well. Present obligation arising from past event, settlement of which is expected to result in outflow of resource embodying economic benefits. What is equity? Residual interest in the asset of an enterprise after deducting all liabilities is called equity. Can be tested for MCQ. Income: increase in economic benefits during the accounting period from inflow or enhancement of asset, or decrease in liability that result in increase in equity. Now this is a very typical definition. We generally know what is income, but what does income give us? Income results in increase. Income results in increase in economic benefits. Increase in economic benefits from inflows. You have received something, asset has increased, liability has decreased. Ultimately, income will increase the equity. Income will increase the equity, and expenses, just opposite, will decrease the equity. Okay. This we have already seen. Then framework also talks about how can we measure different elements, okay, especially when it comes to the assets and liabilities. So elements can be measured either at historical cost. Let's say fixed asset. Fixed asset can be measured at historical cost. Fixed asset can be measured at historical cost, that is the purchase price. It can be measured at current cost, but see, this is just the definition. AS16 also tells, AS10 also tells us that we can measure the assets at current cost, something like your fair value revaluation model. Cash that would have to be paid if the same or an equivalent asset was acquired currently. Then we have realizable cost, net realizable value, what we talk about. Cash currently realizable on sale of asset in a disposal. So what is the difference? Current cost means amount that I need to pay if I have to acquire the asset. Realizable means the amount that I will get if I sell the asset. So current cost is from buying perspective. Realizable cost is from selling perspective. Then we have present value. That is, the present value is basically what is the amount that you will receive today based on the future cash flows. Okay, so obtaining present value of future cash flow. What is the present value of future cash flow? The process is called discounting. Now, present value is the amount one has to invest on current date to have an amount after some particular years. So present value is basically future value divided by 1 plus r to the power of n. This we have already seen. These things we have already discussed: understandability, relevance, reliability, comparability. Please ensure a couple of points from this part you are able to write and
understand. This sometimes is tested in MCQs and also as a part of your regular thing. Constraints on relevant and reliable information. Now, what is a constraint? Constraint basically means something which is not allowing us to give full information. Okay. Now, if, for example, I want to give all information which is reliable, if I want to give all information which is reliable, it will take me 6 months. Now, if I report something after 6 months in today's era, is it even useful? It is not useful. So, if there is a delay in reporting of information, then the information loses its relevance. So, I have to give it on a timely basis. Now, if I'm trying to give it on a timely basis, I may not be able to give all the information. If reporting is done without obtaining all information, it may not be reliable. So, there is a constraint. I have to give relevant information. For giving I have to give reliable and relevant information. For giving reliable information, I need a lot of time. If I take a lot of time, the information will not be relevant. Okay. So this is one constraint. The other constraint is balance between benefit and cost. See, if I have to gather some information, process that information, and if I have to give it to the users of the financial statement, I'll incur some cost. If I'm incurring some cost, the benefit should be more than the cost. Benefit should be more than the cost. If huge amount of cost is incurred to derive a benefit, then it is of no use. So that is why you would see subsequently when you go to CA final, there are some practical exemptions kind of thing which are given so that entity doesn't need to spend huge amount of money to extract the information. So constraints, timeliness. If I give it late, it is not relevant. If I give it faster, all information may not be there. And benefit and cost, there has to be a match. Financial statements, as we said, should give a true and fair view of the performance and financial position and the cash flow of the enterprise. Okay. Then this all of us have been doing basically the capital part of the business. Okay. Basically, opening capital plus profit minus losses plus capital introduced minus drawings gives me closing capital. Okay. Now, from this equation, if at all a question comes in the examination, you should be able to calculate what is the profit or loss made during the year. How? Any missing number. They may give you opening capital, they may give you profit or losses, they may give you drawings, they may give you closing capital. You can find this number, which is the balancing figure. Okay. Now let's look at this question. Preparation of financial statement assuming going concern and assuming not going concern. Okay. So if it is going concern basis, then you will carry the amounts at historical cost only. If it is not a going concern, you will calculate or you will show it at a realizable value. So what is given? Capital is given, P&L balance is given, loan, trade payables, assets, stock, trade receivable, deferred cost, and bank. Okay, all of these are given. The remaining life, this is as on 31st March of year 1. The remaining life of fixed asset is 5 years. Pattern of use of the asset is even. The net realizable value of the fixed asset is on 31st March is 60,000. They're saying 5 years useful life remaining. If I follow the going concern assumption, I will provide depreciation on this and I will do the calculation. If it is not a going concern, then I will show the asset at realizable value, which is 60,000. Traders' purchases and sales amounted to 4 lakhs and 4.5 lakhs. So that doesn't change. Cost and net realizable value of stock on 31st March were 32,000 and 40,000 respectively. So if I'm following the going concern, stock is 32,000. If I'm following non-going concern, stock is 40,000. Sir, how can we increase the value of stock? See, the company is no longer a going concern. Means we will sell off the assets and liability. So we'll show everything at net realizable value. Expenses for the year amounted to 14,900. It doesn't change. Deferred cost is to be amortized equally over 4 years. So this deferred cost of 10,000 divided by 4, you should amortize it equally over 4 years. So if it is a going concern, expense will be 2,500. If it is not a going concern, this deferred cost does not make sense to me and that 10,000 will be written off. Debtors on 31st March is 25,000, out of which 2,000 is doubtful. Collection of another 4,000 depends on successful reinstallation of certain product supplied to the customer.
25,000 is the trade receivable. 2,000 is doubtful. 2,000 is doubtful. So we'll make provision for doubtful. Another 4,000 depends on reinstallation of product. If I'm closing my business, I'll not be able to reinstall the product. So this 4,000 also will be lost. Closing trade payable is 12,000, likely to be settled at a 5% discount, and cash balance is 37,100. There is an early repayment penalty for the loan, 2,500. So if I am closing down the business, I have to pay these charges of 2,500. How do we prepare the P&L? Sales will remain the same. Closing stock higher based on NRV when it is not a going concern. Okay, then opening stock will remain same, purchases will remain same, expenses will remain same. Depreciation, the depreciation part will change. If it is going concern, 13,000. If it is not a going concern, it is coming down from 65,000 to 60,000. So only 5,000. Deferred cost not going concern, 2,500. If you are not a going concern, fully written off. Provision for bad debt, 2,000 if going concern. Another 4,000 if not a going concern. Interest will remain the same for the year. Penalty, if it is not a going concern, we have to pay penalty of 2,500. Then trade payable, if you, what they've said, which is likely to be settled at 5% discount. So if you are settling it immediately, 5% discount. So that comes only if it is a not going concern. Okay. Now from this, you will get the profit. Then coming to the balance sheet, fixed asset, if going concern, 52,000 based on depreciation, realizable value. Stock, realizable value. Trade receivable, 25,000 minus provision of 6,000. Deferred cost, 0 because it will no longer be there. Cash in bank remains the same. Capital, 60. P&L, depending on whether you have earned 16,100 or 18,700. Right? Then interest payable will remain the same. Loan 35,000, here higher amount because of penalty. Trade payable, full value, discounted value. This is not going concern, this is a going concern. Okay, this is a simple thing. If at all a question comes in the examination, we should be able to score full marks. Okay, this you can do it on your own. There is nothing complicated as far as the thing is concerned. Just that, take the opening capital, capital introduced, any income that you have received, settlement, wages paid, rent outstanding, and final drawings, you will get to the closing equity. Okay, so here what they want us to do is step by step. So for example, opening capital equity is 3 lakhs, asset minus liabilities. Introduce capital 20,000. This will increase the asset, no change in liability, it becomes 320. Income from investment, increase the asset, no change in liability, 328. Settlement of liability will reduce my asset, will also reduce my liability and equity. Why did equity increase? Because we settled with only 30,000. Wages paid, reduce my asset, no change in liability, overall equity reduces. Rent outstanding, it will increase my liability, it will reduce my equity. Drawings of 4,000, reduce asset, reduce equity. Right? So this concludes the framework of the financial statement. But again, not a really great importance if you ask me for the examination, but here and there they keep on testing theory. All right. So today we'll conclude here the session. Tomorrow we don't have a session. Day after tomorrow we'll do the applicability of accounting standards followed by buyback of shares, and then one more session we'll take to discuss the MCQs and overall conclusion of the session. Okay. Any questions? Yeah. Happy New Year to each one of you. Thank you. Today we'll start with the last two topics which are left. One is applicability of accounting standards and the other one is buyback of securities. That is what we'll be covering up today. And then, tomorrow or Monday, I'll let you know a date where I'll be doing a session of about 3 hours time covering, BOS MCQs, study material MCQs and all of those things, which will give you a good amount of, comfort when it comes to examination. Okay. So applicability of accounting standards. When we talk about this also is a small chapter. You need to remember few things. Okay, there is nothing other than remembering as far as this particular chapter is concerned. Now, when we talk about accounting standards, one thing that you have to keep in mind, and we also saw in the earlier chapter, that if it is a listed entity, we will apply Ind AS. And if it is an unlisted entity having net worth of 250 crores, there also will apply Ind AS. Okay. Now, accounting standards that you learn from accounting standard 1 to accounting standard 29, those will be applicable to other than this set of entities, That is first thing what you have to understand, right? Now, when it comes to accounting standards, some act, for example, Companies Act requires that the entity must comply with the accounting standards. Okay. The Companies Act requires that the entity must comply with accounting standards. That is as far as the legal requirement is concerned. Now, when it comes to other entities, like let us say partnership firm, sole proprietorship, do we need to comply with accounting standards? There is no statutory requirement. To comply with accounting standards. That is the first thing. But what we need to understand is, whenever a chartered accountant, when you become chartered accountant in future, and whenever you sign the financial statements, when you give an audit report, then you have to comment whether the financial statement complies with the accounting standard or not. So for companies, it is applicable, either accounting standard or Ind AS is applicable. Whereas for other than companies, there is no act which says you have to apply. For example, those cases where, let us say, partnership act is there, or sole proprietorship form is there, there is no statutory requirement in such cases. But when me as a chartered accountant, or when you as a chartered accountant, when you prepare a report on the financial statements, for example, for submission to the bank, there you have to check whether the accounting standards have been complied or not, and if it has not been complied, you have to disclose that particular fact, right? If statute governing the enterprise does not require compliance with the accounting standards, the member of the institutes are required to ensure the compliance while attesting, that is, while auditing the financial statements. Okay, so that is one thing what you have to understand. Now, when it comes to income tax, there are some income tax computation and disclosure standards. Okay, so they are given accounting standards on accounting policy, inventory, construction contract revenue, tangible assets, foreign exchange, grants, securities, borrowing cost, and provisions. So do we need to remember? It can be tested for MCQ. If possible, remember, otherwise you can just ignore this. So this is specifically giving guidance on how do you handle certain items for income tax purpose, because entities can do on their own. Entities can have their own way of accounting certain stuff. Like I'm a sole proprietorship, I can follow whichever accounting policy I want. The income tax realized that and said that, boss, you need to be in compliance with these standards for specified entities, for specified SSEs. And this, as far as your exams are concerned, it is just a list. If possible, remember 2-3 of them. If not possible, you can just ignore. Easy way to remember: accounting policies, ours is AS1, here also it is AS1. Inventories, ours is AS2, here also it is AS2. These two things at least you can remember. Okay, remaining, if possible, remember, otherwise leave it. The last one, the 10th one, is provision. For us also, the last one is provision. Okay, that is one thing. And now coming to accounting standards applicability, there are 4 categories. Level 1. There are 4 categories: level 1, level 2, level 3, level 4. Okay. Now these categories, for the purpose of accounting, applicability of accounting standards, this has been prescribed by ICAI. And these are non-corporate, what we will deal first with. Non-corporate, then we'll talk about corporate. Now, what is level 1 entity? Level 1 entity is an entity which is listed or in the process of listing. Now, you may have a doubt, sir, how can a non-company be listed? Because generally what we hear, company is listed. What could be the case when non-company is listed? It could be some kind of fund, mutual fund. It could be some kind of trust. Okay, it could be some kind of trust which wants to list its particular debentures on the stock exchange, or in foreign countries, in some cases where non-companies are allowed to be listed. Those scenarios, but very rare. Okay, either it is listed or in the process of being listed. It could be any security. See, I may not be a company, but I may want to list my debentures, for example, or bonds, for example. Okay, those categories, but rare to find it in real life. First. Second, banks, financial institutions, and insurance. So first category is listed. Second is banks, financial institution, and insurance. Turnover more than 250 crores. Borrowings more than 50 crores. Any of these five criteria satisfied, four criteria satisfied, that becomes level one entity. Also, the holding and subsidiary becomes the level one entity. Now again, we refer to holding and subsidiary in terms of company. Now here, holding and subsidiary basically means maybe a partnership firm having another partnership firm. Let us say there is an LLP and it has one more LLP in which it is a member. So this can be a holding subsidiary relationship, but very, very rare to find it in real life scenario. They have revised it subsequently, but not applicable for your exams, of course. But for May 25 attempt onwards, I think we'll have a separate classification for these entities. So large entities, what we call level one, listed banks, financial institutions, and insurance, 250 crores of turnover, 50 crores of borrowings. When it comes to the second category, turnover of 50, borrowings of 10 crores. Then small category, 10 and 2. 10 and 2. And lastly, the fourth category is the residual category. Second is called medium, third is called small, fourth is called micro. MSME, what we call, right? Medium, small, micro. Micro, small, and medium enterprises, what we call. These are categorized as your MSMEs and large entities. Okay, this classification, just understand, learn it. Only thing that you need to learn is the first one. The remaining you can understand, much more easily. For example, 250, 50, 10. So 50 and 10 is here, 50, 10, and 2. All right. 250, 50, 10, 50, 10, and 2. So 50, 10, 50, 10 is common. That way you can remember. Okay, that is as far as the classification is concerned. Now, level 1 entities are required to comply in full with all accounting standards. Level 1 entity is required to comply with all accounting standards. Level 2, 3, and 4, for non-company entities, there are some exemptions and relaxations in the applicability of accounting standards. That is what we will be, referring it to right now. Now, whenever there is any exemption or relaxation for MSME, that is level 1, level 2, and level 3, they will disclose it by the way of note. Okay, so that is the first thing. Then another important thing here is, if any entity is covered in any level, opts not to avail few of the exemptions or relaxation, it shall disclose the standard in respect of which it has availed the exemption or relaxation. So if you have opted to avail few, not avail few of them, that also you need to disclose. Then if an entity has been covered in level 1 and subsequently gets covered in level 2 or level 3 or level 4, they shall qualify for exemption only after 2 consecutive years of that status. So for example, if I was level 1 earlier, current year I am level 2. Okay, but current year everything you have to comply with. Next year also I am level 2. So year 1 I was level 1, year 2 I am level 2, year 3 also I am level 2. Then I can take the exemption only in the second year. So only after 2 consecutive years. If only 1 year is there, I need to comply with level 1. Same thing. I was earlier level 2. Now I have become level 3. 1 more year you need to follow for compliance. Okay, so 2 years, 2 consecutive years, if you are in that status, in that year, you will, only after the second year, you will have this exemption. In the immediate next year, you will not get any exemption. So we have seen the definition of 4 categories, 1, 2, and 3. Listed banks, 250, 50. For second category, 50, 10. Third category, 10, 2. So 250, 50, 50, 10, 10, 2. That is how you need to remember. And yes, holding and subsidiary of each of these categories also fall under level 1 and level 2 respectively. This table, if you are able to remember, it is more than sufficient from this context. Now, one challenge that we get in this, understanding what is applicable, what is, exemption and all of that, remembering becomes difficult. Okay, remembering becomes difficult. It is a fact, right? Now, what you can do is, some standards you can make a thumb rule that, okay, these standards are not applicable at all. For example, cash flow statement, not applicable to any. Then Segment reporting, not applicable. Earnings per share, not applicable. Consolidated financial statement, not applicable. This associate, not applicable. Discontinuing this interim financial statements, not applicable. Then 27, not applicable. At least remember these standards which are not applicable to 2, 3, and 4. Okay, cash flow, segment reporting, earnings per share, consolidated financial statement, associates, joint venture, discontinuing operations, and interim financial reporting. Or 3, 17, 20, 21, 23, 24, 25, 27. This list you should remember. Then after that, what you can see here is for level 2 categories, leases has disclosure exemption. Leases has disclosure exemption. AS 29 has disclosure exemption and 28 has some exemption. So do we need to remember each of these exemption? It is about how much time you will spend to remember versus how many marks it will be tested. From this table, maximum 3 to 4 marks. I don't expect more than 3 to 4 marks that will come in the examination. That also it has very, very little chance. So as a student, I would advise, student, I never spend time in remembering this. And I would also advise you that if required, make a couple of readings, understand which are fully exempted, and that should be sufficient. If you can remember, no problem. See, there is nothing here to there is nothing in this particular standard where, or in this particular exemptions where there is some logic. Okay, there are some logics, of course, but it is more about remembering. It is more about remembering. At least remember 3, 17, 20, 21, 23, 24, 25, 27, and 29. These are exempt. 28 exemption with from certain categories, right? If you come to level 4, you will see that in this table, almost everything is exempt. Almost everything is exempt. And when you come to level 3, standards which are applicable are accounting standard 13, accounting standard 14, accounting standard 22, and accounting standard 26. These are fully applicable. Okay, these are fully applicable. All right. So that is it about applicability. Now, this was non-companies. Now we have companies. Now, as far as companies are concerned, what they have done is they have framed a rule and they've said we have small and medium companies, first category, and we have non-SMC. Means they have said these companies are called small and medium companies. These companies are called small and medium companies. Other companies are non-companies, non-small and medium size companies. So SMC and non-SMC. Now, what is SMC? Should not be listed or in the process of listing. So if you see here, the way you have to relate these two tables is, if it is listed, here we said it is large. If it is not listed, it is small. So not listed, small company. Then should not be a bank, financial institution, or insurance. In the first table, we saw large companies, bank, financial institution, and insurance. Then turnover should not exceed, that is less than or equal to 250 crores. If it exceeds, it was large. Borrowing less than or equal to 50 crores should not be a holding or subsidiary of non-SMC. So they have defined it in a negative way. Should not be listed, should not be a bank, financial institution, or insurance. Turnover should not exceed 250 crores. That is, it should be less than or equal to 250 crores. Borrowing should not exceed 50 crores, including public deposits, and it should not be a holding or subsidiary of non-SMC. Companies which are not SMC are called as non-SMC. It's a simple understanding, right? Then all accounting standards are applicable to non-SMC. What we are saying, if it is large or if it is non-SMC, all accounting standards are applicable. Whereas when it comes to SMC, which all are not applicable, that is what we will see. Accounting standard 3 is not applicable. Then 17 is not applicable. Then consolidated financial statement is not applicable. I think these are also not applicable, right? Related parties, taxes, then accounting for investment in associates in consolidated financial statement. This is not applicable. Joint ventures is not applicable. Consolidation is not applicable. So if you see, similar to the ones what we had when it comes to your what do you call SMC, small, medium, micro, small, and medium enterprise. Similar type of exemptions are given for the SMCs and non-SMCs as well. For non-SMCs, everything becomes applicable. There is no exemption. For non-SMC, there are some standards which are fully not applicable, and there are some standards like, for example, impairment of assets partially applicable, provisions partially applicable, right? Then employee benefits partially applicable. Partially applicable means the standard defines this part of the standards are not applicable at all. This part of the standards are not applicable. Only disclosure is required, or sometimes maybe for employee benefits they may say discounting it may not be done to the full-fledged extent, or disclosure, some of the disclosure requirement they may exclude. So that is how they define the applicability of non-SMC. Now, what is the reason behind that? The reason behind that is it requires a lot of effort. It requires a lot of effort for the entities to comply with the accounting standards. That is why they have come up and said, okay, for some standards everything will not be applicable. Okay, now if you look at the study material, they have given the list also. For example, this particular paragraph is not applicable, this particular standard is not applicable. Do you need to spend time in remembering that? You don't need to spend time in remembering all of that, because the amount, as I told you, right, the marks that you get, 3 to 4 marks, it is not worth. Okay, are we clear? Okay, so now what we'll do is we'll take up questions, because questions are more important. MCQs, especially when it comes to MCQs. So here you can see exemptions or relaxations for SMC companies. Okay, so they've said for not applicable, A17 is not applicable, relaxation from certain requirements. All of these are given as a part of this particular table. Do you need to remember each one of these? I said, it's too much of time and effort to remember all of this. Okay, so don't waste time in that. Let us see the type of questions. Now, here is what you need to remember. Non-corporate entities which are not level 1 entities whose turnover excluding other income exceeds dash rupees but does not exceed rupees 250 crores in the immediately preceding accounting year are classified as level 2 entities. Now, level 1 entity was 250, level 2 was 50, correct? Level 2 was 50. This table, that is what we need to remember. So, the answer is 50 crores. Following accounting standard is not applicable to non-corporate entities falling in level 2 in its entirety. Now, this what happens is sometimes we get confused, because you have to remember. How do you remember, or what do you say that no, it is applicable or not applicable? In that case, what you have to think logically. 2 is simple, standard, applicable. 10 is also simple, applicable. Now we are left with 17 and 13. 13 also is simpler. 17 is where you are talking about segment reporting. So you can say 17 is not applicable. Like that, you can make a guess which will help you to score marks. All non-corporate entities engaged in commercial, industrial, business reporting entities whose turnover exceeds 250 crores is classified as level 1 entity, straightforward. All non-corporate entities engaged in so and so having borrowings in excess of 2 crores but does not exceed 10 crores. So 2 crores but does not exceed 10 crores. Now 2 and 10, which category will it fall into? It will fall into level 3 entities. If you remember, 50 crores, 10 crores, 2 crores, right? That was the number, correct? 50, 10 and 2. 50, 10 and 2. So level 3 entities. SMC company means a company. SMC companies means a company which may be a bank, FI and insurance. No, it is a non-SMC. Whose turnover does not exceed rupees 250 crores in the immediately preceding financial year. Yes, so if the turnover is less than or equal to 250, it becomes a SMC. Whose turnover does not exceed 50 crores. See, that definition is not even given. This is for your level 1, level 2 and level 3 classification. Whose turnover does not exceed 500 crores. That is also not given. Okay, so this is the correct answer. XYZ with a turnover of 50 crores during previous year and borrowings of 1 crore during any time in the previous year wants to avail exemptions available in adoption of accounting standards. Advise the management on exemptions that are available as per the company's accounting standard rules. Now this, if you ask me, it is a long question because you have to give the exemptions. But first, when this question comes, first is it is a company. So company means our classification has to be SMC or non-SMC. Now, is it SMC? Yes, it is an SMC. Okay, so it's a small and medium-sized company. So what you can say is, because it is a small and medium-sized company, exemptions are available. Exemptions are available with respect to the small and medium companies as given by the company's accounting standard rules. Okay, so that is what you can write. Now, sir, can we what do we write in terms of exemption? Now, you can say, for example, accounting standard 17 is not applicable at all. Okay, there are some relaxations in accounting standard 15. That is what you can mention, right? Then when it comes to leases, accounting standard 19, leases also there are some exemptions. 28 also there are some exemptions. 29 also there are some exemptions. So you can give a list of 3 to 4 standards which are exempt, Okay. Then a company was classified as a non-SMC in year 1, 2. In 2, 3, it has been classified as SMC. So earlier it was non-SMC, now it is SMC. Management desires to avail the exemptions or relaxations available to SMCs in year 2 and 3. So earlier it was non-SMC, now it has become an SMC. Can we give relaxation or exemption in the current year? Can we give relaxation? Now what happens if you want relaxation? Then you have to be in SMC category for 2 years. Same conditions, level 1, level 2, level 3, level 4, same conditions are applicable here. You have to be in the SMC category for 2 consecutive years. If you are not in the SMC categories for 2 continuous years, then you cannot avail the exemption. Hence, the accountant's argument, the accountant of the company does not agree. His viewpoint is absolutely correct. Okay, that's it. Don't waste too much of time in this particular chapter. I'm repeating once again. Because a lot of time it happens, we become scared. If they ask question from the standard, what will we do? How will we handle? So no need to worry on that. All right. Now, having done this, now we'll move to buyback of securities. Any question, by the way?